Welcome to Yahoo Finance Invest 2025. And look, friends, it has been a mind-blowing year for investors for 80, 90, 100 different reasons. But for me, it has boiled down to three themes. Of course, AI. AI has rolled a bowling ball right through corporate America, right through America's job market. And as a result, corporate profits at tech companies have ripped higher, like off the charts higher. But in addition to AI, we have crypto has gone mainstream, notably Bitcoin. Ethereum has had a moment, but really this has been a year of Bitcoin and various other cryptos. And of course, the economy has been front and center. But for me, the story of the year has been all things AI and how absolutely fast things are growing in this industry. I want to bring in our very own Josh Lipton. You had a chat with Alex Karp over Palantir.
I did chat with Palantir CEO Alex Karp. We had a great wide-ranging chat, right? We got his take, Brian, on that great AI boom versus bubble debate. He blasts Wall Street analysts who say his stock's too expensive. They got it all wrong, he says. And we also talked about a new biography of Karp, which you know is making headlines. And he walks us through what it gets right and what it gets wrong.
All right, thanks, Josh. Appreciate it. In addition to Palantir and all things AI, like I mentioned before, this has been the year of Bitcoin. Bitcoin has gone mainstream. It has hit record highs. Now look, it hasn't gone up in a straight line. There's been a lot of volatility in all things Bitcoin, Ethereum, various cryptos, meme coins. I know you love your meme coins, but this year, Bitcoin has taken center stage. And when I think about Bitcoin, I think about the names in the industry. And for me, there's only one big name. And I want to bring in our very own Julie Hyman because we're sitting down with the biggest name in crypto.
And we're talking about Michael Saylor, of course. He's the executive chairman of Strategy, formerly known as MicroStrategy, and he really pioneered the crypto treasury strategy back in 2020 when he started adding Bitcoin to the company's balance sheet. They've added so much that they're now at 3% of all Bitcoin out there. So we're going to talk to him about that strategy, how it's worked out. We're going to talk to him about that volatility that you talked about and all of the regulation that we have seen that has become more and more favorable to the crypto industry.
You know what I love about Michael Saylor? Isn't he a rocket scientist too?
Yeah, I mean, he's got more degrees than he probably knows what to do with. But he's putting all of that brain power to work on Bitcoin.
Indeed he has, Julie Hammond. Thank you so much. I appreciate it. And like Julie just mentioned, a lot of volatility in the economy. I want to get over to our very own Jared Blickery.
Brian, the Fed has already cut twice this year. Meanwhile, inflation is stuck at 3% as the job market cools. It is game time for the Fed, and we've got former Federal Reserve Vice Chair Lael Brainard with us live today to separate signal from noise in a year when every headline feels market moving. We've got more than 20 decision makers from business and finance here to take you through the entire trading day. Yahoo Finance Invest 2025 starts right now.
A big let's go and welcome to Yahoo Finance Invest 2025 presented by eToro, a special day celebrating you, the investor. We are streaming across the globe. You can see us everywhere, including the US, UK, Canada, Australia, Taiwan, and Hong Kong, a true one-day live event. We've already told you about Michael Saylor, Lael Brainard, and Alex Karp. We also have exclusive insights from market movers, including Pfizer CEO Albert Bourla, Delta CEO Ed Bastian, Allianz Chief Economic Advisor Mohamed Al-Arian, Guggenheim Managing Partner Ann Walsh, Robinhood co-founder and CEO Vlad Tenev, the Shark Group CEO Damon John, Reddit co-founder Alexis Ohanian, and so many more. We have a massive day ahead. In addition to these key guests, we have also some exciting announcements from Yahoo Finance ahead. Investors are navigating unprecedented times. The economic landscape is shifting faster than ever before, and record-setting markets are lending way to correction fears. For years, many call crypto a safe haven, and while Bitcoin and other coins went mainstream this year, this safe haven has been on a roller coaster ride of late. Let's get right to our very first guest. So psyched to talk to this next guest. After going public in 1988, MicroStrategy weathered the highs and lows of the dot-com era. One of its biggest moves came decades later. In August 2020, the company bought $250 million worth of Bitcoin, becoming the first publicly traded company to hold the token as a primary treasury asset. Today, the company, now known as Strategy, owns roughly 3% of all Bitcoin. With us now, co-founder and executive chairman Michael Saylor. Yahoo Finance's Julie Hyman is here with me as well. I'll come there in a second, Julie, and join you. Michael, so good to see you right off the jump here. Look, we had Bitcoin hit a record high just a few weeks ago, $126,000. We've seen this pullback here over the past few weeks. I look at strategy stock down about 27% over the past month. Are investors losing faith in the Bitcoin movement?
No, I don't think they're losing faith. If you're an investor, it really comes down to what your time horizon is and how much volatility can you stomach. So if you want max performance, you're going to take max volatility. Strategies up 75% a year on average for the last 5 years. So you can actually outperform Bitcoin if you buy an equity that's amplified like MSTR. If you don't want to trust anybody, you want no counterparty risk, you buy Bitcoin. Bitcoin's up 50% a year over 5 years. No counterparty risk. It's very straightforward. If you want to have your cake and eat it too, you could buy some convertible preferred like STRK. STRK will get the vol. The vol on MSTR is like 60, 70. The vol on Bitcoin is 45. STRK would get your vol to like high 20s. And you get a mixture of a dividend and principal protection and some of the upside of the common equity. And if your time horizon is less than 4 years and you don't have much volatility to stomach, you shouldn't buy the equity or the equity hybrids. You should buy the credit, something like STRC. STRC is meant to be very, very stable, around $100 plus or minus a few pennies. And you get like a 10 and 10.5% dividend, that's tax deferred, and you're getting the benefit of the crypto economy, but you're not on the volatility roller coaster. So everybody's got different risk tolerance. They've all got different pools of capital. The good news this year is now you've got a variety of different instruments you can use to ride the digital wave.
Michael, and as we've gotten more instruments to ride the digital wave, particularly as people have had more and more ways to directly invest in Bitcoin, strategy stock has not done as well. To your point, it has over the past several years. But again, if you're talking about getting in now, or if you got in earlier this year, you wrote it down even as Bitcoin was going up. Are you concerned at all that the crypto treasury, the digital asset treasury strategy that you pioneered is losing a little bit of steam?
Over the last year, there's been 100 companies that have added Bitcoin to their balance sheet. The derivatives market and IBIT has surged. The flows into the ETFs have surged. All the major banks have announced support. The accounting has dramatically improved. The tax regime has improved. The administration support at the SEC, the CFTC, the Treasury level has improved. And so, and the technology has improved. Companies like Block have rolled out support for Bitcoin on Square and Cash App. So all the fundamentals are good. If you're going to be an equity investor, you have to think for yourself, and you have to have a time horizon of 4 years or longer. And equity markets are either going to lead or lag, and occasionally they'll perfectly reflect reality, but generally it's only a few days a year when they'll be perfectly rational. So if you don't have that 4-year time horizon, and if you don't want to make decisions based on fundamentals, if you simply want to park your money in a stable instrument and pick up a stable yield, you should be a credit investor. You shouldn't be an equity investor. I think the irony is the fundamentals of the industry are so much better today than they were 12 months ago that you've now got an extraordinary risk-reward opportunity. Now is a much better time to invest. You know all the things that you wanted to happen have happened. The market sentiment is negative, but that's an opportunity for the equity investor that makes their own decisions.
Michael, you're seen as a pioneer in this industry, charting new territory in cryptos and Bitcoin. What do you think about the likes of a Jim Chanos and others like him that are trying to profit off of you not doing so well?
I don't really think about Jim Chanos. I think that there'll be some skeptics. They don't really appreciate what Bitcoin is doing. They don't understand digital capital. They don't understand digital credit. But at the end of the day, the big dynamic in the industry is digital capital has gone from nothing to $2.5 trillion over 15 years. Digital credit didn't exist 12 months ago. We've issued nearly $8 billion of digital credit. Digital credit is got a tax equivalent yield of 4 times higher than bank credit. You know, you can have a bank account, in New York City that pays you 4% and it's taxable, or you could buy something like STRC that pays you 10.5% that's tax deferred. So the market's evolving, and the short sellers aren't really interested in the impact of AI or the impact on digital assets to change the way the world works. They're just interested in being skeptical as a business. So I don't really focus on them. Nothing great has ever been created by a short seller.
Michael, you've referred a couple times to this new digital asset credit that you guys have developed, STRC Stretch. It's a preferred security that, as you mentioned, pays out 10.5% in yield. And this is also a way for you all to not necessarily issue more stock in the underlying equity in order to pay for buying more Bitcoin, and therefore maybe not diluting those underlying shares as much. But how far do you think you can take that as sort of a funding mechanism for your Bitcoin strategy?
Well, I think the money market industry is massive. There's $30 trillion worth of assets invested in treasury-type instruments in the United States. Stretch is about 1% of 1% of that industry. It's about a $3 billion issuance. And the big idea here is you take an asset appreciating 50% a year with a volatility in the mid-40s, and you strip the volatility from 45 down to below 5, maybe to 2, 3, or 4, or even 1, and then you extract about 10% dividend yield. And if you do that, you end up with something which is yielding 6% more than the risk-free rate. And when the vol gets to 1, you've got a Sharpe ratio of 6. So we're really engaging in financial engineering to distill pure currency yield above the risk-free rate. And of course, the common stock shareholders in MSTR get the difference between the 10% that we pay and the 50% that Bitcoin's been performing. Long term, the math is pretty simple. We expect Bitcoin to appreciate about 30% a year for the next 20 years. We expect to pay about 10% dividend yield on the preferreds. 2/3 of the benefit go to the common equity shareholders, and most of the volatility is stomached by the common equity shareholders and the corporation. And the credit investors get this pure 10% return of capital dividend. That means it's tax deferred. They don't have to pay tax on it until they sell the underlying instrument. And that means that they're able to invest in a credit instrument that pays them a 10% dividend instead of holding a money market that pays them 4% in a taxable coupon.
Michael, of course, we're having this conversation the day after the government shutdown officially has ended. Things have to restart up again, but still record-setting shutdown. What did you think about the length of the shutdown, and do you believe it reinforces your long-term view on Bitcoin and various other cryptos? Because look, at the end of the day, record-setting shutdown, I mean, how can you have trust in the dollar?
Well, we joke there's no tariffs on Bitcoin. Bitcoin has no employees. It's got no corporate headquarters. It is an index reflecting the digital economy or the global digital economy. So if you just like to buy 1/21 millionth of the global free market, then you buy 1 Bitcoin. As people lose confidence in a currency in Africa or South America or Asia, as they lose confidence in a government, if they think that their favorite company might make a mistake, war, famine, pestilence, fire, flood, uncertainty, acts of God, all of these things are risk factors, and they're all risk factors that Bitcoin doesn't undergo and doesn't experience. So as people get educated, I think they can see the appeal of buying digital capital instead of investing their money in equity capital or real estate capital or fiat capital or corporate credit capital instruments. And so this is all a teaching moment, but I think that every single month that goes by, more and more people start to appreciate the benefit of owning 1/21 millionth of all the money in the world forever.
Michael, do you think, in light of the shutdown, that investors have lost faith in our country?
No, I don't think they've lost faith in our country. I think the country's going to do just fine. This is a hiccup. It's not our finest moment, but right now, the exciting things that are going on are digital intelligence, digital assets, digital capital, digital credit. It's pretty clear that money's going to move at the speed of light. It's pretty clear that 1 billion AIs are going to think 1 billion times faster than us human beings. You can see a world where 1 billion robots are going to build everything we need, where the cars are going to drive themselves, where the products are going to figure stuff out for us. So we're moving toward an intelligent world that is millions of times more efficient and more empowering. So in a world where 1 billion robots do everything I want before I think to ask for the thing, I don't know how I won't be better off.
Michael, is there a risk that some of those robots or perhaps quantum computers combined with generative AI, that they crack Bitcoin, or that they think of something better than Bitcoin and it becomes obsolete?
No, I don't think there is a risk. I think that technology will improve and hardware will improve, and at some point, if the hardware gets more powerful, we'll have to upgrade the software that protects our system. So just like you can expect your bank to upgrade their software, and you can expect to upgrade your Apple software and your Google software and your Microsoft software, and you can expect to upgrade your hardware devices. I'm on the iPhone 17 Pro Max right now. You'll upgrade your computer. Bitcoin is a protocol, but it runs on hardware and software nodes all around the world. The hardware is being upgraded every few months. The software is being upgraded annually. And so the software and hardware that runs the Bitcoin protocol is going to get upgraded just like your Apple and Android and Microsoft software will get upgraded.
I was going to say Tim Cook's sending you a check in the mail, but I guess now Microsoft and Alphabet have got to send you a check too, because you mentioned all of those. Let's talk a little bit about the bigger market because of the AI advances that you're talking about. You know, you're very familiar with the dot-com bubble, right? Because you founded MicroStrategy in '89, you went public in '98. I was looking at the history of the stock chart here. You went public at $12 a share. The stock at that time spiked as high as $313 in 2000. And then crashed down or remained below 20 until you initiated your Bitcoin buying strategy. I'm curious, you know, as you look back at that crash, what that taught you and whether you see any parallels today. Obviously, you're aware of the big bubble debate going on right now.
I think it teaches you to focus. Don't overextend. You might have 10 good ideas, but you're better to focus upon your one idea and to commercialize the one idea. It also just reminds you that no matter where you are as a corporation, you can always improve the company's outlook, and you can improve and create shareholder value by harnessing the next wave. People wrote off Apple for dead. I mean, Michael Dell famously told Apple to shut down and give the money back to the shareholders back around '97. And then Steve Jobs returned and he harnessed the internet, and then he harnessed MP3 files and digital music in order to revive Apple, and then eventually created a crazy thing called the iPhone, and it became the most valuable company in the world. I think history is replete with examples, you know, whether it's the internet or whether it's AI chips, people wrote off GPUs as being irrelevant, and all of a sudden we have the ChatGPT moment. The Bitcoin miners were struggling, and then AI explodes, and now everybody wants their energy. I think that digital intelligence, digital assets, digital capital are creating the most compelling opportunities for corporations in the world today. I think the important thing is to use them the right way. For example, we used AI in order to design those 5 digital credit instruments. So people ask, how do you make $1 billion with AI? Well, we created $8 billion with AI just by designing new types of securities. Yesterday, STRC traded $175 million. It's the most successful preferred stock in the century, maybe ever in the history of the capital markets. It was designed completely with AI. It's 100 times better than a good preferred stock. I would encourage anybody with any corporation to think about how you turbocharge your company by using digital assets, digital currency, digital capital, or digital intelligence. There isn't a company that you can't improve using technology in the year 2025.
Michael, later on in the program, I'm going to be sitting down with Eric Trump and Asher Ganut. They're, of course, working American Bitcoin and Hut 8 mining those operations for American Bitcoin. And I know they're very focused on power generation. As you look at your long-term outlook for Bitcoin, other cryptocurrencies, how concerned are you that this country can't produce the power it needs to meet the demands of cryptocurrency?
You know, I think the company got a wake-up call. Back in 2020 and 2021, I talked to a lot of power companies and energy companies, and they were about to decommission all their nuclear reactors. We were staring at all the nuclear reactors getting decommissioned, and there was a movement to shut down nuclear energy in this country. And of course, in Germany, they shut them all down. From early 70s, 73, all the way till 2023, the nuclear industry was persona non grata, and it was politically incorrect. And I think the explosion of AI, and when people started using these AIs and realized they're actually quite useful and they're transformational, it created a reconsideration and a political shift in the United States. The Overton window shifted. And as soon as Google and Microsoft and Apple and Amazon realized they needed energy, nuclear became cool again. And we flipped from 50 years of not wanting to build power, whether it's nuclear or natural gas was out of favor too. People wanted to shut down natural gas. All of that changed in the past 2 years. And now the political sentiment in this country is we should develop natural gas, we should develop nuclear power. And of course, we're only about 1 to 2 years into that sentiment shift. But I have confidence that the United States is going to move from a laggard to a leader in the energy generation business, because now we see we need the energy to drive our cars, we need the energy to power up our robots, we need the energy to think 1 billion times faster, 1 billion times quicker, and we need the energy to defend our digital assets like the Bitcoin network. And the only thing that was lacking was the political will, and I think that has flipped 180 degrees. There's bipartisan consensus. There's not even a debate right now about whether we should generate more energy or build more power plants. 4 years ago, you couldn't have done it. And so I think we've been saved by the explosion of digital intelligence and digital assets in this country. It'll be good for the nation. It'll be good for the world.
Michael, obviously, you're a serious guy, right? We've talked a number of times. You think very deeply about all these issues. But then sometimes I look at your X account and I see you posting or reposting these various sort of digitally generated images, AI generated images of yourself. They're a lot of fun, right? Of you, we're showing one of you in a top hat, various Bitcoin paraphernalia, superheroes, et cetera. Like, you know, I'm just curious how you think about that. Is that, you know, is your Bitcoin, you know, advocacy, is there an element of shtick to it as well? Are you having a little fun with it? How do you think about all of that?
You know, when I was growing up, there were 3 channels on television, and they turned off the television, the signal at like 11 o'clock at night or midnight, and for 8 hours there was no programming. There was no internet. We didn't have, today, we have infinite free music, infinite free television, infinite streaming video, infinite free YouTube. You can get lost, fall in a TikTok hole, an Instagram hole. You can get on Stream and Twitch. We have managed to manufacture infinite everything. It used to be you had to have money to get a newspaper or a magazine. And now, you can see we live in a world where we have, to say 1 million times more content would be probably an understatement. So the entire society is being inundated with information, and their attention span has shrunk. And so people just don't have an hour to listen to what you have to say. Sometimes they don't have a minute. Oftentimes I think, should I say it in a podcast? Well, maybe someone will listen to it. Can I say it in 5 minutes? That might be too long. Can I say it in 30 seconds? Sometimes I'll write a paragraph and you think, no, I don't have a paragraph. People will read the first sentence, and then I write the sentence and I think people aren't going to read to the end of the sentence. And so the thing you learn from social media is you need to get to the point. So how about tell me what you want to say in 1 second? And the cliche is a picture is worth 1,000 words. And so sometimes I don't give you 1,000 words because you would lose 99.9% of the audience. In fact, I would say you'd probably lose 99.99% of the audience if it took 1,000 words. Show me the picture, and that will go viral. And you're doing people a service to give them an idea that travels a million times faster, that is a million times easier to digest, because people just don't have time. They're busy. They're being inundated. And when you see those images, that is us communicating something cheerful, constructive, useful, perhaps profitable to someone. But like if someone says, hey, I wrote a book on this, here's the book, do you want to read it? I mean, how many books can you read? Literally every book written in the history of the human race is available for free to you right now. Do you really want someone with a good idea to give you 250 pages and tell you to read it? Or do you just want them to boil it down to one sentence, one tagline, or one picture? Because I'm like, show me the picture. Okay, got it. Now I can move on with my life. Thank you.
You're making a lot of sense to me, Michael. Stay with us for a second. Let's bring in our social correspondent for the day, Yahoo Finance's Ali Canal, with some of what she's hearing from our online audience during this interview. Ali.
Yeah, well, Brian, Michael Saylor just talking about infinite content on social media, which is the perfect segue since we are talking and taking your questions on social media. Plenty of viewers chiming in, and starting off with a strong one here, Michael. First question, do you see Bitcoin catching up to and surpassing gold's market cap by 2035? What say you?
I do. I think we're in a Bitcoin. We're in the digital gold rush, and 2035 is the 0.99 year. That means that 99% of all the Bitcoin will have been mined in the year 2035. If you want Bitcoin, you need to get it between now and then, because the last 1% of Bitcoin comes out over 100 years. There's no doubt in my mind Bitcoin will be a larger asset class than gold by the year 2035.
And another social viewer wants to know, why should an investor buy strategy stock instead of a Bitcoin or spot ETF?
Yeah, if you don't want to take any counterparty risk, and if you have a long time horizon, then you should probably buy the Bitcoin because you can take custody and take it anywhere in the world. If you simply want the asset, you want it in a brokerage account, you should buy the ETF like IBIT. It's going to take you 10 seconds to do that. It's easy to borrow against it. If you're a believer and you want amplified exposure to digital capital, and also if you believe in digital credit, like our mission at Strategy is we want to give 1 billion people a bank account that pays them 10% tax deferred. If you think that's a cool idea to give someone in Japan or Europe or Switzerland or New York City a bank account that pays them 10% with no volatility, and if you think that Bitcoin can power that, then you're buying our stock because we're a digital credit factory. And if you want to outperform Bitcoin and you're ready to get on the roller coaster, you should buy the equity. But if your time horizon is less than 4 years, if you need the money back in 4 weeks or 4 months, then you probably want something principal protected. You want low volatility. You should buy a credit instrument. Like STRC is literally designed to get the vol, down. Right now it's 7, whereas Bitcoin's vol is 45 and Strategy's vol is 65. And if you want something that's going to be extremely low vol, you should buy a credit instrument like a treasury credit product like STRC. You'll outperform your money market. You might very well do as good as the S&P index, but you'll be able to buy it and sell it and get your capital back, in a month, in a quarter in a year, and you don't have to, worry about the roller coaster.
All right, well, thank you so much, Ali. Michael Saylor, thank you for joining us at Invest. It's always a treat to spend some time with you. Thank you for doing this. And a big thanks to Yahoo Finance's Julie Hyman. Let's send it on over now to our Yahoo Finance team on a check for the markets. Josh Lipton, take it away.
Thank you, Brian. We've got full market coverage over here. I'm here with Kenny Polcari. Brooke DePalma is live at the NASDAQ, Inez Ferre at the Stock Exchange, and Ramzan Karmali is live from our London studios. Kenny, I will start with you. Let's start here. Government shutdown. It's over. It's a big piece of uncertainty is removed. How are you thinking through that as an investor?
So I don't listen. The whole government shutdown story, actually, if you go back and look at it, didn't create a lot of drama. The S&P was 2% higher as of last night than it was when the shutdown started on October 1st. The NASDAQ was 3% higher. So when you really look at it, the shutdown created a lot of headline drama and chaos. But for investors, it really wasn't the focus. So now that it's shut down, okay, it's great. Everyone's back to work. It's fine. We can start to focus once again on the macro and the economic data that's really going to define where the economy's going.
But on that point, my friend, the data. Now, you didn't have all the data you wanted. I'm curious how much of a challenge that was. And I ask you because some people said, hey, it's a challenge. I did have other investors on my show, though. They'd come on, they say, it's a challenge. But I had if I wanted to read on the economy, I went to bank earnings. If I wanted to read on how Kenny and Josh were doing, consumers, I had credit card data. How much of a challenge was it for you?
It wasn't that much of a challenge. I think the biggest challenge is the labor challenge. That's the one that everyone's really looking at because there's concern that the labor market is weakening, right? Mm-hmm. And so that, I think, is going to be the biggest challenge. The rest of the data, you're right. You can get it in other places. People were mostly not that concerned about it. You didn't see it coming through in other parts of the market. The earnings season was really great. The guidance was very robust going forward. So in my mind, I wasn't focused every day on, oh my God, the government shutdown. What am I going to do? I wasn't that at all. We have our portfolios. I have my investment. We watch them. We're on top of it. It was fine.
Let me talk to you about that AI theme, because Cisco reported after the bell yesterday. This morning, that stock was whipping.
Right.
Demand for its AI products front and center. AI boom, AI bubble. Where's Kenny's head on this?
Listen, we're not in a bubble. We're very much in a boom. And you saw AMD yesterday. Their CEO come out. The spending is crazy in that sector. So while I think valuations are stretched, I don't think we're in a bubble. Like, I don't think there's going to be this massive pop and suddenly everything's going down 50%. I don't think that's going to happen. But I do think, and we saw it over the last couple of trading sessions, that the concern over valuations, we see some are stretched, there'll be some correction, but that's actually good. Shake the branch a little bit, see who falls out, and then we can move from there. But I'm in the camp that we're very much in the very early stages of this story. We're still in the batting cage. We're not even on the first inning yet, as far as I'm concerned. And so I'm really bullish on the theme, but I'm cautious. I'm not chasing tech. I think there's other places to allocate money, but on a pullback, certainly tech is a place you want to be.
All right, thank you, Kenny. Appreciate it. Now let's get to the NASDAQ with Brooke DePalma. You're looking at some earnings today, Brooke.
Good morning, Josh. That's right. I'm looking at Disney specifically because pre-market, we are seeing that stock move lower. It's down nearly 6% in pre-market trading this morning after Disney. Now the call is currently underway. And what we heard from the company was ongoing declines in that linear TV business, but that was offset by some strength in the parks. And so adjusted earnings per share beat, but revenue slightly missed. And that was due to a 6% decline in revenue drop within the entertainment business. That includes streaming TV, theatrical services. And also, too, if you take a look, this company really trying to key into the consumer and taking a step back. We are seeing all three major indices in the pre-market hours here roughly flat, especially after that 43-day shutdown has now moved aside. We now do know that we are moving forward. President Trump saying the federal government will now resume normal operations and get our country working again. But sticking with the consumer theme, we are hearing from trade associations like the National Retail Federation. They said that getting consumers back in spending, getting those furloughed workers their back pay, getting them back in here, that will really restore consumer confidence and spur economic growth. Right now, all three major indices roughly flat. And once again, Disney seeing a decline in pre-market hours.
All right, thank you, Brooke. Inez, what are you watching at the NYSE?
I'm watching crypto this morning, Josh, specifically Bitcoin hovering above 102,000 per token. We've seen some choppiness with crypto and with Bitcoin, but look, the government reopening, strategists are saying that should give a boost to liquidity and hence a boost to Bitcoin and crypto in general. I did speak to one strategist, though, that says that he's watching to whether or not the Fed will be cutting rates in December, because if they do cut rates, and that would be a catalyst to take crypto higher. Also, I'm watching Circle right now in pre-market, a little bit of a rebound there, up 1% after falling 12% yesterday over fears of falling rates and increased competition in the stablecoin industry. But the company did report a good quarter. Bernstein coming out with a note this morning reiterating their buy rating on the stock, pointing out that the company has gained market share and it is still a major player in the stablecoin adoption story. And then I'm watching gold jumping today, hovering above 4,225 per ounce. That's around a 3-week high. Remember that gold, it too had sold off in October, but it has rallied in recent rallies. Over the last 5 days, gold is up about 6%. Gold futures up more than 60% year to date, Josh.
All right, thank you, Inez. And finally, Ramzan, what's going on across the Atlantic there, my friend? Fill us in.
Well, let's start with Asia, because they had less time to sort of react to the news that the longest ever US government shutdown in history was over. Asian markets, broadly speaking, a really positive sentiment prevailed in Asia. Because of the fact that the longest ever shutdown in government history is over. But there's also other news. The Chinese government plans to unveil a comprehensive strategy to boost new energy battery industry and enhance related infrastructure. And unsurprisingly, some of the new energy stocks really were a lot higher today as well. I want to point out on the AI theme, SoftBank. Remember, they've made a massive bet on OpenAI, and they sold their entire stake of Nvidia. Well, their share price again lower, over 3% lower as well. And if I turn over to Europe now as well, initially stocks were actually higher because at the start of the day, but then they started getting a bit more information about the shutdown and the fact that perhaps, we might not get that data, the consumer inflation data and that jobs data in October. So that's kind of like darkened the mood slightly. So initially they were tracking global counterparts, but they've stopped doing that now. But when it, one thing I really want to point out is the FTSE 100. It is lower quite significantly, and that's because we had some pretty poor GDP data this morning out of the UK. The economy surprisingly contracted in September. It had been growing actually the previous 3 months, but that sharp drop, it fell by 0.1%, and that's had an impact on the FTSE. One share I'd like to point out though, and luxury brands, they've not had the best of times, but Burberry shares, they're flying this morning because they reported comparable store sales growth for the first time in 2 years. Well, they actually grew. So some good news for the luxury sector there, but a little bit more muted in Europe right now.
All right, Ramzan, thank you, sir. Appreciate it. Now let's send it over to Ali Canal, who is standing by at our social center. Ali, what do you have on tap for us today?
Well, Josh, we were just throwing some social questions to strategy CEO Michael Saylor, but social media is a big part of our everyday lives, and it's going to continue to be a big part of Invest. Throughout today, we will be asking your social media questions to high-profile names like Robinhood CEO Vlad Tenev, tech bull Dan Ives. He's going to have interesting things to say about Tesla, Nvidia, hedge fund manager Eric Jackson. He's been all in on Open Doors, so keep sending us your questions. We are streaming live globally across X, TikTok, YouTube, Facebook, and if you miss a moment, you want to rewatch a certain interview, you can find us wherever you get your Yahoo Finance content. We will be here all day long, but for now, sending it back to our executive editor, Brian Sazi.
Ali, crush it. Love those questions the community had from Michael Saylor. All right, today is not just a big day for Yahoo Finance, it's an essential day for you, the investor. In addition to market-moving insights from some of Wall Street's biggest names, we have some game-changing things happening at Yahoo Finance, all geared to help investors build their wealth. First, we're excited to announce an all-new prediction markets hub on Yahoo Finance, powered by Polymarket. In the coming months, investors on Yahoo Finance will get context around shifting public sentiment and expectations. This hub will combine trusted data with in-depth analysis, helping investors make smarter, more strategic prediction market investments. Psyched for that one. Prediction Markets Hub will display probability data from Polymarket for key economic, government, and market outcomes. It's your daily check-in for valuable new insight. Also, we are now a redistributor of SIBO market data. This allows other leading brands to access this valuable market data through Yahoo Finance's platform. That includes Samsung, which we recently announced a partnership with. And let's not forget about crypto. Bitcoin and other coins have been on a roller coaster ride this year. Instead of facing ongoing questions about risk, the sector has been embraced by Wall Street and regulators alike. Yahoo Finance is excited to announce our new crypto hub, your new destination for comprehensive crypto coverage coming soon. We're joining forces with top content partners like Bankless, CoinMarketCap, Decrypt, Real Vision, The Block, and more to create a destination that will not only share the latest market-moving news on crypto, but real-time data to help you make informed decisions. We'll also be bringing in NFT data to the hub as part of a partnership with CryptoSlam. The unbeatable insights to feed all your wealth-building ambitions start on Yahoo Finance. All right, we're just getting started here, Invest, just getting warmed up. Up next, we take a deeper dive on two of the most popular stocks on the Yahoo Finance platform. You guessed it, Tesla and NVIDIA. And one of the biggest tech bulls on the street, Wedbush's Dan Ives, is here to weigh in. Plus, we have a jam-packed lineup of top names in AI, investing and more, including Palantir's Alex Karp, Starboard Value's Jeff Smith, and former Fed Vice Chair Lael Brainard.
Welcome back to Yahoo Finance Invest. I want to hone in on two of the hottest stocks on the Yahoo Finance platform right now. That's NVIDIA and Tesla. And joining us now is resident bull on both names, Wedbush analyst Dan Ives. And Dan, you were supposed to be with me here in studio, but I heard even though the government shutdown is over, you might have had a little plane trouble and you're stuck in Miami down there?
Yeah, stuck in Miami. Actually, it's my second time in Miami in this week. I thought I'd be lucky to get back, but it looks like it's going to have to wait a day.
You're a busy man. We know this. I'm sure it has nothing to do with how cold it is here in New York City, but I have a lot of viewer questions for you. Before I get to that, I do want to ask you your 30-second bull pitch for Tesla and your 30-second bull pitch for NVIDIA, because I know you're very, bullish on both of those names.
Yeah, look, on Tesla, this, in my opinion, is the most important chapter ever for Musk and Tesla, the AI chapter, autonomous and robotics. I think we're talking 2-3 trillion in terms of market cap, best physical AI play besides NVIDIA. When it comes to NVIDIA, the godfather of AI, there's only one of them, and that's Jensen. Look, demand to supply is 10 to 1 for NVIDIA chips. Get the popcorn out, get the watch parties out for next week's earnings, because this is, in my opinion, is going to be a $6 trillion market cap in 2026. And again, the bears will continue to yell from hibernation caves. They'll be wrong.
All right, they'll be wrong. You heard it here first. But let's get to some of our social questions. And I want to start with Tesla. One social viewer asks, Tesla seems to be a show me story with investors all in on robo-taxis and automation, but that seems years away. How much patience does it take to be a Tesla shareholder?
It takes a lot of patience. And we've talked about it so much, on Yahoo and on the show, because this is when you have to have the understanding of what Musk and Tesla are trying to do here. They're building out the AI future. Autonomous, they're going to own 80% of the autonomous landscape, in my opinion, over the next decade. Robotics, Optimus, that's what you're playing for. It's less about deliveries. It's more about the AI future. You have to be patient, but it goes back to this, in my opinion, is going to be the most important chapter ever in Tesla's story.
All right, another question from our audience here, Dan. You've compared the AI boom to a party before, and that we're still early on in the night. Do you have any new analogies for where we are in the AI trade right now?
Yeah, so look, it was 9 p.m. in that AI party. It's now 10:30 p.m. But that party goes to 4 a.m. And it's my view where, look, you're going to have glass on the dance floor, DJ stops playing music, but that party's going to continue to rage on. The Bulls and the Bears meet up at 6 a.m. at the diner. Bulls had a lot better night than the Bears.
But Dan, my mother always told me nothing good happens after midnight. So how do you know when to leave the party?
Look, and that speaks to my view. It's all, when it comes to AI, it's all about demand, right? 3 million air miles the last 25 years. I'm always on the road trying to understand what demand looks like. I was in Asia for a month. Demand's accelerated 30% over the last 4 or 5 months. So look, I get some on the valuation, but when those call an AI bubble, they're underestimating the scale and scope of this AI revolution. And for the first time in 30 years, the U.S. is ahead of China.
All right, I'll tell my mom for the AI party you have to stay all night long. But I do want to take some time to talk about your outfits, Dan. This is something that you are known for. I want you to show the camera what you're rocking today. A lot of patterns, a lot of personality. What's the inspiration behind your style?
Yeah, look, I'll show you wearing today, right? This is...
Love it.
This is my man. But to some extent, I always have dressed in a way that it's similar to how my stock picking is. It's different, right? But ultimately, it's what I'm comfortable with, and I also, it brings color and fun to an industry where, that maybe historically hasn't been there. And I think that's also why, my clothing line, DanIvesClothing.com, we've sold 400 or 500 shirts out there, and, it's an exciting time. More want to get into the color and just have fun with this.
So would you say your outfit picking is similar to your stock picking?
I would say. I think to some extent, it's like I don't care what others think. I go to the beat of my own drum, and the reality is that it's something where I've always dressed different. That was in Korea a few weeks ago. And look, I think it's one where it also gives inspiration to others, where it's like going out of the box, but it's similar to how I pick my stocks, right? If you just looked at valuation, I always say the bears, when they're in hibernation mode, they can't see AI in the spreadsheets.
Now, I was doing some digging and I saw you have a collaboration with this fashion brand, Snow Milk. And the shirts ain't cheap here, Dan. You have $100 for a polo. These shirts are trading like some of these AI stocks. Is the valuation justified here?
Look, those are made in the USA, made in Williamsburg, Brooklyn, right? And it's one where, look, and this is something where all those shirts are handmade, right? And we'll eventually have sweatshirts and hats, and I could see Sazi wearing one of those sweatshirts soon. But look, this is it's having fun with it, right? And I think also it speaks to my view in that party at 10:30 p.m. You don't want to be wearing the Peter Millar and slacks in that party on the dance floor.
All right, well, I'll be patiently waiting for you to send me my own shirt here, Dan. But thank you so much. You will be back throughout the day today. But for now, sending it back to our executive editor, Brian Zazi.
That's some conversation there, Ali. I really need to redo my wardrobe for sure. Retail investors have been out in force this year, driving a lot of the upper momentum in markets and costing short sellers billions of dollars. One platform that has become a beneficiary of retail investor dominance is eToro, the sponsor of Yahoo Finance Invest. The company saw its assets under administration grow 76% from a year ago to $20.8 billion in its third quarter. It has more than 40 million registered users across 75 countries and debuted on the NASDAQ in May of this year. Let's get right into the future of the retail investor with Yoni Assia, eToro co-founder and CEO. Yoni, I think I just saw you at the IPO down at the NASDAQ.
Yeah, we had a great interview, and it led to eventually us sponsoring this great event.
Well, thank you so much for your support. We have to redo our outfits. Did you see that last segment? That was wild.
Yeah, we need better clothes.
So since we last spoke, look, the Dow is now at a record. Like, what are you seeing in the retail investor community at this point?
I think, we are just at the beginning of, again, the largest transformation of wealth in history, where our generation, Gen Y, and even younger generations, Gen Z today, have discovered that their fiat money devalues over time. Probably, with the widest knowledge of an understanding of inflation, which means that your money in the bank loses its value over time, and you need to invest that money somewhere. And I think people across the globe, here obviously, 60% of households are exposed to the stock market, but in Europe it's 10%. People understand now and are discovering you can generate double-digit returns investing in the stock markets. They're finding out about crypto. 400 million people now are investing in digital currencies across the globe. And I think this new generation talking about their investing on social networks, on eToro, looking at other people's portfolios, which is a unique part of eToro, where you actually see millions of accounts and you see their performance over time from different countries, investing in different stock markets, not only the US stock markets, but global stock markets from Asia to Europe, realizing that if you learn how to invest in the markets and you learn how to compound wealth over time, you'll significantly improve your financials if you start doing that when you're younger.
When you are one of the most passionate founders or co-founders in this game, I've always loved listening to you talk, love the story behind eToro, but for those not familiar with your personal story, when did you found the company? What has driven you to take it to this point? Where did you come from?
So born and raised in Israel, but I started trading when I was 13. And my father was actually CEO and founder of also a NASDAQ-listed company. And we've always been passionate about capital markets. We found the company 18 years ago together with my older brother. And we looked at the world of investing and we said, we need to simplify this world. We need to make it simpler to open the markets for everyone to trade and invest in a simple and transparent way. That was our statement from day one, 18 years ago, until today, until the IPO. And we're very excited to see now millions of people, tens of millions of people that we've helped access the global markets. And across the globe, we realized it's really about helping people get more familiar with the markets, trust more capital markets, educate themselves. And we did that by building a social network where people can actually see other people, how they invest. Everybody automatically shares by default their portfolios on eToro. So somebody joining eToro from France or Italy or Spain or here in the US can see like-minded individuals and how they're generating performance over time. And then the unique part of eToro is our technology that enables you to automatically copy the top investors on the platform. Because what I've learned across the 30 years in capital markets is investing is simple. You can just buy an S&P 500 ETF.
And go to sleep.
And everybody should learn how to invest in the markets. Trading, on the other hand, it's like professional sports. That you need to invest a lot of time and a lot of effort to become a good trader over time, to beat the indexes over time. And by opening this up, opening a community of very smart investors and traders that can learn from one another, we're actually helping people become better at that professional of trading, at that profession of trading.
Where do retail investors go from here in 2026? What's the next big thing?
Well, I think it's definitely AI. Right? We were very early on to crypto. We started buying Bitcoin at $5. Vitalik was in eToro's offices, inspired by our colored coins about tokenization of assets before starting Ethereum. So I think there's now sort of two parallel tracks that have a lot of connection between them, which is tokenization and all assets becoming digital, and retail investors and generally the world of investing becoming significantly more powerful through AI, through intelligent investing. So when I started trading, I was always around, so how do I build software? How do I create algorithms to trade the markets? But it's very hard, it was very hard to create quantitative strategies, to be 24/7, to build the software that can monitor the markets 24/7, what's happening in the markets and manage your portfolio. And now what we're seeing in eToro, we just launched our app store and an AI studio for our investors where they can actually vibe code, so you can just write in natural language. Wow. Basically, and we saw some of these apps that our pro investors started developing, and they're like, build me the Warren Buffett and Benjamin Graham, like the fathers of value investing. I want their personas, read everything about them on the internet, and I want Benjamin Graham and Warren Buffett to comment on my portfolio, and I want to talk to them about my portfolio. And then I want to rebalance my portfolio based on their insights. And you can use it, the best investors in the world, because again, AI knows the best investors in the world. It read all of their books and all of their information, all of their memos, and you can suddenly have in your hand of a retail investor technology and power that was available only like to the top quantitative, most sophisticated hedge funds here in New York. Suddenly a retail investor has access to all of that information, data through eToro. So in eToro, when we provide our Tori, our AI analyst, it has access to see your portfolio. So you can ask what happened yesterday in the markets and how does it impact my portfolio? What are other people doing in their portfolios today, right? So it has access to all of that information and super powerful. Now, if you connect AI now to digital assets, which means all assets eventually become digital, smart, 24/7, tradable, right? So capital markets are now copying crypto markets, sure, moving to 24/5, and the ability to become smart contracts, right? So AI can then interact with those digital assets. I think those two trends are going to shape and completely change financial markets for retail investors over the next 10 years.
Lastly, before you go, you just mentioned Warren Buffett. And if I'm right, you had a dinner at Warren Buffett a while back. Warren Buffett's getting ready to, I guess, go quietly, as he just said as an investor later. In our time, do you think there will be another Warren Buffett?
I think we're seeing on the eToro platform a lot of potential Warren Buffetts. So we've just had our annual investor summit. We met a lot of our top investors from across the globe. One of our top investors went from $50 million copying him to $250 million copying him just over this year. And he's consistently beat over the last 5 years the S&P 500, generating an average of, I think, 29% returns over the last 5 years. The second one with $162 million has generated about, I think, 31% returns in a tenure of 12 years on eToro. So I think you have a lot of great minds out there that are consistently generating returns in the markets. And again, in his letter, he said, find your heroes and copy them. So that's what we're trying to do in eToro, let you find the heroes and copy them. And there's no doubt that Warren Buffett is a hero of capital markets and educating people about capital markets.
Well said. Yoni Assia, eToro co-founder and CEO. Above all else, thank you for the support of Invest. I've always enjoyed following your story. I enjoy following your company, and I greatly appreciate it.
Thank you very much.
Thank you much. All right, up next here at Invest, a deeper dive into the intersection of sports, investing, and media. The owner of several teams in our nation's capital, Ted Leonsis, joins me to give you insight into how some of the biggest trends like sports betting and prediction markets are sending shockwaves through the industry. Plus, one of the key investing themes this year, the continued rise of the retail trader. They've driven wild moves this year, including at FinTech Open Door. That movement was led by investor Eric Jackson, who will join us to explain the power of the retail army and what it means for the market. Welcome back to Yahoo Finance Invest. The business of sports has never been better. Women's teams are exploding in popularity, and sports betting is changing the industry forever. That, alongside sports teams fetching ever higher valuations for private investors. I want to know what the next big thing is that can shake up sports, and for that, I will be speaking to Ted Leonsis, a tech media industry veteran who has built a sports empire in Washington, D.C. His monumental sports and entertainment includes the NHL's Washington Capitals, NBA's Washington Wizards, and the WNBA's Washington Mystics, plus the Capital One Arena and Monumental Sports Network. Ted's a busy guy. The whole company is reportedly valued at over $7.8 billion. Ted joins me right now at Invest. Ted, so great to see you. Thank you for doing this again. Talk to us a little bit about the strategy behind Monumental and where you are at in that strategy.
Well, it's so great to be here, and wow, what a lineup of speakers you have, most in the tech business. And essentially, I've always looked at our business as being first AI proof. I think that that's an important thing to mention about sports, that we are embracing all of the technologies, but that you won't be able to replace the feeling of going to a game with simulations and AI. There's something about convening, and we bring 3 million people, 3 million fans into our arena every year to watch the Caps and the Wizards and Georgetown basketball and the WNBA Washington Mystics. Basically, I think we're building a SaaS-like business. Basically, we bring in a big audience. We own our IP with the teams, and then we distribute our IP on our own owned and managed networks, the Monumental Sports Network. When you look at the leagues, we are a global and digital first enterprise. We happen to be situated in a very big, important market in Washington, D.C. that goes from Richmond, Virginia, all the way to Delaware. It's a 10 million household market. And we think we can build a most important business in Washington, D.C., Greater Washington, by combining the technology the outreach from the media side of our business. And at the end of the day, we're about winning sports teams and uplifting our community. And I think that's why these teams are valued so highly.
Ted, you're literally right in D.C. And of course, we're having to invest the day after it was signed that the government shutdown, the record-setting government shutdown is over. Have you seen an impact from the shutdown in your business? And I'll follow here if I can. Are you tired of these shutdowns? I mean, as an owner of sports teams, you need people in the seats. You need them feeling confident about their finances. I mean, enough is enough already here, no?
Well, we're a big part of the community, and we reached out to many of the government workers and said, come to a game on us. Here's some certificates to be able to dine. We gave $100,000 last week to one of the local food banks. We have empathy and for the community. But yes, I am very, very happy that the political grind on both sides here ended. You know, as we've said and we've reached out to each White House as it comes in, we're not red or blue, we're red, white, and blue, and we're here in service. We understand the central role that we play as owning an arena, touching 3 million people physically every year, which, as you know, we were tabbed to help host the inaugural. This year, the weather was bad outside, and so the president asked if we would host a lot of the inaugural events, and we play a central role. Sports teams, our media, very, very important, but we'll never lose sight of it's our fans and it's our families within the community. And, you know, we employ 5,000 full-time, part-time people in this community, and so you know, we feel it every single day. And so, yes, I'm relieved that this has passed us. I know that it's only been funded till the end of January. I'm hoping that cooler heads prevail on both sides and that we get back to a more normalized business cadence. Certainly, that's why the leagues and teams are so valued, right? You know the puck is going to drop at 7:07. You know how many games, you know what the schedule is. There's a feeling, if you will, of continuity, of longevity with the teams, and that you know that there's rules, and we follow those rules, and the fans rely on us to provide them that kind of semblance of normalcy every day.
Ted, this shutdown debacle, is this the opportunity where you say to your team over a drink, over dinner, whatever the case may be, hey, look, I want to buy another team, but maybe we just do it outside of D.C.?
No, I'll never go outside of Washington, D.C. I don't think that's a good strategy for us, certainly. What we need is scale. Media companies, technology companies, the ones that build great value, have scale, and they get some leverage in their business. And we're able to do that by being in our market. The way the league rules are written, you know, we're the only basketball team, we're the only hockey team, we're the only women's team in this community. There's 2 baseball teams with the Baltimore Orioles and the Washington Nationals. And, you know, being able to provide year-round programming on one network, being able to leverage your ad-serving technology, being able to focus the organization to get scale and to be able to repurpose the dollars in the right way for these payrolls for each of the teams, I think is going to become very, very important. How are we going to compete in DC with LA and with New York? Those 2 teams, those 2 markets are 10% of the overall market. And so we want to fight above our weight class. And I think having that concentration in one media market, that's certainly enough for me. It's certainly enough for our fans. And we want to be able to build Washington, D.C. as a world-class district of champions. Our mayor is very, very committed to that. We're spending over $1 billion, it looks like now, on uplifting our new arena. The city is our partner in that endeavor. These are very, very big bets now that you have to make. Not unlike what you're seeing in AI. You need to get scale. You need to be able to work with the government. You need to be able to work with the utilities. We're very, very focused on how our city, through traffic mitigation, through public transportation, how we can all work through that. And the city wants our arena to be the new front door for downtown DC. We have to find ways to bring the 30 million tourists that come annually to Washington, D.C. We're all focused on, in July of this year, it's our 250th birthday, how will we be able to mash up and integrate and bring tourists into downtown? How will we be able to showcase Washington, D.C. as a great city around the world? So, I understand the social responsibility that we have in owning and leading these sports teams. And I also understand how important a role we play for the leagues. The NBA is a $100 billion plus enterprise right now. I'd say the NBA, the NFL are the most valuable sports brands around the world. Our commissioners are like CEOs, if you will, of $100 billion enterprises. So these have become very, very important assets, very important businesses. But at the end of the day, the fans only care about, are you winning? Are you competitive? Can you win a championship? Can you bring the city closer together through winning sports teams?
Ted, since we last spoke, there's been several sports gambling incidents, NBA, MLB, players betting on sports. As an owner of several teams, how concerned are you that the integrity of these leagues has been compromised? And then what have you told your tems?
Well, certainly we've been front and center in the movement of regulating sports. All of this happened in Washington, D.C. with PASPA. Governor Christie was really a central mover on that, and the Supreme Court ruled that you could have legal gaming and gambling. A lot of new tech companies emerged. Some of those we were investors in, like a DraftKings, like Sport Radar. And the overall feeling there was that there was $100 billion of illegal gambling being done. And if you could bring that gaming into the sunshine and you could regulate it and you could tax it and you could take care of people who were having issues with, if they had a gambling addiction, that it would make this look and feel kind of like Wall Street, right? Where you have an SEC and everything is regulated and the technology really is a way to be able to find when there's flaws in the system. That's what I think just happened. I think that the leagues were able to self-report and able to look at anomalies in gaming and gambling, and that the system worked. Now, unfortunately, because it's such in the spotlight, what happened a couple of weeks ago, it shook us all to the core, because fans need to trust that they are seeing real-time competition and that the outcomes are fair. The outcomes are based on the talents of the franchise and the players and the coaches, and that everything is on the up and up. And so I think the way our commissioner and the league responded in the NBA was totally appropriate. But I want to remind everybody, it was our technology that was able to find it, and that sports gaming is really moving into the class like Wall Street is, where you can find something that's happening that is untoward. Another part there with the gaming issues in the NBA had nothing really to do with us, and that was the poker games that were being played. Unfortunately, a couple of our former players and a coach had some kind of involvement there, but it had nothing to do with the actual game itself. So we take this very, very seriously. But this march towards AI, this march towards much stronger analytics, I think has proven to be a great prophylactic in the future. And certainly the players have to be warned that this is unacceptable. and you'll get banned for a lifetime. One of our players who got caught a year ago, he's banned for life. And the dollars that are getting paid to the players is so dramatic. I think that should be a fair warning to everyone to play within the rules.
Ted, as an owner, do you have to put in new protocols for players? Like, is there a way to spot this before, at the start of it potentially even happening?
Yes, we do that. Every season before the season starts, we have training. We explain to the players there's signage everywhere. And it's not just for the players, it's for everyone in the organization, especially about insider information, not unlike what every company has to do that's going public or about to IPO. You have to treat that information and knowledge as sacrosanct to the integrity of the game. And we cannot ever lose trust. If you lose trust, the fans can't love you. And so when a thing like this happens, and it happens every day, basically on Wall Street, right? It's just not publicized in this way. And I think over time, that's how it'll be in sports, that, you get caught, bang, you're out. And, the players, I think, will really, really understand. Now, the leagues are smart. And, I think what baseball just did with the prop betting around pitching and changing it and going to the partners and saying, we don't want this kind of prop betting to be acceptable anymore. We'll iterate all of the time. We're in partnership. These gaming companies have become one of the largest advertisers in the media landscape, and they're working with the NFL and the NBA and the major media networks. They're working with the RSNs. And so we're in it together, and no one wants to do anything that strikes at the integrity of the game, because viewership would go down. Fans would stop coming to games. And so we're all in this together to uplift and have the best competition, the best state of play, and to find ways through technology for the fans to have these rooting interests. Certainly the level of engagement and viewership is increasing, and a big part of that is because fans, especially younger fans, can use technology and some of these gaming technologies through fantasy gaming and through legal sports betting to enhance their fandom.
Ted, lastly, I didn't get to ask you this last time we talked on my podcast, but I figured since I have you now, why not? Given the valuations we've seen, the Lakers fetching about a $10 billion valuations up across the board for sports teams. Is your end game an IPO, and an IPO within the next 24 months?
It's not an end game, but I am operating our company, and I think some other, if you will, central companies like us, as if we're a pre-IPO company. We have to make sure that once you bring in big investors, be it a sovereign wealth fund, be it a private equity fund, that you're going to have some kind of preparation to get people liquidity, get investors liquidity. And we're an interesting industry in that we would have strong retail following, fans of the team itself, and you would also have strong institutional coverage because we're like a SaaS business. 75% of our revenues is repeatable. We look like Salesforce.com or Oracle if you really drill down into our business model, where we have 3%, 4%, 5% escalators every year. We have long-term 10, 15-year contracts with our big partners. And so these are very, very important, strong businesses. But to date, there's very few public companies, and the ones that have gone public are undervalued. And so we have to right size and retrain Wall Street and retrain who's going to cover us, because like the Knicks and the Rangers and MSG are a public company. It's built into 4 separate companies. It's way undervalued. Same with John Malone's Liberty Media. It's confusing, tracking stocks and the like. And I think over time, we'll have some pure play sports tech companies like ours that are understood and valued appropriately. And they'll be valued on their top line growth, on their cash flow, on their EBITDA, but we will look like a Salesforce.com or a Oracle. And when we get those kinds of multiples, yes, I would be interested in taking the company public for the benefit of our partners, our fans, and give everyone the opportunity to share in the value creation that sports and technology are driving.
One of the most passionate owners in the game, Ted Leonsis, thank you for always making time for Yahoo Finance and me. I really appreciate it.
Thank you.
Thank you so
Great
much.
to see you again.
Thank you. All right, Julie Hyman, over to you.
Sports as SaaS. Love that. All right, let's talk about the retail investor. Investing activity has been growing exponentially, with retail investing flows rising by about 50% from 2023 to early 2025. That's according to new research from JP Morgan. From meme stock frenzies to the expanding influence of social trading platforms, retail investors are no longer on the sidelines. They've become a powerful and disruptive catalyst. Joining me now with more on how retail investors are redefining market power, we've got Dan Ives back with us, Wedbush Securities Managing Director and Global Head of Technology Research, known for his bold outfits, as you can see, and big calls. And we got Eric Jackson with me here, EMJ Capital founder, president, and portfolio manager, and leader of his self-proclaimed Open Door Army. He's become a retail expert as well. Guys, thanks so much for being here. And obviously, we've seen a paradigm change from the financial TradFi, as we call it, traditional finance industry, towards retail investors. It's become sort of more accepted. They've been more courted. But Eric, I want to start with you. What do you think that traditional finance still sort of misunderstands about the power of that retail investor?
I think the retail gets a bad rap. I think the perception is they're stupid, dumb money. I mean, that was the name of the movie from GameStop. They think that they're going to lose their shirts. Wall Street thinks they know better. They think to protect the stupidness of retail, they should just pile into ETFs, pay a few bips to Vanguard and in the S&P 500 and not even try to kind of find these outperforming stocks out there. And when they see certain stocks rise and go up 100%, 200% or whatever, they immediately don't trust that, and they sort of talk it down, and they want to lump Open Door as a so-called meme stock, which is sort of trashing the company. It's sort of like a put down on it. So I think there's a lot that Wall Street misses. Retail doesn't miss it, though. That's the point. They are a lot smarter than what they're given credit for.
Well, and it's also interesting because we have seen some executive teams at companies start to try to explicitly court those investors more now. Do you think that's the right move, or do you think we're going to see more of that?
Absolutely. I think Alex Karp, and Dan knows this. I mean, he set the bar. I mean, he really, he was first really out there with video earnings calls. He was taking questions from retail on the earnings calls, treating them as importantly as he was the sell side analyst, and thanking them and kind of acknowledging them, which is really oftentimes all that they want. That sort of recognition and appreciation. And but obviously he had a great company. He is a great master communicator. So you can't separate that as well. I mean, just courting retail is not going to do it. You've got to have that underlying story to go with it.
Dan, I'm curious what you think, right? Do you think that there are still things that are sort of underappreciated and misunderstood about the retail investor? Because what Eric is saying is true, but there has been some progress made, I think, since the sort of meme stock explosion at the beginning of the pandemic, for example.
Yeah, look, I think Eric makes great points, as he always does. And look, the reality is that retail investors used to be at the little kids' table at Thanksgiving, and you give them a little cookie. Now they're at the adult table. They're front and center, because if you look from Palantir to Robinhood to Tesla to so many other examples, I mean, everything Eric's doing on Open. Look, this is a very important investor class that's very informed. I mean, I'd say some of the best conversations that I have on many names are with retail investors. I mean, there are many retail investors that understand Tesla better than institutional investors in terms of the autonomous robotic future. Palantir, right? I mean, you go back to early days, the believers in retail. Institutional, they laugh, when this stock was a teenager, and then they're crying when it turns 100 and screaming from the mountaintops, 200. My view is just it's institutional and retail, but you have to pay attention. Retail is becoming just a force in this market.
Dan, I'm curious if you have an anecdote or if there's a particular retail investor interaction that you've had. I mean, you travel constantly. Is there a particular interaction that maybe stands out to you that is particularly memorable to you in your recent travels?
Look, I would just say that, like, when I'm, traveling around the world, you realize, like, retail investors will ask questions that usually maybe only the most sophisticated institutional investors would have asked 2-3 years ago. And I mean, there were some moments, like, I'm sitting in Thailand and Korea and meeting with retail investors that basically have theses on Palantir and Tesla and Open and many other names those are not mean. We're talking about sophisticated investment thesis that they've built, and their investment clubs around the world, social media. If you look even on Palantir, there's many that have been well ahead, and I think have helped really spread the message.
Let's take a little bit of a step back. Eric, for people who aren't as familiar with you, yes, you sort of have gained some notoriety this year for your advocacy around Open Door. But for people who are not familiar with your background, I mean, you've been at this game for years as a hedge fund manager and as a sometime activist. What happened this year? What changed for you that brought you to this point?
Well, I've always been a tech investor, and but earlier this year I decided, hey, one of our biggest successes at my hedge fund in the last couple of years was that we got into Carvana a couple of years ago, early on, after it had dropped from $400 to $3.50 in December 2022, and then it sort of started this road back, and they've recently eclipsed $400 again. I got in at $15. Our AI model flagged it at $11.
Eric's paying for dinner.
So basically, earlier this year, I was meeting with our engineering team and saying, hey, we got to do more of this. We're building all kinds of different models to do predictions on earnings events and all this. Let's just find more 100 baggers. And so that led us to discovering Iron and Cypher earlier this year, sort of when they were like $9 and $3, still seen as Bitcoin miners, sort of not as sort of next gen AI, HPC,
Neo cloud, if you will.
Neo clouds, right. And then from that, like I noticed immediately the retail responded to that, and this notion of like, oh, the next Carvana, I missed Carvana, I'm not going to miss the next Carvana. Like there was definitely FOMO out there. People were kind of bored of the Mag 7. They were just sort of looking to go out further on the risk curve for sure. And then a lot of people were asking me, hey, I remember Eric you used to talk about Open Door. Whatever happened to Open Door? And that sort of sparked my reinvestigation of Open Door. They were like 50 cents at the time. They hit a low of like 51 cents in June of this year. I got in the 70 cents range, and then went public with my thesis in mid-July in 80 cents, sort of like high 80s, 88 cents or something like that. And immediately it took off, and there was just like this palpable energy. It was global, sort of to touch on something Dan said. Like I was getting like messages from Mongolia, Antarctica.
Right.
I have there's a crew of fishermen in the middle of the Bering Sea that were out on a 10-week, fishing for cod. Like Captain Mike of this fishing vessel was on Starlink buying Open, taking all the 60,000 that he had made in the past 6 months fishing and going full portfolio into Open, and encouraging the rest of the Open army. So I mean, it's been a wild ride, international, like hunger amongst the retail in kind of finding the next big thing, and it's been fun to be a part of it.
All right, well, we're going to just pause for 1 second because we're going to send it over to Ali Canal in the Social Center with some audience questions. I don't know if Captain Mike is writing in and asking any questions here today, Ali, but who do we hear from?
From our Yahoo Finance social media audience, and this one is from Benjamin, and it's for both of you guys. He asks, what investing knowledge have you given away for free that people just don't seem to listen to? Eric, we can start with you.
Well, I think most people do listen when I try to give advice. I would say, one of the things that I've been trying to stress with retail, and I struggle this with myself, is controlling your own emotions as a trader. Like, it's one thing to have this sort of thesis that open door is going to 100x, right? But that sort of masks the volatility that you live with, like day to day, week to week. Sometimes there can be massive drawdowns. Open right now is on a big run since earnings of last week that we're seeing as successful. So it's been up every day since. But before that, like it hit a peak of almost $11, and then got as low on the recent market pullback as below $7. And so on those days, I'm constantly flooded with DMs from people saying like, "Oh my God, is the magic over? Like, what have I done? Do something, Eric. Tweet something. Make it stop," and all this kind of stuff. And you have to teach them that just controlling your own emotions is often the most difficult part of investing sometimes.
Dan, what about you?
I mean, look, traveling around the globe constantly, and obviously, like, from social media, we're transparent. Like, to me, it's really like it's passing it forward and really making sure the information flows there, whether it's for our clients or for retail investors that follow me. I mean, that speaks to like my ETFs. It speaks to everything that I do. What I say here is the same thing I'd say if we bumped into each other in an airport. And it just speaks to like, this is the fourth industrial revolution. It's another 2 years in this tech bull market.
Right.
And I think investors look to people that they trust to navigate them to try to find the winners.
Well, we're going to talk more about all of that a little bit later on. We'll hear more from Dan and from Eric. But for now, we're going to send it over to Brian Sozzi. We just heard the opening bells on Wall Street.
All right, thanks so much, Julie. Let's check in on the markets. Brooke DePalma is at the NASDAQ. Inez Ferreira is at the NYSE. Jared Blickery is here in our New York City studios, and Ramzan Kamali is in our London studios. Let's send it down to Brooke for a look at how the market is open. Brooke.
Good morning, Brian. We're definitely seeing all three major indices bordering the flat line here after that 43-day shutdown. Government shutdown has now come to an end. Taking a look at all three major indices, we do see some downward momentum this morning, led by the NASDAQ. Also, the S&P 500 also down about 0.4%, and the Dow just slightly behind that, down 0.2%. So seeing some downward momentum despite that good news that the government shutdown has ended. Now, there are a few stocks that did get my attention this morning heading into this report, and that's Disney, Cisco, and Alibaba. Disney reported their recent results and revenue missed this morning, and that was dragged by their entertainment business, particularly streaming. On the call, executives did say that they are working tirelessly to close that deal with YouTube. We know that ABC has not been on YouTube streaming. Next up, I'm taking a look at Cisco. That stock, a bit of a bump this morning, up more than 5% at the open, and there, that company boosted their 2026 forecast. A lot of what we're talking about today, they did cite that AI infrastructure revenue is what led that company to boost their 2026 forecast. We know that the street like that. And Alibaba also moving higher this morning after the company said it's doing an AI app revamp, and it's also launching its first self-developed AI glasses. Those are the three tickers that got my attention today. But I know that Inez Ferreira down at the New York Stock Exchange, you're taking a look at Bitcoin, gold, and also the dollar.
That's right, Brooke. We are taking a look at crypto, and I want to start out with Grayscale Investments, which just filed with the SEC to go public for an IPO. This is the asset manager, you'll remember, that manages the Grayscale Bitcoin ETF, also the Grayscale Ethereum ETF. In fact, their filing shows that Grayscale now has about 35 billion assets under management and products that give exposure to more than 45 tokens. No word yet on the number of shares to be offered or the price range. But this is an important development because it further drives the crypto theme this year and crypto-related companies that are going public. Now that the government has reopened, you may see a push of more companies that are going public nearing the end of the year. But Grayscale is really one of these asset managers, that digital asset managers that has been at the center really of the evolving U.S. crypto regulatory environment and adoption here in the the U.S. Taking a look at Bitcoin, we are watching Bitcoin that has been hovering above 102,000 per token. The cryptocurrency really has been struggling to make a meaningful comeback since that October sell-off. It's been hanging around the range of anywhere between 100 and 105,000 per token. But for more market action, let's take it back to the Yahoo Finance studios with Jared Blickery. Jared.
Thank you, Ines. Let's check out the sector action for today. We're looking at energy, the only sector with meaningful gains here, up about 0.75%, followed by materials, industrials, and financials. Some of those just kind of slight gains there. What's not working today, the mega cap sectors of communication services as well as tech. Also utilities down about 0.5% here. I thought it'd be interesting with the government shutdown now over, take a look at what has happened over this 32 trading day period. You can see healthcare, XLV, that is up almost 10%. And then you see tech and that AI related trade and utilities up about 2.5%. And as Kenny Polcari was talking about earlier today, the S&P 500 throughout all of these negative headlines in the shutdown, well, that was up 2%. So back to what we're seeing today, I'm going to leave you with some of my sentiment indicators here. Bitcoin doing well today, retail, gambling, China doing well. What's not is chip stocks. Chip stocks, ARK Invest, so the disruption trade taking a little bit of a backseat. And on that note, I'll send it to you, Ramzan.
Well, Jared, thanks so much. Well, let's focus in on Asia first. They were the quickest to react to the government shutdown, and it was broadly a positive sentiment that prevailed across the markets in the region. And also, there's some other positive news for energy stocks in China. The Chinese government plans to unveil a comprehensive strategy to boost the new energy battery industry and enhance related infrastructure. Also supported sentiment too. I want to just point out SoftBank shares fell over 3% in Tokyo today. That's on top of the fall it had the previous day as well. That's after it sold its entire stake of Nvidia, remember, and it's betting big on OpenAI. In Europe, those stocks were initially tracking their global counterparts higher, but they started to slip back down after some clarity came in about what the US government shutdown would actually mean when it came to data, the fact that we could likely have a delay in inflation data and jobs data in October as well. So that really didn't help sentiment there. The FTSE in London was down pretty sharply. One bright spot, though, was Burberry, and the luxury brand actually announced its first increase in sales, in comparable store sales for over 2 years. And that's really helped luxury brands in France as well. See, and you might have noticed the CAC 40 was higher in France. Well, it's been a huge year for AI, reshaping the global markets, and we've been tracking the biggest trends with top analysts and executives to break down where the next leg of the AI trade is headed.
It's an AI-dominated world now, and NVIDIA's chips are leading the way.
Other chip makers come out and say, oh, we're making this newer, even faster chip. Does it bear out in the marketplace? We haven't really seen that yet.
In order to really take advantage of the AI industry, you have to partner with NVIDIA.
Investors rattled as China's DeepSeek triggered a sharp sell-off in NVIDIA shares.
I think the key takeaway here is that there's a surge in inference demand. That's driving a lot of demand for compute.
President Trump really wants to have America win the AI race.
Our action plan for AI dominance is to get the entire world running on the backbone of American technology.
Because of the changes to the Big Beautiful Bill and the lack of a lot of legislative activities, the president is limited in what he can do.
China is by far investing more in quantum than any other country. It's important for the U.S. to really start focusing on a better strategy for quantum and really to up that investment.
If we think about AI and we believe it's the next industrial revolution, you have to have security.
I think we're in a bubble, but we're in early stages of the bubble, and you can still make a lot of money. But I think people just need to be aware that we're starting to get a little bit beyond the realms of rationality and into more sort of faith-based, belief-based investing.
It's been a massive year for artificial intelligence, reshaping markets and the global race for tech dominance, and few companies sit closer to the center of that transformation than Palantir, whose software powers decision-making from Wall Street to the U.S. government. And here with me now is Palantir's CEO, Alex Karp. Alex, great to see you.
Great to see you too. We've been at this for a long time.
Many years, my friend.
Many years.
Let me start here. Question for investors. Maybe it's the biggest question for investors right now. AI boom, Alex, or AI bubble? A lot of smart people have different views on that. I'm curious to hear yours.
Well, I mean, first of all, it's always interesting to define what it means to be smart. But so if smart means informed, I think the debate comes down to two questions. How large is the market, and how large is the market for things that actually work? So there's really two AI markets from Palantir's perspective. People using AI, call it enhanced intelligence to do basic things, but things that are not sophisticated enough so that they would change your revenue or margins. That is a very large market. One could argue as an informed citizen that market is very large, but may not create enough value to justify the actual cost of large language models or their implementation. What we see on the ground, not as an opinion, but as like a fact, is a subset of that larger AI market. I would call AI that works either in a way that it can change the battlefield, or it can change your margins, or it can change your revenue. And by the way, can do it in a way that's so quickly that you can do it in the public sphere, so you can do it as a public company. You don't have to inherently take the company private, although you can do it in the private context, or you can do it so quickly you can change things on the battlefield. That portion of the market, so the subset of AI where you can show quantifiable results, again, life and death, safety results, or results so that margins or revenue actually change dramatically and quickly enough so that you can capture the value while you're still running the company in the structure as it exists now. So it used to be, to do these things, you had to essentially isolate an institution. I want to rebuild my military. I want to rebuild a company. I want to change the trajectory of my private company. The timeline on it and what you would have, the violence involved, meant that you had to take it offline for 5 years. Okay, that's a really, and sometimes you still have to do that. What the special thing about the category we're in is you can do all that so quickly that you can show quantifiable results. And that portion of the market is expanding as a subset. So if the whole AI market is here, this was a tiny subset. That is metabolizing the rest of the AI market. And so what we see on the ground is the people are very, very receptive under the condition you can show it having worked in a similar environment somewhere, anywhere on the globe. So the part of the market that is weak, that where people talk about a bubble, is in the institutional context. So not consumer internet, where you cannot show the thing having worked. That part of the market is very weak and dissipating. Now, the part of the market we're in, which is we'll show you the results quickly and we'll get paid a subset of it, that part of the market's getting bigger and bigger and bigger, and that part of the market is going to dominate the rest of the market in the institutional context.
Let me ask you this. So you're describing where Palantir is today, Alex. Help me understand where, you think about where Palantir could be 5 years from now or 10 years from now. And one way to think about it is that, you sometimes talk about, Alex, how AI will define the future of warfare. So let's say you talk 5 or 10 years out. I'm interested how you think about what the future battlefield will look like and what Palantir's place on that battlefield could be.
Let me kind of invert the question and say, where will America be? Because I think we're downstream from America's success. America is the only country in the world that provides everything from chips to ontology, above and below. One country. So the question is, can we grow the aggregate GDP, and can we grow the subset of GDP that affects working class people? Because that's essentially the challenge we have. We're in a unique environment where we probably can grow aggregate GDP in absolute terms, meaning GDP that affects you and me. And now we have to, can we grow it in a way that positively affects the welder, the plumber, the truck driver? So this is the core challenge for America. And then as a subset of that, because in a weird way, our ability to defend ourselves or our need to defend ourselves is going to depend on our economic strength and our military strength.
And how does AI play into that?
So first of all, something that we just have to say over and over and over again, we forget in this country, we're the only country in the world who has every part of the stack where the dominant feature of that stack is built in our country. So this is completely unique. So we have a very different problem than, say, Europe has. Europe has the problem that they don't have any part of the stack as a dominant player. Now, so the advantage for us is we have a very plausible narrative to growing our economy. The disadvantage for us is we have to show we can grow the economy in a way where the average person with a skilled job participates. Now, so how does AI happen? It depends what you mean by AI. Again, if you mean AI that you're just going to be running some query, that's very hard to see why GDP inherently grows. It's also hard to see why the plumber, the welder, the truck driver has a better job or the job they have today, but gets paid more tomorrow. And if you're doing AI the way Palantir is actually doing it on the factory floor, on the battlefield, and in corporate environments all over America, you can see that what we're doing is we're taking the welder and saying, oh, we can make you into the kind of welder that can work in a complicated environment that you could not have worked in the past. We're taking the truck driver, presumably, and saying, hey, if we reroute you this way, you're more efficient, you save energy, you actually know how to repair your truck or predictively chair, and so you are a more valuable engineer. And arguably, the most important thing is we're equipping warfighters with lethal technology that is substantially above what our adversaries have, which means our adversaries don't want to fight with us.
Do you see that remaining so in the future? The US,
the danger we have, honestly, in this country is just, like so many of the crazy debates we have in this country are downstream from, we have a bounty of riches. And like our issue is how do you manage that? Like it sounds like an easy problem, but just as an example, if Europe had one of these things, it would be very good at protecting it. We have so many of these things, people think it's automatic. We're automatically going to win. We can afford these international invites. My personal view, maybe not, I'm not saying those of everybody, we can't afford open borders and complete delusion that we can get away with a non-meritocratic society. Most of that comes from the left. But it's like, if we can't get away with diverging from our unique heritage, which is particularly valuable, like free speech, First and Second Amendment, an ability to defend ourselves. These things are especially the fact that we attract and retain the best entrepreneurs from other countries, but we already have many of the best ones here. So like every other country is scrambling to get something to work. Our problem is actually different. This problem, can we stick to the hand we have? We've been dealt a blessed hand. Are we going to screw it up? Now, and that's really our problem. Like, are we going to so regulate AI so that somehow it's easier to do it somewhere else? Are we going to eviscerate concepts like meritocracy? Because, it is like partly because, now this is where Silicon Valley could do a better job. People are nervous about meritocracy because they think it's meritocracy for me and like an oligarch for you, right? So it's like, no, it's like, does this work for everybody? Is a real, or most people, like, are we going to have a society where people believe that tomorrow is better than today? Or are we going to have a dystopian set of views because people think it's only working for Silicon Valley? What does it look like to navigate foreign environments? Can we be honest about successes and failure? I mean, can I get any progressive I know to admit that President Trump has done an amazing job in foreign policy, especially on Iran? And especially on the border.
Well, it feels like we've come to the part where I think a lot of Americans right now, Alex, on that point, I think sort of feel like I'm for kind of reflexively whatever my political opponent is against.
We're in the unique environment where we've been blessed with the most important resource in the world currently. Call it the ability from chips to ontology, like above and below. Obviously, the two most valuable things are kind of the chips and ontology. They're both here. But yes, it means we have to get out of our parochial little niche and start evaluating things on the issues. Like we you know, the bounty of riches that we have, it can be a huge danger. Like, do you know what I spent half my life in Germany. Do you know what Germany would do for our tech scene? Any country in Europe, any country in the world. Like, this is like no other country has this. And by the way, it's incredibly hard to replicate because it's not, people want to believe, including in the Valley, it's like some pure IQ. It's not. It's like a way of organizing things, a way of doing things, plus IQ and other attributes. And this is somehow in this country, if you're like me, you're like, yeah, our Constitution was given to us by a higher power. We have a special role in the world. Some people don't believe that, but there's a lot of evidence for what I believe, including this whole conversation. And then the real question is, do we screw it up? And yeah, we could screw it up.
Let me ask you this: in this AI discussion we're having, investors have clearly determined, Alex, that Palantir is an AI winner. Your stock has soared. I talked to some analysts who cover Palantir. I want your reaction to this. And I'll ask them, you cover Palantir, why isn't Palantir a hold? And here's what they'll tell me. They'll say, I like Corp, I like the company, I like the tech, but it is too pricey.
Okay, great.
It's too expensive. We're at nosebleed levels. What do you say to that?
Great. How often have you been right in the past? That's literally my question. My question is...
That would be your question to the analyst.
No, I'm not going to engage on your prognostications of the future if your record... By the way, this is, as much as I like to bash analysts and as much as many deserve it, it's really, there are analysts who are... I think some of the analysts say that. I think some of them say, look, I was wrong in the past and now I'm looking deeper. So one can't generalize even about analysts. But I would say all sorts of people who have, let's say, all sorts of people that have negative attitudes towards Palantir, or broadly defined. The quote-unquote analyst who's like, nosebleed level valuation. The quote-unquote journalist that says we're powering the surveillance state domestically. The quote-unquote person that says I'm a conspiracy. The quote-unquote person, I don't know. There's all these things. In every country, there's a negative Palantir meme. What I would say to any one of them, and by the way, not just on this issue, there's persuasion and being right. One of the most important things you have to ask yourself is, how often has this person been right? And that is more important than, is it persuasive? If you, analyst, journalist, politician, if they've been right on 5 out of 6 things, and they say a 7th, I think one should assume they're likely to be right. What if they've been wrong about all those things? And by the way, where I do have a bone to pick with like traditional financial people, including their minions, the analysts, some of them, not all, is, do you know how much money you've robbed of people with your views on Palantir? Like, it's like they have all these views. There's no downside risk for their view. At what point, it's like, it really should be next to every statement. I said don't buy Palantir at 6. I said don't buy Palantir at 12. And the welder, plumber, technician who didn't buy it or sold too soon, I owe them money. And by the way, let me tell you something about Palantir that is very positive. By my reckoning, Palantir is one of the very few, if not the only, where the average American bought and the average sophisticated American sat on the sidelines or sold.
What do you think explains that?
Yeah, because the average American was a lot smarter than they were and listened and was not bigoted, like was not held down by a whole set of training beliefs that were wrong. Like, what does it mean to build enterprise? What does it mean to have FTEs? What does it mean to go to market? What does it mean to get paid? Does your enterprise have to be parasitic? Should it be a parasitic? Should the host essentially be paying for the privilege of making your company larger and getting no value except for a weird feeling that you get from the parasite that you're better than you are? It's like essentially replicating the whole woke mind virus in the enterprise. They were open. By the way, they were also not only, they were not bigoted against some obvious truths that we've been saying for 20 years with, by the way, these views when they were not popular.
Like what, Alex?
Like America is a better way to organize and live than any other place in the world. That even though it's better, we shouldn't be exporting, or especially it's better, we shouldn't export. We don't need to export our values abroad. We need to be strong enough in America so that nobody screws with us. Including my views on the border, like we should have an actual border, we should have an actual culture, we should have meritocracy, we should not tolerate discrimination, and discrimination means against white males or whatever that is. We should build the best products. The products are going to have to be much better than any other products in the world, or they're not going to get implemented. I mean, all these things we've been saying for 20 years, and you know what? They pissed off a lot of people in the elite. You know who they didn't piss off? The same people we're also making AI work for. The truck drivers, the plumbers. I run into people all over America and quite frankly all over the world. People who have like normal means who are now rich because of Palantir. You know who's not rich because of Palantir? The people who read the analyst notes and the people who wrote them. And you know what? They're also still kind of angry because while they're cruising along in their broken down car, the person cruising next to them in their beautiful Tesla is an actual worker in this providing actual value who may have gotten rich on Palantir. By the way, I love that. Nothing makes me happier than looking in my mind's eye at the bank executive who's hanging out with their thing, who's living on the drip of some high interest loan, watching some person who's free, American, riding their car, who did not go to an elite school, but knew enough because they didn't probably go to elite school to buy Palantir shares. And now are going to make even more money using our platform.
Let me ask you this. I want to end here. There is a book coming. I want your view on this. It's a biography of you, The Philosopher in the Valley. When I read this book, is it going to be a fair, balanced portrait of Dr. Alex Karp?
Well, I mean, only be fair and balanced if everything was good. Look, it's 70% accurate. It's very.
What's the 30 that's not?
He's got Trump derangement syndrome, obviously.
How does that come out?
Like anything that Palantir's done, it's basically 2 books. It's one book about my childhood, which is a complex background and, came from nothing and highly dyslexic and amorphous. It's like the whole thing, amorphous background, a little bit too amorphous racially, a little too Jewish, a little too very dyslexic, political. That part's fascinating. It's a little hyperbolic, but it's like 85, 90% true. Mm-hmm. Then, of course, the Trump derangement syndrome, the fact that President Trump did these courageous things in Iran, and closed the border, and Palantir's played a role in these things. Obviously, not the role that the people did the work or the president, but that just sets off this mind virus. So Karp has to be evil. It's that part of the book obviously is but it's so obvious that you can kind of read through it. And yeah, there's some things, but I guess it's a good read. I think people read it will say, oh, wow, that's really interesting. There's some things about Alex I didn't know. And, you can assume all the things you don't like about me are on the inaccurate side, and all the things you do are accurate. But I think a lot of people are going to read it. I think people will enjoy reading it.
Since we're talking politics there, final question. And we've been talking for a long time, the two of us, years. How have politics changed in Silicon Valley as you've watched it? What's the arc been like? And how has that, if at all, impacted the defense tech sector?
Well, I mean, I'll tell you, the thing I get in most trouble for in my intellectual circles is the following statement. Silicon Valley, like the rest of the world, will listen to you if those ideas make you money. Now, of course, you still have to have convincing ideas that are true, but if those ideas are not tailored to real world things that work, in the Valley, quite frankly, is dollars, they will not listen. The fact is, and again, whenever I tell this to my intellectual friends, they stop talking to me because they want to believe that pure ideas change the world. Pure ideas don't change the world. I'll tell you what changes the world. Pure ideas backed by the military, in this case, hopefully the US. Doesn't mean you have to use the military. If you're strong enough, this is where I'm like, Palantir is not a neocon project. Our project is to make America so strong we never fight. That's different than so almost strong enough so we always fight, right? So your ideas get listened to if you are dominant on the battlefield, and hopefully so dominant you don't have to use it, but if you do use it, people are like, yeah, I'm not screwing with those. Or if those ideas make someone a lot of money. You still have to have the ideas. And in part, the intellectuals get so angry, my intellectual friends, it's like because they just think they write a book, someone reads it, and it changes the world. Nuh-uh. And that's not the way intellectual projects have ever worked. The ideas have to have a real world input. And so the fact that Palantir is at whatever we're at, this changes the Valley, because not only was the patriotism right, but the patriotism will make you rich. And that's what that impact on the Valley is going to be very long lasting. And I'm very proud of that. But again, you can't just be proud of the idea. That was right from the beginning. It was been right since the history of our country that our way of organizing, especially our Constitution, is superior. It's certainly superior for Americans. Again, superior for us doesn't mean we export it to everyone in the world, but superior for us. since conception, but to make people listen up in their seats, you need to be dominant on the military and dominant on the economy, and Palantir plays a really but-for role in both of those areas, and that's something that I'm proud of, because not just because of the impact, but because the way in which it reverberates both in Silicon Valley and outside. And by the way, it also stands for, anyone can make it. One of the things that's in the biography is, read where I came from. Read that. There's no reason you can't advance in this society. And that's an important lesson for everybody, especially outside the Valley.
Alex, always great to see you.
Nice to see
Thank you
you
for your time today.
Your time too. Thank you. Bye.
Pretty amazing chat there with Palantir's Alex Karp. Straight ahead at Invest, a pulse check on the health of the consumer. One of the CEO of the biggest names in buy now, pay later, the firm's Max Levchin. Levchin's background runs deep in tech. He'll also give us his expert insight into the rise of AI. Welcome back to Yahoo Finance Invest, presented by eToro. AI isn't just transforming tech, it's making its mark across industries. One industry already seeing change, payments and retail. We've seen the likes of Walmart, Shopify, Etsy, and Lowe's partnering with OpenAI to integrate AI tools into the shopping experience. Let's bring in a key name in this sector, Max Levchin, the CEO and founder of Affirm. He also co-founded PayPal, and he is a prominent venture capitalist through his firm, Sci-Fi VC. Max, so great to spend some time with you as always. Thank you for doing this, coming to us, I believe, from another country in London. So thank you so much. So
a country in the United Kingdom.
The United Kingdom. Okay, there we go. I appreciate the correction. So one thing we have not talked about, Invest, we've talked about how AI is impacting sports, how AI is impacting Bitcoin. We haven't talked about how AI is going to impact the shopping experience. So let us have it. How will it impact it?
You know, the jury's still out. It's happening right before us, and so it's a little hard to make perfect predictions. It is the case that we already live in a world of agentic commerce. So today, when you fire up your favorite grocery shopping app, e.g. Instacart, you're telling an agent to go buy things for you. You're trusting a human in this case, but doesn't really have to be a human, does it, to go and refill your fridge or get the food that you're fully trusting a quality control and a payment to occur entirely outside of your hands. And so as humans, we are prepared for a sort of fully outsourced shopping experience from the desire all the way to consumption handled entirely by a system, maybe by machines. The thing that we're talking about now, I think the most interesting part of agentic commerce coming our way, is this notion of AI chatbot, presumably that's kind of the most likely manifestation, becoming a trusted partner in your research, which happens today. I speak with ChatGPT about all sorts of things that I may or may not buy later, closing that last moment of, all right, now let's go buy that. And the question is, how far are you willing to let control go, where you say, we've talked about, I buy a lot of bicycle parts, being my favorite other thing to do, ride a bike. Will I ever say, okay, robot, you go get me that bike? These things run very expensively. I take a lot of effort into figuring out exactly just what I want on my bike, in my bike. Will I fully let go? And I think we will gradually get there. Within payments, of course, the most important question ends up being things like, all right, so let's say we get there. Let's say you trust your chatbot to fulfill whatever it is that you've just chatted it up about. What happens when you don't like it? What happens if you're unsatisfied with the product? Who gets to bear the responsibility of the return, for example? Is it the chatbot that screwed up, or was it you? And so there's just a lot of really interesting questions that are starting to emerge in these conversations about agentic shopping. And of course, the more agentic, the more outsourced, the more the fuzzy the area of, well, okay, so you really have nothing to do with this purchase. You trusted an agent. Does this agent have a power of attorney that you gave it implicitly, or is it explicit? Does it have to be explicit? And so, we're at a firm, obviously we're right in the middle of trying to think all this stuff through, but it's a fascinating new world.
Max, I'll just say, so this is kind of scary. I still like going to an Amazon or Walmart, clicking on a link and buying myself something. What's the risk of putting all our eggs in one basket with these agents? These agents sound like they're about ready to run amok on the internet if they haven't already.
Definitely going to go through some interesting speed bumps, I have no doubt. But you and me both. I very much like my local bike shop experience when I go see a human mechanic that is a true expert. They will talk to me about the thing that I need, but also maybe enlighten me about a couple of things that I want. And therein, by the way, lies one of the more interesting puzzles vis-a-vis retail. So everyone who's ever worked in a store or run a shop, online or offline, understands a very, very important truism, and that is the second sale is the one you want. The first sale is the hardest. You need to attract someone to your store. You need to persuade them to trust you, to sell you the thing. You sell them this thing, and if you are good, if you really deliver a great service, if you deliver a great product, you can expect a returning customer. And that returning customer is what you want. In this sort of internet jargon, there's no longer a CAC. That first transaction, you must have advertised for it. You must have expended some effort trying to get this person to trust you. Once you have fulfilled the transaction once, the second one is much easier, and that's where the profits are made. And so in the world of agentic shopping, one of the things that we can anticipate is the relegation of the store to much more of a fulfillment role, where the chatbot is the one that helped you pick, which is great because it might create a totally new distribution channel for retail, and I think it will. But will retailer in question actually get that easier second sale? Will you know which bike shop online did you order that part that ChatGPT helped you select? And I think that's a question that is going to necessarily resolve itself over the next several, I was going to say years, but given the speed of AI, maybe months. But that is maybe the most important one. How will retail adapt to this new world where the transaction happens entirely or primarily inside the bot? I don't think local bike shops or Amazon or Walmart.com are going anywhere. I think many of us, myself included, actually quite delight in this process of interacting with retail, finding out what's new, seeing new products, being shown some things that I didn't even know existed. And so this discovery process is, that's part of the shopping that's entertainment. And so I suspect that's not going to go away. Agents aren't going to completely replace us in that process. But we are going to reinvent discovery. We are going to care a lot about what does this mean for the second transaction, third transaction.
For those retailers that can't adapt, Max, is the reality that they're just not going to exist anymore?
they're going to compete on price and fulfillment, and some retailers already compete on just those things. But I do think the world of shopping is changing rapidly, changing in ways that we have not seen before, we've not predicted. I think, adapt or be ready for a world you don't especially like. So I would encourage folks to adapt.
So, yes, as someone that has been, I mentioned the intro, PayPal, I mean, you've been in the internet for eons, Max. Do you like what you see in AI? Is it being rolled out responsibly? Do you like the changes you're seeing on the internet, to the very foundation of the internet? Do you like any of these things, or are you worried about some things?
I'm sort of a perennial techno optimist, and so I'm also a computer scientist and engineer by training. And so to me, it's once again a playground of awesome new tools and building blocks to create new things. So I'm profoundly predisposed towards loving, like not just liking, but really enjoying what's going on. Affirm, my company, has been in AI in various forms of it, both machine learning, sort of the classical now known as classical AI, as well, of course, as some of the newer stuff. And so we built a business leveraging the latest discoveries in that domain. And it's done great things for us, for our customers, for people who borrow money from us. And so all this new technology that's coming our way, there is a good way and a less good way to use it. And it's up to the individual entrepreneurs and teams to put it to great use. And I think there are so many great teams, so many people that see a cool new tool, a building block, and say, that's the thing that I'm going to use to make my mark on the world, make so many lives better, just push us to the next place of abundance, success, etc. So I'm not worried, to be completely honest. For every bad actor, for every mistake, misbehavior, there are so many more people who are deeply motivated by just trying to make lives around the world better.
Is this generation of AI, Max, is it making the internet a better place?
I think so. I am, in a world of worries, the thing that I certainly expect, and again, I worry less than I think I expect and plan. The things like deep fakes, the sort of really indistinguishable from reality content that's generated to look real, but is something entirely not. It's a concern. I think we're going to need new, deeper, more serious forms of authentication. I think we're going to really care about verifiability. We're going to need to give people tools of detecting what's true news and what's being designed to sort of excite them into behaviors that they won't be proud of later. And so I think that's the darker parts that I spend some time on. But again, through the lens of an entrepreneur's mind, that's a great opportunity. So someone's going to build the next verification service to rule all verification services. There'll be an AI company to bring a mirror to some of the deep fakes and say, no, that's not real. In the world of augmented reality, I will have a pair of glasses that will allow me to look at images and videos and say, that's not real, that's generated. And so it's always easy to get scared and sort of try to look for a unelectrified dark cave from where you can finally hide from all the ills of society. But it's much more fun to imagine what tool you can bring to bear to combat the whatever darkness scares you.
I don't know what this says about me, Max, but my X feed is filled with robot videos. Elon posting robot videos of his own. Those seem to work well, but I've seen other videos of these humanoid robots trying to cook an egg. They can't do it. They fall apart, run into a mirror. I mean, some of these videos are ridiculous. Are you a big believer in the humanoid being a major contributor to the economy, and is it all coming for our jobs?
I don't think it's coming for our jobs. I think, so I'm a huge believer in this notion that AI and embodied AI is a collection of tools for us to lead better lives, to do more. We're all going to be smarter because these systems have PhDs on any given topic. They can educate us, they can bring us along, they can help us be more decisive. Once we get to robots that can cook an egg, which I think we're a few steps away from, just because it's a much harder problem. Bits are inherently easier to manage than atoms, and we're a little bit farther away from managing atoms. But we'll get there too. It will open up our world to do more interesting, more intellectually stimulating jobs. And, there will be someone who will lament the loss of their manual labor. But I think it's pretty similar to sort of, it used to be real. I would hammer a piece of metal with my hammer, and that was real work. And now we have these machines that just do die cutting and casting, and that happened a couple times in history, and we've always done better for ourselves as a species. So I'm not at all worried about the loss of jobs. I do think the robots are coming. I would definitely invest a few serious cycles into making sure we don't end up in the sort of a Skynet universe. Not so much because the robots will evolve consciousness and want to kill us all, but because there are plenty of people out there who would want to wreak havoc by breaking into these robots' operating systems and doing bad things. So security is important, safety is important. I think we're going to solve those problems.
I wanted to get some thoughts on leadership, Max. You and I always talk about earnings. We got shot of accounting. We talk about profit margins, but we could talk about some leadership things here because we are at a all-day event. Here's one for you. You've seen the evolution of tech from the early 2000s to now. What would surprise your younger self about the world today?
I think one of the more important traits in a leader, and certainly in a technology entrepreneur, is you can't ever stop being surprised. As I try to make a mental list, like the question isn't what surprises me, it's sort of what surprised me the most today. There's always something unbelievably cool going on. I just saw the news that Waymo will take me from San Francisco to San Francisco airport, which I couldn't do 2 days ago. It's like the greatest thing ever. I love Waymo. It's like the robot car that gives you full privacy, and you sort of ensconced in the back and feeling like you're in a clamshell just traveling the world. Now it can take me to my next flight, which is so exciting. And I did not. So when I was in college, my roommate was involved in a project to do a self-driving car through the desert somewhere, and there were no roads, but also no real obstacles. Just drive, and they drove for like 6 miles and the car crashed and it was terrible. And I remember thinking, man, like, will we ever have self-driving cars? We have self-driving cars that can get on a highway, get off the highway, deal with the airport traffic, drop me off to my gate. Like, that's amazing. And tomorrow will be something else that'll just blow my mind. And like, you have to have that willingness to just have your mind blown every day, because that's when you also find ideas like, well, you know what would be cooler if we built that, and then you can build it.
Max, are there any pivots in your own career that stand out to you as particularly meaningful?
My most important pivot was pivot back. Yeah. Stop me if you've heard this one before, but so obviously I sort of lucked or maybe worked my way into this PayPal thing that Peter Thiel and I started, and worked with some really great people in the process, and sort of defined myself as this financial services entrepreneur in my early 20s. After the PayPal journey was over, the one thing I told myself is I'm not touching financial services ever again, because how can I possibly beat that? The Sophomore Act cannot be comparable to the Freshman Act. It'll never work. No more financial services. And I meandered through the desert of anything but financial services for a number of years. I managed to start a company that Google acquired, so I wasn't entirely successless, but it was a bit, I sort of cut myself off from the very supply of the drug that apparently fuels me the best. So when I begrudgingly decided I'm going to go try to build another payments company in credit, as it happens, it took me a year to fully commit. Sure, I'll build it. And my wife, who is much smarter and in most ways much better than I am, said, just wake up, man. Like, you are good at financial services. You foam at the mouth about the excitement of doing fair credit and underwriting and compliance problems you're going to have to solve. Like, no one is as boring as you, but you love this stuff. Go build it already. And so I started a firm. And of course, it's been 15 years and I love every moment of it. And it's been amazing. Company's been quite successful, obviously. But the pivot back, thanks to some very not so gentle pushing in my family, has been the best.
Lastly, Max, am I wrong to think if you weren't doing a firm, if you weren't in tech, you would be spending most of your time in biking? Like, what do you do outside of this gig?
I train as if I'm just about to go off and ride the Tour de France, which has not happened, but hope dies hard. You and I share a passion for fitness and a certain degree of obsessiveness around right kind of vegan proteins.
Yeah, I'm actually a couple High Rocks gel packs into this to this day. We're going to keep it coming, though. Got a long day here at Invest. Max Levchin, thank you for your thoughts on Affirm, robots, and I'm glad you don't think the internet's falling apart. We appreciate it. We'll talk to you soon. All right, the AI trade is among the hottest on Wall Street, but will it stay that way? We'll hear from top investors on what you should think about for your portfolio in 2026. Don't go anywhere.
Welcome back to Yahoo Finance Invest. The AI trade has powered markets for nearly 2 years now, fueling trillion-dollar valuations and reshaping entire sectors from semiconductors to cloud infrastructure. We hit the streets to get Americans' take on AI and how it affects their lives.
Are you afraid of AI taking your job?
I think AI is coming and it's going to be used in ways that are good, but also possibly ways that are harmful.
I do see where it's being supplemented for things, writing emails, writing proposals and contracts. So I could see other people in my organization where it goes towards it's taking away their statement of work.
We kind of just have to work with technology and use it to better our own business.
I think that it's getting too smart, too quickly. Everybody uses it too much. And I personally don't. I try to minimize my use in general.
Now investors are asking whether we're in the middle of an AI bubble or still just scratching the surface of a long-term growth story. To break down the next leg of the AI trade, we're joined by Dan Ives. He's back with us, Managing Director and Global Head of Technology Research at Wedbush Securities. Gargi Chaudhry, BlackRock Managing Director and Chief Investment and Portfolio Strategist for the Americas iShares. And Eric Jackson, EMJ Capital Founder, President, and portfolio manager. And guys, something I'm struck by as we heard those folks on the streets of New York, and also I'm sure in all of our conversations, is how concerned normal people are about AI. So there's this fascinating disconnect to me between what we see in the markets, where there is huge investment and enthusiasm, and the real trepidation that people have about how this transition is going to unfold. Gargi, as you all think about your investing strategy around this, how do you think that informs what the transition is going to look like?
Sure, Julie, it's so great to be here. Thank you for having me. And I think just listening to that dialogue and then also thinking about how clients of ours are talking to us about AI. So for example, we just did this survey with People and Money, and 19 million Americans are actually thinking about investing in equity markets in the next year or so.
Who haven't yet,
or many of them have not yet. And a big driver of that is the AI sentiment, this mega trend that is shaping earnings. It's shaping, to your point, a huge amount of earnings growth over the last couple of years. And we think at BlackRock that this is something that is flowing through not just into flows, which is happening, but also into macro data. So it's the macro growth is impacted by earnings. Real GDP in the first half of the year, about 1.1% of that was driven by AI, but also in the micro in terms of earnings, in terms of IG issuance, in terms of how we're thinking about infrastructure and private credit. So this is definitely a powerful force and a tailwind in many ways.
Dan, we know that you are a big AI proponent, obviously, and as you talked about, you think we're sort of still relatively early on in the AI party, so to speak. I'm curious how you're thinking about the investing case for the enterprise versus the consumer when it comes to these AI applications going forward.
I mean, right now it's all about enterprise in terms of the AI revolution. I mean, that continues to be ultimately where the growth is. And I think consumer ultimately is going to come in 2026, 2027. But this is about the enterprise in terms of this AI revolution from NVIDIA to Microsoft to Palantir. This is an enterprise-led AI revolution first, then the consumer.
I think Dan's got to go back to his shot where he had the beautiful trees in the background in Miami. We're having a little bit of trouble with your shot, Dan. But Eric, I want to ask you about NVIDIA specifically. I know you've been an NVIDIA bull in the past. Obviously, NVIDIA has been incredibly dominant in this build-out phase of AI. Do you think that dominance is near peaking as we sort of move towards the application part of AI?
Well, they're gonna. You need both, and so they're in the driver's seat, and they will continue to be for many years to come. I mean, obviously they'll have the AMDs of the world nipping at their heels, and everybody will say, well, we're coming out with the next great chip. But NVIDIA has this 25-year head start over everybody, and so they're going to move just as fast, if not faster. And so we've got Rubin coming, and the next generation of chips after that, and there's nobody better positioned than they are to continue to lead. So they are a necessary component. The apps are also a necessary component of what's to come in the build out. So both will succeed.
And I know that you're focused on sort of stocks that are very specific where you see a lot of upside, but do you think that there's also a case to be made for investors? Do you just buy the whole basket of everything that touches AI, or do you think it is better to have sort of these very targeted bets?
Well, I think just as an observer, there's been a lot of skepticism around NVIDIA, for example. And so almost from the moment that the ChatGPT 3 came out, 3 years ago now, there was sort of this knee-jerk that, the way to play this is not NVIDIA, but it's to play the catch-up trades of like the next set of chips. And that's been terrible advice. And so I think a basket I would not suggest. For most investors, I would say you want to pick the winners within every little niche of the overall AI stack and go with those leaders.
So Dan, I want to go back to you on this then, because we know that you, again, are bullish on quite a number of these different names. Let's say, what if you had to pick one, right? What if you had to pick one stock in 2026 within AI, what's it going to be?
Tesla. Because, this is the AI chapter that's now going in for Tesla. Musk is wartime CEO. Autonomous and robotics is going to be the next step. I think Tesla is ultimately a double over the next 12 to 15 months. That continues to be the name that I think, especially when it comes to a name that investors are underestimating what this is going to look like. To me, it's Tesla, and obviously followed by Messi of AI, Palantir.
Eric, do you have a view on Tesla or Palantir?
I love them both. I think they're both great companies. Alex Karp had an amazing interview just on the network, just in the last half hour. It was riveting to watch. but they're both huge companies, and so I, like you said before, I like to kind of play for some of the smaller plays, and even a company like Opendoor, you'd think, is that an AI company? But think about like what they're trying to go after, and there are going to be so many stories like this. They're trying to revolutionize how we buy and sell houses, and move away from an agent model to one that's purely like AI led. And so what will that look like? Well, they in the summer they had 1,400 employees. Keith Rabois, who's now the chairman of the board, has said, we want to fire 90% of those people and replace them with AI. So we want to totally rethink the entire real estate transaction process, AI led, including like home inspections, including like AI, what do they call it when you sort of frame your house, you sort of do up your house and make it look best. I mean, that's all staging. Yeah. AI staging now is a huge thing. Huh. So it's going to be interesting. Like that's just real estate, but every industry is going to be revolutionary.
And Julie, I'd also add, I mean, the bullishness of colors on this panel. I mean, Jackson's dressed a little bearish. No, he's dressed a little bearish. I expect
Dan, this is how Canadians dress when they want to look like Dan Ives. This is as flashy as we get up in Canada. Okay,
We've all tried. I think. We're sort of complimentary here. I think all of us equal Dan's shirt is what's going on today. Gargi, I want to follow up to you on something that Eric just talked about, which is those layoffs, right? If there is going to be this disruption, right, and it seems like the more progressed it gets, the more it looks like there is going to be labor disruption. There's also some maybe cyclical labor disruption under the surface. So, okay, we have this great AI future. Who's going to have a job to have money to spend on this great AI future? If I don't have a job, I'm not paying, as Max Levchin was just talking about, I'm not paying an AI agent to buy my groceries or spending that money. So how do you think about that?
Julie, and I think we heard that when we, before our segment started, when we heard from people across the street, if you will, there is that concern around my job is going to get taken away. But if we take a step back and think about where we are from an economic cycle perspective, unemployment rate, at least the starting point, is very, very strong. And I think we have to take solace in the fact that the consumer is in a very good shape right now. Unemployment rate, I mean, we haven't had the picture in a while, but based on what we see, it's still a strong labor market. And as of now, the small impacts on the unemployment side is coming through for a very specific cohort. Now, we've seen revolutions like this in the past. I mean, there were people that entered things by hand in stores and in companies, and then you had the computer come in and replace all of that. What happened? People had to get retrained. It took time, and at the end of it, we had a more productive economy. So I don't want to diminish the fears that people have about getting replaced by AI. I do think it's something that you are palpably seeing, but at the same time, I want to point to two things. The research so far shows that if you're using AI to augment your skills, you're likely to be in a much better place than if you weren't using AI at all. So for those that are not using AI, I would say make sure that you're using it for augmentation of your current skills. And the second is be invested in this AI revolution, whether that is through equities, whether that is through private credit, whether that is through infrastructure. Make sure you're a part of this, and then have a voice. Have a voice in the process. There's going to be hopefully regulation around this, making sure that your voice is heard within the process.
I love that idea of like hedging that you could potentially lose your job or have to shift your job by investing in some of these AI companies. That's a really intriguing prospect. Going back to some of the specific companies and this sort of universe that we have, I find it intriguing that Dan's picks, or for that matter, Eric's picks, aren't as leveraged to OpenAI, which is seen, obviously you all know there have been a lot of questions about the centrality and circularity of OpenAI and its position in this whole ecosystem. Dan, let me send it to you first, how you think about that, whether you think it's a risk, and what you made of maybe I don't know if it was a Freudian slip or what it was by Sarah Fryer last week of OpenAI, who talked about a potential government backstop, and then sort of the company had to kind of walk that back.
Yeah, and I think they've walked that back, right? Look, I think the reality is like OpenAI is foundational to the AI revolution. And I think everything that they're doing, from the NVIDIA stakes to AMD to Oracle, you're building out what essentially is the new economy for consumers and enterprises. So I don't view, look, the circular issue, I'm not as concerned about. It's not like a vendor financing late 90s situation. For every dollar that they invest, they're getting back $12 to $15. So in my view, OpenAI is going to be a core foundational successful piece. I do not worry about the too big to fail concept in terms of where this is all heading.
What about you, Eric?
I think there's been so much noise, and haven't we learned from, especially Tesla and Elon Musk, how many times has the world been sort of offended, at something Elon said? Remember, he said something to Bob Iger. He's, in 2018, we thought it was going to end when he tweeted about, 420 to taking it private, and the show goes on, and Tesla is the story is what matters to investors. I think, there's people have been complaining about what Sam Altman said on a podcast. It doesn't matter. We were just talking before this segment about using ChatGPT to find like an amazing restaurant in New Orleans that we never would have, discovered before. There's like what we get out of this technology is really what matters, not the personalities, not the
It matters
news
a
of the
little
day.
bit, but you have other choices. If you don't want to buy Tesla because you think that Elon Musk is not a particularly stable leader of the company, we've been talking about a lot of the other choices that you do have.
I mean, there are always competitors, but there is no other Tesla. There is no other Elon Musk, faults and all. And there is no other, I think OpenAI is just an amazing company. It's got drama with Sam and Elon fighting and tweeting at each other and stuff, but the product is amazing.
Eric, my call continues to be Julie will be in a robotaxi in 2026. That's my call.
Not a Waymo, a robo-taxi?
You're in a robo-taxi, 2026.
I don't know. We'll see. I don't know about your call that you've made to us before, though, that we'll all have robots in our homes in the next couple of years. I'm not quite ready for that, especially since the robot on the market right now, which is not made by Tesla, still is controlled by a human. No, thank you. Not getting that one in my house. But be that as it may, Gargi, I'm curious how you think about OpenAI and the web that we have seen created here. And also, not just on the equity side, but on the debt side, some of the creative vehicles that we have seen to finance some of these projects.
Absolutely. And this is a question that's been coming up a lot from our clients. I will point out that we just did a poll yesterday in one of our client calls, and 66% of about the 1,400 clients that had joined are still very bullish, but that obviously means that there is a cohort that is getting concerned around valuations, and they're questioning, is AI in a bubble? And a lot of it is around the circular financing point. So maybe two things to remember here. One is, to the extent that the majority, 52% of the hyperscaler capex that's taking place is coming from cash flow and it's not coming from sort of leverage, I think that is something that we can feel good about. And then of the total capex, about only 12% is going towards these smaller neoclouds. To the extent that that remains the case and you're looking at massive profitability, maybe the circular financing, to Dan's point, this isn't new. We've seen it in this space before. It's not as concerning when there is revenue and EBITDA associated at the end. Mm-hmm. However, obviously, if we look at the number of neoclouds that are doing deals and are doing capex going from 12 to 15 to 50, I think that is going to be something that will raise more questions around circularity of AI. And I'll also say that's probably a risk in terms of, is there a perceived demand that might not actually be there because you're not exactly sure what's hiding what. And that is a risk that we need to be aware of.
Well, Eric, you like some of those neoclouds. We talked about them earlier, Iron, Cypher. CoreWeave, by the way, those shares have been on the wane a little bit. I don't think that's one of the ones that you hold. So how do you figure out, when you're assessing some of these companies, how do you assess the risks, the potential risks that we're talking about?
Use ChatGPT. I mean, you got to do your homework, and you got to. I mean, and we laugh about it, but like, there has never been a better time to be an investor and leverage these AI tools to figure the answers to the questions.
Guess what? Those AI tools are not infallible. The stakes are low when Gargi's asking you where she should eat in New Orleans. It's a little bit higher when you're trying to figure out where to put your money.
And that's what separates like the good investors from the bad investors. Somebody joked with me the other day that like kids today should be majoring in prompts prompt writing. That should be your major. You want to do something practical. How do you write a prompt? It's sort of garbage in, garbage out.
Yeah. And it's the data that you feed it.
Right.
You're getting the output from the data that you're feeding.
Well, most of the data that ChatGPT is using right now is from the internet. So that's data is uneven, shall we say.
Well, and I mean, the good investors know when they're
use
being
your
kind of
human
led
judgment on
led.
top of it.
Yeah. You can smell a rat, like in some of the answers that you get. And so, well, no, I don't trust that. You're wrong, ChatGPT. How about do it this way and do it that way? It's the follow-ups. And so, I mean, that's the exciting part, though, is that the world is your oyster, I think, with these tools. But you're right. Like there's a big difference, I think, between a CoreWeave and an Iron Cipher. CoreWeave is sort of stuck in the middle between the hyperscalers. They said, like, hey, we want to be this asset light, company because we think it'll get a great, multiple from Wall Street, and then we don't have to buy all the necessary, real estate underneath and build the actual data centers, and that'll be rewarded. Turns out they're getting disrupted because they don't control these things that their whole business is sort of based on.
Right, and then I saw today Bitfarm, which is a Bitcoin miner, is now transitioning over entirely to AI and data centers, which is something we've seen more and more of. Thank you guys. I wish we had more time, but we'll have to do it off camera. Eric, Gargi, Dan, thank you so much. And we're going to send it back over to Brian Sazi.
Oh, that's amazing conversation. Thank you so much, Julie. It's been a roller coaster year for the economy, from tariffs and interest rate cuts to the longest government shutdown in history. Up next, former Fed Vice Chair and National Economic Council Director Lael Brainard joins me to make sense of it all.
President Trump will unveil long-awaited tariffs on all countries as he aims to level the global trade playing field.
If we didn't have tariffs, we would be exposed as being a nothing.
Make no mistake, this is China versus the world. They have put these unacceptable export controls on the entire world.
We have a record for the S&P 500 closing above 6,400 for the first time ever.
NASDAQ Composite, we do have a record there, and the S&P 500 crossing, as you said, 6,400 for the first time.
A bunch of micro data points drives the overall economy. And from right now, I see nothing alarming from the micro data point.
The S&P 500 fell more than 10% in 3 days following President Trump's quote-unquote Liberation Day tariff announcement. The decline was one of the worst stretches we've seen since World War II.
This is all coming against the backdrop of multiple threats by President Trump to remove Powell from his post and pressuring him to lower interest rates.
The administration is looking for cause, a reason to fire Chair Powell.
This is the red line for the markets. If President Trump were to fire Jerome Powell, then you would see, as one analyst said, a mess in the market.
Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
Markets are continuing to price in an interest rate cut in December. That's despite Federal Reserve Chair Jerome Powell's recent hawkish comments, saying another cut this year is not a foregone conclusion. And it's not just rate cuts that have all eyes on the Fed this year. Investors are also waiting to see who will become the next Fed chair and what the future of Fed independence will look like due to ongoing pressure from President Trump. Joining me now at Invest is Lael Brainerd, former Federal Reserve Vice Chair, former Undersecretary of the U.S. Department of Treasury, and former Director of the National Economic Council under President Joe Biden. Lael, always a treat to get some time with you. I thank you for coming to Invest. The debate right now in markets, the day after the government shutdown has officially ended, is the lack of data. And the Trump administration has locked in on the fact that we may not get this data from the past few months. How concerned are you about the lack of economic data that's likely to come out?
Well, it is a very unusual juncture. Going into the December meeting, it's just much less clear where the Fed is going to go than it was back in September. And it's not primarily because of the lack of data, although the lack of data just makes it worse. It is because we have heard from both sides of the Monetary Policy Committee that both the hawks and the doves are digging in, with the hawks saying that inflation is 3%. It has been for 44 months now. And it is projected to remain in that territory because of the tariffs. On the other side, the doves are saying that the labor market appears to have softened given the last public sector data that they have, as well as some private sector data. And both sides are right.
Before the government shutdown, Lael, there was a general consensus that the economy was slowing down, as seen through the prism of U.S. labor market data. Why was that happening?
So I think we have a very clear two-track economy. We have the AI sector, and all of the related sectors are seeing record interest in the stock market, are seeing massive investments, data centers, electricity, chips. The leading sector is doing extremely well, but it's not hiring. And the rest of the economy is suffering. It's suffering because it is less favored in the capital markets. It's suffering because it is still trying to digest those tariffs. And then it's also, a lot of those businesses are not clear how much should they hire given what they're hearing about integrating AI into their businesses. So for all those reasons, neither the booming sector nor the remainder of the economy are really hiring. And meanwhile, you have very divergent economies.
Is the economy in a recession?
I would say you saw the second quarter growth number coming in very strong, 3.8%. Consumers remain resilient. Now, we know that that is the top of the consumer income distribution, but they do remain resilient, driving spending. And all the estimates are that third quarter GDP is going to come in quite similar. So the economy at the top level is strong, but again, it's being driven by this really important set of investments in AI. The rest of the economy under the hood is really stuck.
You bring up a good point, Lael. Why do you think the wealth we're seeing built at the top end, as seen through the prism, of course, of the stock market, why isn't that trickling down to the average household?
So you saw it in the election. Clearly, people in the lower half, even the lower 3/4 of the income distribution, are really concerned about affordability. They've seen prices of coffee and bananas going up, housing costs not coming down, utilities costs going up. So they're very worried about that, and they're worried that their job opportunities are not as good as they were a year or 2 years ago. You see that in the consumer sentiment surveys, whereas that top 10% of consumers, their housing values have gone up, and of course their stock portfolios are very positive.
I'm glad you mentioned coffee and bananas, Lael, because the Treasury Secretary, Scott Bessent, is out this week saying the administration plans to put policies in place to bring prices down for coffee and bananas. Maybe this is the new egg debate. Whatever the case is, you're in government. Can the administration actually do this? Can they bring these prices down for these two key ingredients?
So, look, I think it is interesting, first of all, to see the Secretary of the Treasury and the administration wake up to the fact that people are really unhappy about prices and affordability. Don't forget, just a few months ago when they were putting tariffs in place, he was talking about how, well, there'll just be fewer toys under the Christmas tree come Christmas time. Now, I think they're seeing that actually consumers are really troubled by this affordability. And to some degree, they can take tariffs off where they've put them on. And that is what they're talking about. But it will be very difficult for them to fundamentally reverse the affordability crisis in areas like housing and, of course, in healthcare because of some of the expiration of the tax credits. It's actually going to get worse for millions of families.
Do you believe the higher prices we have seen, coffee, bananas, whatever it is, furniture, apparel, are tariffs causing this inflation? And then do you think the administration will come to regret these tariffs?
So look, I think in areas like baby clothes and strollers and toys, furniture, those are clearly tariff related. You can see the tariff lines. Coffee, bananas are hurt by tariffs, but in some cases there are structural forces that are making these worse. And so, for instance, the demand for electricity is growing at a rate we haven't seen in many years because of the boom in AI, and that is inevitably going to put pressure on consumer electricity prices. And that is something that is more complicated and difficult for the administration to reverse. Of course, it didn't help that they got rid of a lot of the alternative energy incentives. They have brought prices down. We're seeing lower prices at the pump by a little bit. But some of these other forces are going to be difficult for them to reverse without reversing their own policies.
I talked to a noted economist, Lael, Mohamed El-Erian, earlier on at our Invest event. He said this, quote, "I believe that this Fed went to sleep." And Mohamed was referencing that the pressure, like you were mentioning too, on lower income consumers. Is the reality that the Fed, that meeting, December 10th, decision day, they need to come out here and cut rates and make it clear that more rate cuts might be needed to ease the pressure on households?
Well, I think they are in a difficult spot because they have the most powerful inflation fighting tool. And of course, with inflation now not continuing to come down, but stalling out around 3%, a little higher, they are concerned about inflation. I think most members of the committee believe that this is a transitory impact. They don't like to use that word, but they do expect the tariff effects to dissipate, so no further increases from tariffs eventually. And the other side of the committee, I think, has been sounding the alarm about the weakening labor market. And that was what we saw in September, very clear commitment to cut 3 times in those projections. But it turns out that 9 of the 19 members were not actually on board for 3 cuts. And so that is what we're going to see play out in December. Even if we see a cut in December, it's likely we would see a pause after that, given where the hawks are on the committee.
If you were still in the Fed, Lael, would you argue for a rate cut?
I would. I would be concerned about the weakening labor market. And I think I would take the risk that perhaps tariffs push prices higher for a little longer against the risk that we really see a self-reinforcing downturn in the business sector that leads to real pain for American households. So weighing those two risks, I think as many members of the committee, including the chair, has articulated, they are more concerned about the risk to the downside on the labor market. We just heard that again from Governor Cook. And they're willing to take a little bit more risk on the inflation side of the mandate.
That decision on rates, Lael, is just, of course, one day on the calendar. You look out through this whole year, and it comes against a backdrop of really unprecedented attacks on the Federal Reserve by President Trump and various members of his administration. Are you concerned that these attacks have undermined the credibility of the Fed longer term?
I am very concerned. I think everybody should be concerned because, of course, the Federal Reserve's independence is what is key to its credibility on inflation fighting. And the fact that most people believe that they will bring inflation back down to 2%, that inflation expectations are well anchored, is rooted in that independence of the Federal Reserve. So we've seen, as you said, unprecedented moves to fire a board member without cause. We have seen another new board member appointed while remaining on the staff of the president's office, and ongoing statements from the administration that they believe that the Federal Reserve needs to lower rates in part to bring debt service on the national debt down, which of course is a real violation of Federal Reserve independence if it were to happen. So for all those reasons, I think investors and the public should be carefully watching what happens over the next few months in terms of the Supreme Court case on the firing of the governor without cause, as well as the appointment of a new chair and what that signals.
Of course, the list to replace Chair Powell next year down to 5. Are you confident in these 5 choices?
So the lists that people have talked about publicly, they are all highly qualified individuals. And the real question is the extent to which each of them can truly be independent of the White House and be perceived to be independent, because at the end of the day, it is that public perception that the Fed truly is independent and makes its own calls based on its dual mandate, which is to keep inflation low, keep the economy at full employment. That is what anchors inflation expectations, and it makes it easier to bring inflation to the 2% target without causing unemployment to rise.
Well, before I let you go, Chair Powell, he's been a constant in markets for years now. What do you think his legacy will be?
Well, I do believe that the single most important legacy will be his very determined efforts to guard the independence of the Federal Reserve, to make sure that the Federal Reserve maintains its institutional strength and resilience. And of course, that is the most important legacy he can hand to future Federal Reserve chairs. It's also the most important legacy to serve the American public, because it means that they can have confidence in low inflation and that it won't require high unemployment to bring inflation down.
We will leave it there. Lael Brainard, thank you so much for making time for us at Yahoo Finance Invest. We really appreciate it. We'll talk to you soon.
Thank you.
All right, I'll send it over to Josh Lipton for a look at Yahoo Finance's new Prediction Markets Hub. Josh.
Thank you, Brian. Just talking there with Lael Brainard, former vice chair of the Federal Reserve Board. As we wait and see if the Fed will announce rate cuts in December, prediction markets like Polymarket are weighing in on the probability of it happening, which brings me to some exciting news here. Yahoo Finance will debut a new prediction market hub powered by Polymarket to help investors better follow prediction markets and the forces shaping them. With the Yahoo Finance Prediction Markets Hub, users will be able to see probability data from Polymarket for key economic, government and market outcomes. Each probability will be paired with related news, quotes, and analysis from Yahoo Finance and its partners, providing investors with a broader context around shifting public sentiment and expectations. The Yahoo Finance Prediction Markets Hub is expected to roll out in the coming months. We're going to be right back with more from Yahoo Finance Invest.
Welcome back to Yahoo Finance Invest. One of the world's largest drug makers is coming back out of the M&A trenches with its prize. Pfizer acquiring weight loss drug startup Metsera for $10 billion. This following a battle with Ozempic maker Novo Nordisk. Pfizer has also recently partnered with the federal government to bring most favored nation pricing to those with Medicaid, aiming to lower drug costs for Americans all across the country. And not to forget, we're coming up on the 6-year anniversary of the COVID-19 pandemic. Under CEO Albert Bourla, Pfizer partnered with BioNTech to start developing its vaccine in mid-January 2020. By December, the FDA had granted emergency authorization of the vaccine. Over 5 billion doses have been distributed globally. For a deep dive on keeping the world healthy and what the future of medicine looks like as AI takes over, Dr. Albert Bourla, Pfizer Chairman and CEO, joins me now at Invest. Good to see you.
Very good to see you, Brian.
I can't believe it's been 6 years.
It is. Yeah, time flies.
Time flies. Let's start on some more news over the past few weeks. You had that battle with Novo for Metsera. Why is this asset so important to Pfizer's future?
First of all, why obesity is important, it is the question, and it is because we have the right to win in this space. We are a company that basically we made the primary care market. We are a company that we know how to run big, global, complicated trials with a lot of people in vaccines or cardiovascular. We are a company that know how to manufacture at scale. You mentioned COVID before. And we are, of course, a company that we have a field force that is ranked #1 consecutive in the last 10 years in the US, particularly the primary care field of it. So we have anything that is needed for us to be successful in obesity. Unfortunately, we didn't have a portfolio not because we didn't try, but because our two lead assets a year ago both failed one after the other. So now we have the portfolio. And why Metsera? We looked because we wanted to enter into the obesity market in Europe, in China, in US, in Japan, everywhere. And we couldn't find a portfolio as advanced, as high quality, as differentiated as the portfolio of Metsera, which is why we tried very hard to acquire them.
Within that portfolio, what are they working on specifically?
Yeah, they have a GLP-1, which is basically the likes of Manjaro or of Lilly, that will be a weekly product, and has very good tolerability profile. But also they have a GLP-1, which is a monthly, and this is highly differentiated. I don't know anyone else that is so advanced in a monthly GLP-1 product. They have also an amylin, which is the new mode of action against obesity, that has already presented several very impressive data. And they have it again as a long-acting, a monthly amylin injection. And then they have a combination between the two, monthly and GLP-1, of which I have seen very recent data and looks very, very promising. So those are the injectables. And they have, in addition to that, a set of orals, both amylin and GLP-1s. Usually in the orals, peptides, you need to take them with empty stomach, so you can't eat after you take the medicine for some time. That restriction will not exist with that because those peptides are so well formulated that they don't need that. So highly, highly differentiated. In our hands, I think another very strong competitor will emerge.
You're talking about some serious innovation here. When do products like this hit the market, you think?
I think if we move fast, in 28 we should hit the market.
Would that make Pfizer the leader in the industry?
Look, we think that our leading position will be in oncology in the near future. I think in obesity we will play to be a leader as well. And we are leaders in vaccines.
Of course. You know, there's been some folks saying Pfizer overpaid for this asset, but I would say they're not thinking about it the right way. You're viewing it as a long-term play, standing up a new business. Is that right?
Absolutely right. And it's not also how much we paid, it's how much we plan to invest. And we plan to invest to win in that space. We are going to follow a very comprehensive, very broad, very deep development plan that will hit not only obesity, but also several comorbidities around it.
When you're in a battle like this, like you have been with Novo, does purchase price even matter?
Yes, it matters, and I would be happier if we could get it in the originally agreed price. Sure. But the most important thing in these acquisitions is, does it work or not? Mm-hmm. If it works, it's worth the investment big time. If it doesn't, then you overpaid.
Of course, you know, the last time I saw you, we all watched you at the White House, standing with President Trump, focused on bringing down prices, drug prices in this country. When will consumers be able to see that?
I believe beginning of the year, we should be able to have implemented all these changes. It is the big discrepancy between affluent countries, rich countries, and the US in terms of drug pricing was provocative and was not sustainable. And we knew that the genie is out of the bottle and is not going back in. I think the way that the president envisioned it and eventually the HHS negotiated, particularly the Medicare part of it, they found a plan that can become realistic and can leave behind us this situation. And that's exactly what was reflected in the 4 requests of the President Trump, and we fulfill all 4 of them.
Why are drug prices still so high?
Because we have, in the US, we have a specific situation that the consumers are paying for their medicines like if they don't have insurance, although they have, and it's a very good one. That's not the same when they go to hospital, that's not the same when they go to MRI, but with medicines, they have very high deductibles and very high out-of-pocket co-pays. That is a unique situation here, this middleman. Of course, also, medicines are expensive to make, and the cost of developing drugs is getting higher and higher and higher, and that also plays a role. But the consumer experience pricings that on average are double than the prices that we charge in the US.
You work with, of course, with President Trump rolling out the COVID-19 vaccine, now this latest on helping to bring drug prices down. What are the differences you see in him, and why do you think he's so focused on lowering prices?
I think lowering prices was also on his mind, very high on his mind in the first term. And he made several efforts to be able to address that issue. The difference in this second term, he is more experienced in managing the government, and he is very, very determined. And you may disagree with him or agree with him, but he's a disruptor. He changes things that people thought you can't change.
Is there lots of focus on Mr. Kennedy and his views on vaccines. Those views, do they provide any long-term risk to a business like Pfizer?
Look, not long-term, because we are not going to go back to Pasteur times, right? Vaccines have saved the world and will continue doing that. In the long term, it's the most cost-effective medical healthcare intervention. Now, I interacted a lot with Bobby Kennedy and the secretary, and after he got elected, clearly that was not going to be my choice for HH as secretary, but it's not my choice. It is the president's and it is the Senate's, and he got confirmation, and I try to work very constructively.
Do you weigh in with your recommendation with the president? Do you weigh in, or
no? I don't. No, of course not. But the president makes his own decisions. But I found my collaboration with him in many, many areas very productive. And a good example of this is the HHS agreements that we did now, that were announced in the White House on vaccines and on some scientific ways regarding FDA approaches, etc. We have very big disagreement, but we discuss with that, and I prefer that we spend more time working on things that we agree rather than working on things that we disagree, because the things we agree are many and very important, and we can agree to disagree on the others.
Does the pharma industry still need China? Like, how reliant are we still on China to get key components to make drugs? And I want you to talk a little bit about your investments you're making in the United States, because you're spending billions of dollars in this country.
Yes. I think there are a lot of medicines that are dependent from China right now. Pfizer doesn't have any dependency from China. We don't export from China anywhere in the world, and we don't import in the US anything from China. So we don't have ourselves this problem. But we have a very major manufacturing network in the US already. We have 11 manufacturing sites and 2 gigantic logistics centers, 13 in total, in this country. A lot of them in the South and in the Midwest. They are the locations. We're very happy with the quality of production that you can get, the quality of the people. And now, based on the agreements that we made with the organization, we are going to invest more in manufacturing and, of course, more in research in this country. And we committed $70 billion.
$70 billion.
$70 billion of investments in the US alone over the next, let's say, 3, 4, 5 years. And I think that one of the good examples is that we will build the manufacturing capacity for Metsera here in the US, so that we will be able to provide the US patients from US produced anti-obesity drugs.
I wanted to leave a little time for AI. We're having a lot of great, interesting AI chats here at Invest, talking to several folks on how it might impact retail. But how do you see AI impacting the future of medicine?
I think it will be a profound impact. I think there are things that AI is ready to do now, and we are taking big advantage of that. AI cannot do everything, but I think it can do today more things than most companies are utilizing. I think the name of the game will be how companies will be able to integrate into the processes, into their operations, business processes and operations, the AI. And that will be a challenge, as with every new technology, but it is disruptive because it will change the way that we work, will create anxiety to people, there will be resistance and all of that. So we have a very open and educational session with our employees. We make sure that they are well trained, they understand the language of AI, they understand what they can do with AI, and we see that instead of resisting, they are inviting AI to come in. But there are things that technology cannot do yet, but they will. And this is where the most exciting things in drug discovery and development are coming.
Where do you think the next big breakthrough is, and will AI have a part in it?
I think target identification means to identify what is this site of the cell of the cancer that creates resistance to medicines, and you have metastasis as a result. this is something that AI, we do now with biological science. AI can help us do it faster and better. Once we know the target where we need to hit, we need a medicine to do that. And AI can design medicines and molecules that they can fit the target much faster and better than our own thing. And I can go on and on. For example, we are testing right now a lot of things in animals to make sure that they are safe before we use them in humans. A lot of that can be replaced in silico with models that they can have very accurate prediction of how the molecule will behave in terms of toxicology, pharmacodynamics, etc. Clinical trials. So it's so big, the spectrum of things that can happen, and so exciting.
In the time that we have left, Albert, this is the first time you and I have talked, but I've been following your work
That was a big mistake.
I know, right? I agree with you, but I've been following your work for years, and I still remember when I saw that first photo of the COVID vaccine coming out or getting sent away or sent out from I think it was a UPS trailer, whatever it was.
Yes.
I think it takes a special leader to lead during a situation like that, and of course, the past few years haven't been easy. Like, what is it about your personal story? Like, who are you as a leader, and why are you, how have you been able to overcome these challenges? What drives you, I guess?
Look, I care about what we do, and I'm very optimistic. If there is something about me as a leader that it is on the very high end of the spectrum, it is my optimism. I think that nothing is impossible, and I try to convey that to my people. Sometimes that can lead to mistakes, and that's why I always surround myself with people that they are not optimists, so that they can land me to reality.
Where does that optimism come from?
I think comes from the story of my mom, that she is a Holocaust survivor. She was set in front of a fire squad, and the last moment they pulled her out because her relatives paid bribes, to Christian relatives, by the way, that paid bribes to Nazis so that she will not be executed. And she kept, the Holocaust survivors, they don't speak about those things, what they endured, because it's painful or they're afraid. My mom did, and he was talking to me always about what happened to her, but always with, not in terms of we need to hate, we need to take revenge, look what they did to us, never like that. He was ignoring Nazis. She was talking how her rescue was a celebration of life, that nothing is impossible, that she was in front of her firing squad and she survived. So she wouldn't allow me to go and complain that I can't do my homework. Go and do it, she would tell me. Sure. You can make it. I think that is what gave me most of my optimism.
Thank you for sharing that story. And this is a good example why I love having this event. Dr. Albert Bourla, good to see the work you're doing over there at Pfizer. We appreciate it. Thank you for coming down here.
Thank you, Brian. Thank you very much.
All right, I'm going to send it over to our very own Julie Hyman for a check of the markets. Julie, over to you.
Yeah, Albert helping put things in perspective there, in terms of that story. We are indeed watching the U.S. markets here, even as we're having all of these big, impactful conversations. We're seeing stocks sell off today. Now, President Trump did sign the bill to reopen the government, and we're watching a lot of key headlines, including Disney results, that government shutdown now ending. But really, the big story continues to be the rollover in big tech stocks. Trader Talk host Kenny Polcari is here with me. Kenny, this is sort of now resuming. We've seen it sort of pause on the tech sell-off, and then it just ends up resuming.
Right, and so I don't think anyone should really be surprised, right? We saw this rally into yesterday, all this excitement. We started over the course of the shutdown, right? We were up, we were down. There was concern over valuations, and then there weren't. Again, it's once again concerns over valuation, right? That the market is stretched, tech valuations are stretched. I'm not necessarily surprised to see this. I think we're going to continue to churn right in here. I don't think it's the beginning of the end, though, by any stretch.
I mean, if I look at the stocks that are down the most today, I'd look at the ones that are really have been the big momentum gainers,
Correct.
right? So Robinhood, Tesla, AppLovin, Palantir, they're also the ones where we've seen in some cases some short sellers come out and say, you know what, these stocks have gone too far.
That's right. And so, Michael Burry being the biggest one, right? Making that big splash
recently,
like Palantir and all that. But that doesn't surprise you, right? Because we've been talking about how they're stretched. So, of course, you're going to get people that are going to play it from the short side because they obviously also think it's stretched and they want to try to make money if you see a pullback. And on days like this, they are in fact correct because they're going to make money if they're short. I wouldn't necessarily view it as an issue, a longer term issue. I think it's just a trading trading, right? We've seen it over the last month and a half when the shutdown started.
Yeah.
The Nasdaq was actually up 3% as of last night. So, but we had all that commotion in the middle.
Yeah.
And I think that's more of what we're getting, commotion.
Well, and as the shutdown ends, we're not going to get the spigot of economic data doesn't turn back on like that.
No.
Kevin Hassett, the economic advisor, saying today we're probably not going to get all
Some
of the
of it,
data, right? At the same time, we have Federal Reserve speakers out. Susan Collins, you flagged to me saying she's not ready to cut in December.
She came out this morning and she said she's in the no-cut camp.
Yeah.
And I think that's going to be interesting because I think that's going to be the next catalyst for the market is what's going to happen behind the Iron Curtain at the Fed, right? What are they really going to decide? There was pressure maybe to start to put 50 basis points back on the table because we've been lacking economic data. There's concern about the labor market maybe spinning out of control. We haven't gotten the NFP report now in 2 months. We are going to get one next Friday to replace the one we missed. But there's some concern about the labor market kind of weakening more than maybe what the market expects. And so while they put 50 basis points on the table, I still don't think they're going to do it. And I think if they do, you have to be careful because that might send a very different message to the markets that maybe now they're much more concerned or they're behind the 8 ball. And that's actually not a reason to buy stocks. That would be a reason to be more cautious.
Be careful what you wish for.
That's right.
In other words.
Yep.
All right. Thanks, Kenny. Ahead, we're going to have a deeper conversation on what to expect from the market and the economy in 2026 with an all-star lineup that is coming right up.
All right, welcome back to Yahoo Finance Invest, and we are streaming live on TikTok. I encourage you to go to TikTok, go to Yahoo Finance, watch the live stream, interact with us. I'm really enjoying all the questions you're feeding to us about this event. We've had some amazing conversations. Just got off with Pfizer CEO Albert Bourla. Wow, what a conversation. Go to our landing page. You can check out that chat. I'm just blown away by what Pfizer is working on. All right, having said that, the global economy is rapidly evolving from shifting monetary policy to inflation pressures and structural changes thanks to technology. And the backdrop, record-setting markets that are sparking fears of a correction or even worse. Here's what Allianz Chief Economic Advisor Mohamed Al-Arian told me when I asked him about risks like the cockroaches some top leaders have warned about.
So let me just say, we will have cockroaches, but not termites. And this is a fundamental differentiation. Cockroaches are unpleasant. They come in groups, but they don't eat away at the integrity of the system. Termites eat away at the integrity of the foundation. So why are we going to have cockroaches? We're coming from a period where people have stretched really far for additional returns. They have been encouraged to do so by a strong economy, by very loose financial conditions. And some people went beyond their comfort zone and beyond their ability to do due diligence. So I don't think we should be surprised that we will have these accidents, these credit accidents. We'll have some economic accidents, but I don't think we're going to have any systemic shock.
That is, of course, a good thing. And when you mention potential economic accidents, what keeps you up at night? Well, what are you most concerned about for 2026?
So what used to keep me up was a trade war. But the US has been able to impose higher tariffs without triggering much retaliation. So that doesn't keep me up as it used to. What does keep me up is what's happening at the lower ends of the income distribution for households, where there is significant pressure. And what keeps me up is the amount of debt that has to be refinanced at higher interest rates. So those two things are potential areas of pressure, which would be made worse if we get a policy mistake.
Mohammed, you bring up a really great point. It's something I've been thinking on very deeply of late. We've seen tremendous wealth created in the market this year, and the bull market has continued. But we're not seeing it, I guess this goes to your point, we're not seeing it translate into that average U.S. household, that lower income consumer. Is that cohort of the U.S., are they in a recession?
They're near recession, and they are spreading this concern about affordability, which is not just an economic issue, it's a social and political issue. The first shock to affordability was, of course, the 2021-2022 inflation shock. But that was offset, Brian, by income transfers. Now we have inflation stuck at 3%. We have insecurity about future income. The Challenger report showed you that layoffs were surging. AI will change the workplace. And in addition, we have high debt and credit cards that have been maxed out. So there is real concern on the bottom bit of what people call the K-shaped economy. And this is not isolated concern. If the lower household incomes stop spending, not because they don't want to spend, but they're not able to spend, that will contaminate upwards for the economy as a whole.
So you think that pressure on the low end, so the high income consumer, the person that is exposed to the markets, they've enjoyed a good year, they're not immune to what's happening on the low end.
So they're doing fine. They're doing fine from an income perspective. They're doing fine from a wealth perspective. So I'm not worried about middle to upper class. I am worried about lower income households and their ability to continue to navigate this uncertain environment.
How do we bridge this gap? Because if you listen to the current administration, Mohammed, they are talking, the president has floated a potential $2,000 dividend. There's been interest in that. The one big beautiful bill was passed. More jobs are being created in the U.S. in terms of tech companies building out AI data centers. How do you bridge that gap between what's happening on the high end and low end?
So they also, you could have added to that list that they've moved on some very sensitive prices, gasoline being one, and the other one being some pharmaceuticals. So they are taking steps, Brian, but this has been long in the making. This is not something that is recent, and therefore it is deep-rooted. It is made more complex by two other issues. One is the difference between real and perceived, and the other one is the difference between relative and absolute. So it is a really complicated issue, and if you go through it, the bottom line is it will take years of effort, both on the income side and the price side, to get us out of these situations.
I want to leave enough time in this conversation, Mohammed, because you are known as a foremost thinker on Federal Reserve policy. It has been quite the year for all things Federal Reserve, of course. Attacks from the Trump administration. We're coming up on the end of Chair Powell's tenure. Where is your head at as it pertains to the Fed in 2026? What is a new Fed chair? What will they bring? And where do you see the ultimate end game for rate cuts this cycle?
What a new chair will inherit is a divided Fed. And it's divided by two things. One is whether they are sensitive to the employment side of the dual mandate or to the inflation side of the dual mandate. Both are flashing yellow right now. So it does matter where your bias is. And what we see is that people are on both sides of this divide. The second thing that they will inherit is a division between people who are totally comfortable being backward looking, so-called data dependent, and those who realize they also need to be forward looking. They need to have a strategic view of the economy, and in particular, Brian, of something you've been talking about a lot, AI and its impact on productivity and growth. So what a new chair has to bring is a unifying narrative. And I think that narrative has to be forward looking. And the new chair has to have a view as to what the future economy looks like. I am a great believer, as you know, in the promise of AI. If we get diffusion right, we will have a significant productivity increase. And as a result, monetary policy will be able to be looser than it would otherwise have been.
Do you view the attacks on the Fed and what it does for the administration, will that leave lasting damage on this institution? And if you do think that's the case, what does that damage even mean to markets?
So I believe deeply in the independence of the Fed, deeply, that I think a Fed with policy autonomy is the best thing we can have. But I also believe, as you know, that this Fed went to sleep. There are many areas of reform that require attention. There are many best practices that from the rest of the world that we should be looking at more seriously. And there's lots of hard questions that we need to ask, including what is the right inflation target in a structurally changing economy. So the good news is you're starting to hear debate from within the Fed. You've had two Fed officials, as you know, come out and saying, maybe we should have a range for inflation, our inflation target, not a point estimate. You've had another one come up saying we target the wrong intermediate policy variable. So I'm encouraged by the fact that the Fed itself is now finally talking about reforms. And that is something that, if you look at the 5 candidates on the short list, all of them understand that you need to reform the way the Fed operates. Otherwise, the Fed will continue to be behind. And if you look at the recent years, not only have we had decisions that were too late, but we've had a culture issue. We've had 5 officials that were accused of irregularities. So I think it's really important to reform this Fed. And what this political pressure has done is it has made certain Fed officials realize that it's better to reform from the inside than to have it imposed on you.
The 5 contenders you mentioned on the short list for the next Fed chair, do you have confidence that they will keep the Fed independent?
I do. I think all of them understand the history of central banking. They understand the importance of keeping the Fed independent, but they also understand that an independent Fed needs to be an accountable Fed, and an independent Fed needs to reform itself to keep up with changes. It is striking to me, Brian, that we don't have external members serving on the FOMC, like the Bank of England does. So we end up with groupthink, and that groupthink ends up by the Fed being behind. We saw that in 2021, 22, and we've seen it again this year. So there are things that can be done and should be done. And I think that all 5 realize that an independent Fed is critical, but it doesn't mean a Fed that goes to sleep on how it operates.
Do you think the 2% inflation target should be scrapped?
I don't think it should be scrapped. I think it should be changed. I have been of the view that a better inflation target is a range, not a point estimate. A point estimate suggests precision that is elusive. Second, that range should be higher than 2%. It should be the 2.5% to 3%. And what is undeniable is that we are at a stable 3% inflation, and that hasn't in any way unanchored inflation expectations.
Out of the 5 candidates, Mohammed, look, I agree with you. These are incredibly qualified people. Of course, shout out Rick Reeder, friend of Yahoo Finance. We all know him very well. What do you think their biggest problem they will have to solve? That first 6 months on the job of leading the Federal Reserve after a long tenure like Jerome Powell has had, what do they need to get right out of the box?
Shifting the Fed from an excessively data-dependent, backward-looking institution that is reactive to one that has the confidence to take a strategic view and be proactive. That's going to be a major change that is really needed, has been needed for a while, and that hasn't happened under Chair Powell.
I wanted to get back to what you mentioned on AI and productivity. You could see AI chatbots, at least for now, this current wave of innovation is already starting to drive a lot of productivity. How much of a risk is it to jobs around the world? How concerned are you?
I'm concerned mainly because of the corporate mindset, Brian. If you look at the promise of AI, there is a labor displacement risk, and there's a massive labor enhancing opportunity. And the worry I have that with the exception of a few companies, the mindset right now in corporate America is about cost minimization. AI is viewed as a cost minimizer. What AI really is an enabler, a productivity enabler that gets there from better work and more work. And I worry a little bit that the mindset is too focused right now on cost minimization, because the real promise of AI is not labor displacement, it's labor enhancement.
I told myself coming into this, Mohammed, I didn't want to be that guy that asked you about a bubble. I just think it doesn't capture the nuances it deserves. So let me, if I can frame it a little more academically, how concerned are you that AI stocks are grossly overvalued?
So let me share the work that I've been doing with Mike Spence, a friend and a Nobel Prize winner. We believe that we are in a rational bubble. So yes, there are elements of a bubble. And there's three elements in particular of this bubble. First, the frontier, those working on foundational models. Not all of them are going to succeed. And yet all of them are attracting significant investment. Second, diffusion isn't being talked about enough. Diffusion means getting AI into the workplace in an orderly fashion, in a comprehensive fashion. We don't have a diffusion policy so far. Other countries, China does, UAE does, we haven't. We've got to get diffusion right. Otherwise, the promise of AI is not going to be fully realized. And then you and I remember the dot-com era. We remember companies simply putting a label on what they do and attracting investment. Well, that label today is AI. So there are elements of a bubble, which means that people will end up with losses. But the aggregate value of what's being created is significant. And therefore, the rationality part comes in, Brian. It makes sense to take a venture capital approach to AI. The payoff is so large that it is rational to have multiple investments and to overinvest. So the good news is that it's a construct that will make us more innovative, more competitive. The bad news is there will be tears, there will be losses, because elements of it are elements of a bubble.
I wanted to leave Invest viewers thinking with one deep thought. And let me come at you with this question, Mohammed, before we get going here. If you were writing a short message to policymakers right now, one key action they should take, what would it be and why?
That realize that our future is going to be at the tails of distribution, not in the belly. You know, for a long time, we grew up with unifying themes, the Washington Consensus, globalization. We are now living in a world of fragmentation, in a world that structurally changes. And what happens at the tails are going to determine where we end up. So don't get fooled by a normal distribution, a bell-shaped distribution. Realize we're in a multimodal world.
Coming up at Invest, the 2026 insight you can't afford to miss. Get the analysis on the economy and market to help you make investment decisions in the new year. And later, I'm getting the breakdown on all things crypto and prediction markets with Robinhood CEO Vlad Tenev. You do not want to miss that chat. For real, I'm serious. Don't miss it.
The U.S. economy is facing a challenging environment riddled with worries over inflation, large deficits, and monetary policy pressures. So how do Americans feel about the economy right now? Well, we took to the streets of New York to find out.
My biggest financial concern right now, probably staying afloat, like paying rent and other expenses and food, just trying to get by.
Everything is more expensive than it used to be. Rent prices in New York are going crazy. The job market is looking really tough right now. I know a lot of new grads who are having a really hard time getting jobs. I think that's a good sign of the economy going down.
Everyone is confused about the tariffs changing, not knowing what the price of their goods are going to be.
We just heard their thoughts from the everyday consumer on the economy in a year that has been weighed down by uncertainty, yet the bull market entering its fourth year despite lingering risks. We've got a lot to unpack here at Invest as traders aim to build even more wealth next year. So let's dive right into what's shaping the financial landscape with ADP Chief Economist Neela Richardson, Truist Chief Investment Officer and Chief Market Strategist Keith Lerner, and last but not least, People Inc. Chief Business Editor, that would be Caleb Silver. Welcome to you all. Neela, I will start with you as the resident economist on the panel. Maybe start big picture, Neela. You know, this interesting dynamic this year where, okay, cooling labor market, but GDP has been hanging in there, right? I mean, tariffs, trade, Fed uncertainty, it's hanging in there, it's resilient. And I'm just curious to get your take on that dynamic, Neela, and whether you believe that's going to play out the same way in 2026.
Yeah, so the labor market has really been holding hands with the consumer this year. And actually for the last several years after the pandemic recovery, we have a relatively strong labor market. It's been called low hire, no fire. I think it's been static. It's been less dynamic than we're used to, but we haven't seen a lot of outflows or inflows. What we have seen, though, is that the hiring momentum has slowed quite a bit since the beginning of the year. So yes, the consumer is still well supported by a functional labor market. That means they're going to keep spending, but you can already see from the tape you rolled, there's an uncertainty cloud over that spending. And that uncertainty is strongest for low-income, low-wage consumers. So even though we have an economy and a consumer that is strong enough to keep that economy growing, it may not be strong enough to keep the job creation flowing and that hiring momentum. Yes, strong enough to spend, but not strong enough to get those mom and pop businesses to hire yet another worker when they're already facing a lot of uncertainty.
Keith, I want to bring you here as well. Your outlook for the economy next year, what do you see, Keith?
Well, a punchline is an uptick, and it's a modest uptick. As you just discussed, it is a two-speed economy. It's a two-speed stock market as well. But the way we're thinking about things and why we expect at least a modest uptick is based on three things. One, we do expect the Fed to cut rates modestly over the next year, so that should be a positive. We have this tax bill that was passed. We should see some incentives and some positives in the first quarter as far as for the consumer and also businesses. And then hopefully we'll also have a little bit more clarity on tariffs. So you put that all together, that suggests to us a modest uptick, maybe a little bit above 2% as we move into next year.
Caleb, I want to get you in as well, because you have a unique insight, Caleb, into the retail investor. When you're surveying all those fans over in Investopedia, how would you broadly characterize investor sentiment right now based on your survey work? I mean, is it optimistic, Caleb, cautious, downbeat? What do you see?
Yeah, cautiously optimistic is how I would describe it, and why not? We are seeing many all-time highs already so far this year. We do have the wind at our backs in terms of corporate profits, and we've been seeing that play out in the earnings numbers, but they're also concerned about the underlying economy. At what point does a potential weakness in the economy translate into weakness in the stock market? So far, they're still dancing in opposite directions, and that's kind of, they usually move in different directions or usually not down the same path. But right now they're wondering, is this going to last? And they're worried, just like some of the people you talk to, about their own personal finances or about their neighbors' personal finances. In the stock market, their assets have done very well. We got more millionaires than ever. We got more 401k millionaires than ever. We have more retail investors invested in the stock market than ever. That's good. That's a way to generate wealth. But maybe at some point, this diversion between the two, the economy and the stock market, catches up to the stock market and affects overall mood.
Neil, Keith brought up the Fed there. You say something interesting. You say the time for easy answers for the Fed is over. What did you mean by that, Neil? What makes this environment more tricky?
You know, I call it the muddled middle. It's easy to know what to do when inflation is very high. And it's easy to know what to do when there is very low inflation, or going back to where we were, before the pandemic, when the problem the Fed was facing was too low inflation, not too high inflation. Imagine that.
Right.
But it's hard to know what to do when both sides of your mandate are active and you're trying to thread a needle through a very narrow hole. And that's exactly where the Fed is today. They have projections that inflation stays above their own targets for the next 2 years after being above target for the last 4 years. And consumers are very sensitive to price increases in a way that they weren't 10 years ago. So you add that with the slowing momentum, still a pretty solid labor market, but a slowdown in that hiring momentum, you get a very tight spot for the Fed to maneuver going forward.
I've seen some economists now, what is your take on this? They talk about the labor market. I think it was Ed Yardeni, and he said, the issue with the labor market, he said, was on the supply side, boomers are retiring, they're not easy to replace, you got stricter immigration policies. On the demand side, he pinned a lot on AI. A lot of bosses, he thinks, are thinking, I can reduce headcount but boost productivity. His point was, Dr. Ed, he doesn't see how a Fed cut addresses any of that. What do you think?
I think that is the key issue. There is a conflation of things that are short-term in the making in the business cycle and structural, whether it is AI exposure and impact, demographics, immigration, uncertainty. These are structural changes to the economy, and the Fed acts short-term. That's why at ADP we actually started producing just 2 weeks ago a weekly index of employment change. That way we hope that investors can have a real-time perspective of what's going on in hiring, because there is so many things happening all at once.
Keith, turning to that Fed meeting next month, it's interesting. Some of our central bankers, when you listen to them right now, it doesn't sound like that cut's a sure thing. Some of them seem to be saying, listen, that 2% target, it's a target. It's not a suggestion. I just wonder if next month you don't get the cut, how would the stock market react, do you think?
Well, right now the market is pricing in about a coin toss, and I think that's probably about right. And to your point, they have scar tissue from the inflation before. They're in a tough position. So I think initially you could have a bit of a hit, and you probably would see that more in the small cap and more of the interest rate sensitive areas. But I also think that for this market, the most important thing isn't whether the Fed cuts in December or January. I really think it's about corporate profits. And what we've been saying all this year is that the North Star of this bull market is corporate profits. As the stock market has made a new high, corporate profits has followed. Now we have to see, is that sustainable? A lot of that is driven by tech and AI, but we have seen that pouring out as well. So I overall, again, I think the interest rates moving down matter on the margin, but it's not the make or break for the bull market. I think profits ultimately will be, and if we do see a little bit of an uptick or this muddle through that you just discussed continues into next year.
Caleb, when you survey folks about the Fed, I'm interested, what feedback do you get? Are they fans of Jay Powell? Are they critics?
Largely in support of how the Fed has handled monetary policy and want the Fed to remain independent. That is one overall sentiment that they think most of our readers, who are individual investors, have. They really want the Fed to remain independent. They think that's super important. But to the point that these guys have made, it's not really necessarily where the rate goes from here. The rate is the rate. I think it's about corporate profits. And when you think about how investors are perceiving the stock market right now, the most important metric probably is revenue per employee. And that is driven by AI and other advancements. But if you look at the best performing stocks in the market, they have the highest revenue per employee. Look at NVIDIA, it's $3 million per employee for that company. And when you look on down the list, that's what's important. That's what's been driving the stock market and stock market returns. That's not a great sign for the labor market long term, if that's what we're going to be seeing going forward.
Keith, every bull market has a theme. This one's been AI. Caleb, they're talking about NVIDIA. I feel like I have to ask you, and it's a top of mind question for so many investors. I'm sure your clients are asking you, AI boom, AI bubble. What do you tell them?
Yeah, so you're right. Every bull market has a dominant theme. AI and tech is this market's bull market theme. The biggest question I'm getting is, are we in a bubble? And our answer is no. When we look at the data, at least that's what the data tells us. So what are we looking at? Well, there's a couple of factors, but one is valuations by themselves. Valuations are rich, but if you look at the S&P technology sector, We're trading around 30 times. That's expensive, but during the bubble, it was 50 times. Another statistic to take away the valuation component is just saying price. Like a bubble has a momentum aspect to it, especially towards the end of it. On a year-over-year basis, the technology sector is up about 30%. During the bubble period, it was up more than 100%. I also started my career in the mid-90s, and when people would call up and they wouldn't know the stock name, they would be saying IOM or JDUSU. Most of my questions today are we in a bubble? That wasn't a question back in the late 90s when people were leaving their job to be day traders all day. So it doesn't mean we can't have a correction. We had a big run. We're seeing a little bit of nervousness. But ultimately, I think that underlying trend for tech is still intact, but we're taking a breather. We're seeing some rotation, and there's just some concerns. But I do think money will ultimately come back to tech because that is where the secular growth is.
This AI boom bubble debate, though, Keith, there is an interesting question. I love your take on this, which is when you see this AI infrastructure build out, I know some folks have been saying, well, if you're funding that with cash, that's one thing. But now if I'm watching companies tap debt markets to finance it, that's a yellow caution flag. I'm curious, do you agree with that?
I mean, on the margin, the story for tech was they were asset light and cash rich, so that story has changed. So on the margin, there's more risk as you take on more debt. So I think we have to take that into account. But we also have to think about, if you listen to the leaders of the industry, this infrastructure build is huge, and there has to be a lot of spending to do that. Going back to the 90s, one company that came out a lot, you probably remember this, is Amazon. Like every quarter, people were saying, how much are they spending? How much are they spending? And they weren't profitable. Well, ultimately, it worked out, and they needed to spend that money, but they went through some ups and downs. So I think that's that's what we're going through right now. We don't know exactly what the future is. We know that this AI, I think, is real, and the rate of change is so quick, so it's hard to get your arms around it. But ultimately, I think there are going to be a lot of great things. But when you have announcements or some concerns about debt, and you have higher valuations, investors, sell first and ask questions later. So I think you have to go with the ride. We saw that kind of bumpy ride even during the pre-bubble period. But ultimately, I think a lot of things are going to come out of this in a positive way for corporate profits and productivity that will boost these stocks.
Neil, you look through AI through a different kaleidoscope, right, as an economist. How quickly is AI impacting the labor market? Is it even faster, Neela, than maybe we would have anticipated?
It is having an impact, but I think it's important to see the full context of the labor market. 3 in 4 U.S. workers work in a small company with less than 250 employment count. So while big companies are driving the headlines right now in terms of AI impact, it's smaller companies that actually produce the hiring. And so what we're waiting for, the stock market is a forward-looking discount mechanism. They're seeing ahead into the future. And what we're looking for in the real economy right here, right now, is that impact translating into the smaller businesses and to the worker. And where we're seeing the biggest impact right now is early career. And I'm sure you've heard all of the anecdotes. It's harder for college-age students to get jobs right now. There are some things that AI is taking over in terms of that entry-level role. But when you look at the kaleidoscope of tenures, it's actually likely to augment jobs as well. So that path to the future that the stock market is already seeing, in my view, will be jagged. It will depend on the industry. A lot of consumer-facing industries are where we're getting job gains right now, like healthcare, home health aides. Those kinds of jobs are still going to be very, very much in demand, even though they might be the last to get AI exposure and technical advancement. So it's going to waffle a little bit more in the real economy than what we're seeing in the stock market.
Caleb, how excited are those Investopedia readers and fans about AI?
Pretty excited, and when you look at their portfolio, it looks a lot like the top stocks in the stock market. That
what do they like?
Full of AI. They like the stocks that everybody likes, which is NVIDIA, which is Palantir, which is Meta, which is Alphabet and Amazon, but they broaden that out. And if you look at all the companies spending this $380 billion this year, going up to $700 billion, it's those companies plus a bunch of companies on the periphery. You got a Salesforce in there, of course, Oracle's in that category as well. Palantir, obviously a very important stock for a lot and widely held for a lot of investors right now. And when you ask them what stocks they would buy and hold now for the next 10 years, it looks very similar. So very faithful to the stocks that they've owned for a long time, and big believers that this is going to stay that way for a long time. We live in the land of the giants in the stock market. They think that's going to continue for the next decade.
If that's what they've been buying, I'm just curious, what have they been selling?
Yeah, they've been selling. Eli Lilly was a big stock that was on the sales list, and that stock now at a 52-week high. So sometimes our timing as retail investors is not so good. They're concerned about some of the chip stocks, and some of those chip stocks have had some ups and downs. Very volatile sector right now with all the demand and all the deals. But by and large, they buy, hold, and keep their favorite stocks, and I don't think that's going to change.
Keith, as we head into 2026, we're talking all things AI.
Yep.
Investment implications there, are you telling clients, hey, listen, stick with the Mag 7, stick with tech? Where do you want to be overweight?
So we still want to be overweight tech. Something we just looked at recently is each bull market, who is the leader, and does that leadership continue to the end? And what we found out, it historically does. So in the 90s, tech's relative outperformance peaked in March, which is when the market peaked. If you look at the 2000s, which is more of that global industrialization, emerging markets was leadership. It was leadership until the end. And even before, we had the bear market in 2022, technology, rode that to the end. So ultimately, we think if you believe we're still in a bull market, which we do, we think tech ultimately resumes that leadership. But on a short-term basis, just like we're seeing where it gets, semiconductors up 100% off the lows, technology up 60% relative to about 35 for the S&P. It's not going to be a straight line. You're going to get tested. I'd be interested to see the sentiment after the last couple of days. I know other sentiment surveys I looked at this morning, it showed bearishness at the highest level since May. And we haven't had, in the grand scheme of things, a big correction, but we are seeing more of a correction in those technology stocks. So I wouldn't be surprised if sentiment shifts even quicker now, because a lot of people own these stocks.
That's
and they're
right.
seeing them hit.
What do you want to be underweight, Keith?
I think overall, there's still areas like real estate we're kind of mixed on, even though it's a muddle through. I don't know rates are going to move that quickly. We're still underweight staples. I will say it's moving towards an extreme because we are expecting an uptick in the economy. Staples tend to really outperform when you're starting to slow down, so we still want to be there. And then our process is very tactical. We look at relative earnings momentum and relative price along with valuations. We were more negative on healthcare earlier this year. We did upgrade that about a month ago. I know that's becoming like the hot sector all of a sudden, but it underperformed by about 50% over the last 3 years. And now as you get some of that political noise, maybe a little bit behind you and expectations so low, I think there's more room for that to go as well.
Keith, Neela, Caleb, that was great. Thank you all. Appreciate it.
Thank you.
Now let's send it over to Jared Blickery for a look at the markets. Jared.
Well, thank you, Josh. We're looking at a bit of a down day in the markets, and we can see the Dow Jones Industrial Average is now down 450 points, or about 0.9%. And we just took another leg down there. So this is actually the worst day for the Dow in several weeks. I think 4 or 5 going back about a month. And you can see that on the chart there. NASDAQ Composite, the losses in tech are the worst of any other large cap sector today. That tech heavy index is down about 2%, and the S&P 500 down about 1.25%. I'm also tracking the small caps. A lot of smaller issues today that have done well recently are selling off. And for that matter, it goes for the large caps. But we're seeing that small cap index down about 1.7%. Meanwhile, let's take a quick look at the VIX inching closer to 20. That's just one of those big psychological levels. When the VIX goes up, sometimes that means investors have more caution. And a lot of that times that happens when you see the market go down. Here's the 30-year T-bond yield. That cost of money is up about 2 basis points to 4.69%. And I want to jump over to the sector action. I said tech was the biggest loser on the day, exactly down about 2.20%. But also the other mega cap sectors not doing very well. XLY down 1.86, XLC down 1%. XLC, by the way, has Meta and Alphabet in it. But there is some green today. We see healthcare XLV up 0.8%, and energy close on its heels, also seeing some gains in consumer staples. And here is the big red board for you, the NASDAQ 100. NVIDIA down the lowest now in several weeks. We'd have to see that carry over into the close for that stat to be true, but Tesla down 6.5%, having its worst day in months. And you can really see this if we just zoom in on the semiconductors here. A lot of dark red in that space. And then in software, the other side, we see red, but not as much dark red. And for that matter, Cisco is in the green for about 4%. Do want to send it and close on the Dow here. And we see a little bit of green in the energy sector. Chevron up over 1%. There's that Cisco trade. And also some of the staples doing well. J&J up 0.4%. But the big one loser today in the Dow is Disney. That is down 9% after that expensive studio line came in on their earnings report. All right, keep it here on Yahoo Finance. Here is a look at some of the key guests still to come. We have Starboard Values, Jeff Smith. Robinhood CEO Vlad Tenev, and Eric Trump. We will be right back.
And now it's halftime here at Yahoo Finance's Invest. We've covered some of the biggest trends driving the market, including in-depth chats with Pfizer CEO Albert Bourla about the future of medicine, buy now, pay later, giant Affirm CEO Max Levchin, and Palantir CEO Alex Karp on the next chapter of AI. You can watch all these interviews on our Invest page on the Yahoo Finance website and on our app. Now let's take a look at some of today's trending tickers. Brooke, what are you watching at the NASDAQ?
Brian, well, certainly I'm watching all three major indices see a bit of a sell-off this morning. We have the NASDAQ leading that momentum lower. The NASDAQ down more than 400 points at midday trading session here. The Dow also down about 400 points, and the S&P 500 down more than 1%. As you can see, a bit of a sell-off here. That's largely led by a rotation out of tech. Taking a look at what exactly is moving within the NASDAQ, we do have NVIDIA on track for its lowest close in roughly 3 weeks. We also have Broadcom moving lower. Tesla down more than 5% the last time I looked. And that stock, if it stays down more than 5.15% today, that'll be the worst day for Tesla since July, now trading down about 6%. Also, Palantir, they're on track to see their lowest close since early October. Keep in mind, we did chat with co-founder and CEO Alex Karp earlier at Yahoo Finance Invest about the valuation of the company and the future of AI. But I also want to take a look at Disney, because that is dragging the Dow lower. It's down more than 9% today after the company missed on revenue, now nearly 9%, hovering around that, after the company missed on revenue in Q4 around weakness in its linear TV business, and also executives weighing in on the call about that potential deal with YouTube. And executives had said that this could go on for some time, and certainly we're looking for a deal there, and investors seem to be waiting as well. Back to you, Brian.
Brooke, thank you. Inez, over to you.
I'm watching crypto right now, Brian. We're looking at Bitcoin that's hovering above 100,000 per token, struggling to really make a meaningful comeback since that sell-off that you saw in October. Ethereum and Solana also slumping. The sell-off in equities, of course, isn't helping. That rotation in tech that Brooke was talking about is not helping. It's also not helping the Bitcoin miners that have pivoted to AI. Those are under pressure today. Bitfarms, one of the largest Bitcoin miners in the U.S., their latest quarter quarterly revenue missed estimate, but the company revealed a plan to wind down its Bitcoin mining operations and pivot fully to AI. So this trend that we've seen with other companies because of competition, price volatility, and Bitcoin's halving events that are cutting rewards, their margins have been squeezed. And so these companies are turning their data centers to service the AI boom, and it has paid off because these companies that you're seeing on the screen right there, year to date, they're up double-digit percentages, and in some cases, triple digits. So this pivot has paid off. Finally, want to mention newly announced IPO plans for Grayscale Investments. That's a digital asset management company, and they're in charge of Grayscale Bitcoin ETF. You've heard of these before, the Grayscale Ethereum ETF, and more than 40 products that give exposure to about 45 tokens. They will be going public. This is a big deal because this goes with the theme of crypto and crypto adoption here in the US as digital assets and mainstream finance, those are merging. Brian?
All right, thank you, Inez. Allie, you've been tracking a lot of the activity on social media.
Yeah, sure have, Brian. And there are a few key stories that are standing out on my feed right now. First being the government shutdown. This U.S. shutdown, the longest in history, 43 days, is finally over. And we have been asking guests throughout the day how the shutdown has played into their worlds. And Brian, you spoke with Ted Leonsis, who runs a massive sports empire in D.C. Capitals, Wizards, Mystics, Capital One Arena, Monumental Sports Network, all under his leadership. And he had a lot to say about the shutdown. He told us that his team stepped in during the shutdown, offering free game tickets and dining credits to federal workers. Also donated $100,000 to a local food bank. He said the teams feel the impact directly because they employ thousands of people in the community. He is very happy at this point that the shutdown has been resolved, although he did say that the government is only funded through January. So he hopes at that point cooler heads will prevail. But it's not just the shutdown making waves on social media. We also have some big news in the sports world. So NBC Universal, which is owned by Comcast, is launching a new cable sports network on Monday. Now, this channel will show games currently on Peacock. That includes the NBA, Big Ten football, Premier League, and likely Major League Baseball once an official right licensing deal is finalized there. And this comes as NBCU plans to spin off most of its cable properties, with the exception of Bravo, into a new publicly traded company that it's called Versant. So just yet another example of the wild changes that we're seeing within media that's making its waves on social. And then finally, Starbucks. It is Red Cup Day today. This is typically one of the busiest events for Starbucks, but that's not what's trending right now. It's actually the strikes. Unionized Starbucks workers in at least 40 cities are walking out, with 1,000 baristas across 65 stores participating. Now they're pushing for better pay, more consistent hours, and a resolution to ongoing labor disputes. The union saying that the strike could continue into the coming days, which will hit Starbucks' peak holiday season. That's not something that shareholders want to see, with shares down around 5% since the start of the year. So those are just some of the top trending stories on social media right now. And as a reminder, we are streaming live globally on TikTok, YouTube, Facebook. And if you don't catch us live, you can catch us anywhere that you get your Yahoo Finance content. So Brian, we'll send it right back to you.
Yeah, we are. All right. Thank you, team. Appreciate it. Coming up at Yahoo Finance Invest, we've got some of the top names in crypto. Robinhood CEO Vlad Tenev, Kraken co-CEO Arjun Sethi, and American Bitcoin's Eric Trump. Plus, we're taking a look at the rise of the activist investor. Josh Lipton and Julie Hyman will discuss the top corporate battles, and then I'll be speaking with noted activist investor Jeff Smith from Starboard. Psyched for that chat. And if you're just joining us, here's a look at some of the top moments you missed so far from Invest.
All these things we've been saying for 20 years, and you know what? They pissed off a lot of people in the league. I run into people all over America and quite frankly all over the world. People who have like normal means who are now rich because of Poundgy.
The math is pretty simple. We expect Bitcoin to appreciate about 30% a year for the next 20 years. There's no doubt in my mind Bitcoin will be a larger asset class than gold by the year 2035.
It was 9 p.m. in that AI party. It's now 10:30 p.m. But that party goes to 4 a.m.
There are elements of a bubble, which means that people will end up with losses. But the aggregate value of what's being created is significant. It makes sense to take a venture capital approach to AI. The payoff is so large that it is rational to have multiple investments and to overinvest.
It shook us all to the core because fans need to trust that they are seeing real-time competition and that the outcomes are fair.
Activist investing is booming on Wall Street. And Josh, let's talk about some of the numbers here. 61 new campaigns over July, August, September, which is up from 60 the prior quarter, but it's also up from 36 a year earlier. So what are we talking about when we talk about activist investing, right? They used to be called corporate raiders in the 80s. Basically, there are two types of investments, right, that a big investor can make. A passive investment where they buy a stake and they just kind of let it quietly ride, or an activist stake where they put their flag in and they say, not only am I an investor, I want you to change X, Y, and Z. Maybe I want you to change the board. Maybe I want you to change the leadership. Maybe I want you to change strategy, or even potentially put yourself up for sale. So that's what we're talking about when we talk about activism writ large.
Yeah, and so let's put a name to some of these faces. So one name we'd play, that would be Paul Singer from Elliott Management. Why do we talk about Mr. Singer? Because he's a powerhouse, right? Manages, I think it's like $76 billion at last count. I bring him up, Julie. I want to make sure I have this right. 2025 active. This year alone, they were involved in something like more than a dozen activist campaigns. Their campaigns dominate the top 6 battles by stake size, and it was in BP and Phillips 66. It wasn't just the energy sector. You had Honeywell, you had Pepsi, broad strokes. Some of the themes you were just mentioning is what they wanted, right? They wanted cost savings, they wanted divestitures, strategic pivots. I thought this was interesting, just in terms of performance. A stat from our old colleagues at Bloomberg: yearly returns average in double digits since their launch back in '77. Only 2 years of losses for Mr. Singer.
Wow, so it's a strategy that has worked for him. And there are a number of other big names within this space. There's some smaller upstarts as well, but you mentioned Paul Singer, Carl Icahn, who's been at the game a long time, Nelson Peltz as well, who has made his name in a lot of consumer-facing companies, for example. And then you have a somewhat younger generation of folks as well. Dan Loeb, who was involved in Yahoo way back in the day in an activist campaign. Sony, Disney, Bill Ackman. Listen, I had a lot of experience covering his Herbalife activist campaign. That one didn't work out necessarily quite as well.
Yeah, and then, listen, all big names. I think we have to also bring up some other names. Travis Kelce. All right, let's talk about Kelce for a second. Future, that's going to be a first ballot Hall of Fame tight end. He is also engaged, a little known singer. She's small, but she's gaining traction. This one was interesting. One of my all-time favorite stories this year, because when the headline dropped, I could time a double take. But basically, the story was he's teaming up with Jana, and they got Six Flags in their sights. And at first, you think, Julie, what is going on here? Is this a misprint? But then you read into it, and Mr. Kelsey, he's a fan of Six Flags. He's actually got a pretty wide-ranging investment portfolio, right? He's got beer and clothing and games. And I guess for Jana, the idea is too, hey, you link up with a guy like this, superstar, celebrity, that doesn't hurt. You get attention, you get eyeballs, you get awareness on the campaign.
Yeah, you do. I mean, and this chart of Six Flags is sort of emblematic of why activists get involved. I mean, look at the stock. The stock is down 67% this year. So an activist looks at that and says, I can do this better. I can help this company. When you see a return like that, especially potentially if you have some sort of emotional connection to, in this case, Six Flags or roller coasters or amusement parks or whatever, maybe you think you can help it. One of the other iconic campaigns that I always think of when I think of activism, we showed Jeff Smith earlier of Starboard when he got involved in Olive Garden, remember the parent company of Olive Garden, and he put in place lots of operational changes there, including salting the pasta water. You remember that?
I don't remember that.
That was a big one.
But that's a basic, I mean, come on, I'm married to an Italian, that's basic. Yeah. Let me ask you, here's a question for you. Do you think, since we're talking all things AI at Invest, could a theme develop next year where you have some folks say, maybe they go around to, hey, they say, you chip maker, you data center operator, you software name, you're investing a lot in this AI thing. Yeah. I'm not seeing the ROI.
Oh,
Where
interesting.
is it? Or am I too early? Maybe that's too early.
Should we start an activist fund?
Well,
Send us.
If you've got Kelsey's phone number, I'm in. Then I'm in. Yeah.
I'll see if I can dig that up. All right, we're going to send it back over to Brian Sazzi. Saz, you have Kelsey's phone number?
If I did, I'm not sharing y'all. Sorry, guys, not sorry. Look, I very much enjoyed your activist investing conversation. And as a former stock analyst, I have long appreciated what activist investors do. But there's one name that I have gravitated to really for over 10 years, and that is Jeff Smith over at Starboard. I still remember when he put out a legendary slide deck over at Darden. The whole board got wiped out, and Jeff created a lot of value. Up next, I'm going to be sitting down with Jeff Smith at Starboard. I can't wait to talk to him.
It's full-fledged studio going on.
All right, welcome back to Yahoo Finance Invest, presented by eToro. Starboard Value was a little-known $3 billion hedge fund when it moved on Darden Restaurants in December 2013. The firm took a 5.5% stake and sought a drastic overhaul of the company, including the end of Olive Garden's unlimited breadsticks. What followed was a dramatic activist battle that saw the departure of Darden's CEO and his entire board. It was one of the strongest signals sent to companies that activist investors mean business. Starboard Value, which oversees more than $9 billion today, always has its sights set on new targets. This year, Starboard has aimed to shake up Tylenol maker Kenvue, Corvo, and Fluor. Joining me now at Invest is Jeff Smith, Starboard Value CEO and CIO. Jeff, good to see you. You don't do a lot of these, so I don't know how I got you to do one of these. I've actually never seen you in person. I've exchanged a lot of emails.
Yeah.
So.
Well, I was hoping if I got here, maybe you would give me some tips for my fantasy football team.
No, we could. We got the team. That team is sitting over there on the other side of the room.
Yeah, I'm not doing so well, so maybe you have a couple of suggestions.
I do. Look, before I can even get into some of your campaigns, I think the people have to understand why you do what you do. What motivates you to launch a campaign?
Wow. So I think it's just part of who I am. I mean, from my standpoint, I look at the world, everything I look at, I can't help it. And I've learned this about myself, that I need things to be more efficient. I need things to be run better. It doesn't matter where I am or what I'm looking at. I have to analyze the best way, the most efficient plan forward. If I'm driving on streets, I'm mapping out in my head the most efficient way to handle the lights and where I'm going to make the right turn on red to avoid getting caught at a light. Way back when I was dating my wife, before she was my wife, she made a bet with me living in Manhattan that we couldn't get back to our apartment without stopping at a light walking across Manhattan. And then, you know, it looked like I was going to be in trouble. We got to an intersection, there was a red light, and then we went underground through the subway and up on the other side of the stairs. So from my standpoint, it's always thinking around corners, thinking differently, and trying to be more efficient.
This is in your soul, it sounds like.
It really is. So when we look at companies, it's not too different. It's trying to understand the inner workings of how a business works and whether it can be run better. Yeah.
How do you know what tactics to take?
I'm not sure that we always do know. So just to be fair about it, I think it's, you know, a combination of personalities and timing, seasonality. Proxy windows only open up once a year. So the most leverage any investor has is potentially nominating directors during a nominating window leading up to a potential annual or an annual meeting or potential proxy contest. So if you're a month before, 2 months before, 5 months before, 6 months before, you know, your tactics can be different. What the stock is doing, your tactics can be different. The behavior of the company can change our tactics. It's a feel thing. It's a knowing people thing.
I've long thought this, but I think CEOs are scared of you. Like, what do you feel about that? Why would they be scared of you? I mean, you're trying to unlock value at a publicly traded company. What is so wrong with that?
Not all CEOs are scared of us. Some of my closest relationships are very successful CEOs, and there's amazing mutual respect that happens there. I think it's more a matter of whether a company is performing well or a company's not performing well. And most of what we do is based in human nature. So if you can imagine yourself being a CEO that has risen to the top of a company because you've been there a long time and then you become the CEO of a large company, but you've missed your numbers for every year for the last 4 years, and the stock price is trading at a 5-year low, and then an activist shows up, you probably are going to be rightfully insecure. Now imagine yourself as a CEO that, you know, you aren't insecure. Maybe you're in the same position, but you aren't insecure. You know your business really well. You're very secure in how good you are and how smart you are. And you have been thinking about, put it in two camps, you have been thinking about how you're going to transform the business and perform better. So the one that's been planful and is really thinking about how they're going to transform their business and how they're going to perform better, it's probably several steps ahead of us, but maybe the market doesn't know it yet. Those CEOs, when we come and we approach them, are not scared of us. Instead, they welcome us in and they want to have a good healthy debate about what's going to happen for the future of the business because they've been active thinkers about it. And they're saying, okay, well, I've been thinking about that, but what about this? And there's a great dialogue that happens. And many of their ideas may be great, and maybe we accelerate those ideas. But if you put it in the other camp and you're the CEO that's been struggling for 4 years and you don't have plans for how to change the business, you don't know what to do better, and nothing's really changing, you're probably going to be insecure about it. So I think it's in two different buckets, and we see that fairly quickly, right? So when we make an investment in a company, if the CEO welcomes us in and wants to have this open dialogue about high-level strategy and what can happen with the business and what can be done better, it's usually going to go in one direction. If instead you have a CEO that's kind of putting up the walls and pushing you aside, doesn't want to have a meeting.
Our strategy is right. Like we know all the answers. Yes,
it might go a different direction because, Einstein's definition of insanity is true, and so we believe you need to make some changes if things aren't going so well.
How do you think you have changed the CEO over the past 10 years? How do you think you've helped just redefine that position?
I think, and I didn't expect this, but I think that corporate America, it's not just the CEO, but corporate America has been more active than they were before we started. Let's go back more pre-Darden. You mentioned Darden. So pre-Darden, so that's now going back 15 plus years ago, and then corporate America was slower to make changes. And actually one of our early investors, a very large allocator, made an investment with us early on, and we were talking, and they said to me, Jeff, we're making an investment with you, not just because we love what you do, we do, and we love your process, and we think the returns are going to be good, but the amount of money we're investing with you is really small compared to the amount of money we have in the overall market. And we just believe that activism is going to make the overall market more efficient. And they were right. That's what's happened. So what's happened is the direct impact we have on companies is so big, but the indirect impact that all activists have had on the market and making the market more efficient has been pretty huge. Board members think about whether their company is performing poorly faster, and they will take action faster. CEOs, because of that, in order to save their job and do a better job, will act faster, will make changes faster than they would have done before. And I think that's good.
Do you still view, let's boil it down, let's say the Fortune 500. Are Fortune 500 companies still bloated cost-wise from your perspective?
Not all of them are. So I think there's plenty that are efficient and run well, and then there's always going to be a subset of any group that are not run as well as the best performers. And so the great aspect of being an activist investor is whether markets are higher or lower, or companies in general are more efficient or less efficient, there's always going to be those that are not doing as well as some of their peers. And our job is to find the companies that are not doing as well as their peers, but where there's no structural reason why they should be underperforming their peers. It's more management execution, and get involved and give them this push, this catalyst for them to think about how they can run their business better.
I've never got to ask you this, but I figured, why the hell not? I might as well ask you here at an event. Going back to Darden, like after that whole ordeal, I mean, I had never seen anything like that ever before, from the slide deck, from the whole overhaul of the board. After that was over, what did you think? Like, what was the next few months of your career in life like?
After it's over, as soon as the proxy contest
you just won everything. The board, you got the board, the company got somewhat turned around. What did you think?
Well, so immediately upon winning the contest and replacing the entire board, which is the only time it's ever been done for a Fortune 500 company, I don't think it'll be done again. It shouldn't have been done then. I mean, there should have been a settlement that was done beforehand, but the board didn't take any action. There was a lot of pressure. This was a seminal moment, if not the seminal moment in activism, in that there were no excuses. Darden was either going to be a really good story or not a good story, and there were people on both sides rooting for different things, and I felt that. So the governance community and activists and shareholders that wanted companies to be more efficient were heavily rooting for us to perform really well. And there was a whole group of people on the defense side, as well as corporate executives, that would have loved to see it not go well and to point to that and say, see, that didn't go so well, activists aren't great. So from my standpoint, we went into that boardroom. I still remember to this day the conversation I had. I became the chair of the board, and standing in front of the board and saying to the board, okay, we did something here that's historic, but it's just the beginning. We have to execute. We have to perform. We have to do something great with this company. This is incredibly important for the future of the markets.
I think the first time I talked to you was on the day that you had hired Rob Lynch over at Papa John's, and it was a campaign that you did at Papa John's. You led as chair at Papa John's. Both of you got the business going in the right direction. Rob's now at Shake Shack?
Shake Shack, yeah.
Leading Shake Shack. Papa John's has been the news of late. A bungled deal process or whatever's going on there. Would you want to get back involved with Papa John's? Because after you left, something happened, Jeff. They just fell by the wayside.
I love Papa John's. Well, look, Yahoo has a warm place in my heart. I was on the board of Yahoo years ago. Papa John's has a warm place in my heart as well. We did some great things at Papa John's. We improved the business tremendously. We changed the perception around the brand. We introduced stuffed crust pizza for Papa John's. It's delicious. It's amazing.
It is good.
The Papadillas.
But you also got Shaq on the board too, as well.
Yeah, look, Shaquille going on the board was fantastic for the brand, and he's a terrific person and super smart. So that was great as well. I love the company. I would never rule out getting back involved. I think there's a lot of opportunity at the company, but it has to be right for both people and it has to make sense.
All right, I want to take through some other companies. You were also involved, that we covered really closely here, in Salesforce. Now, Salesforce went through a period of time after you really got involved on trying to improve their profit margins, and they did. But now it looks like they're back out making big acquisitions. The profits have been a little under pressure. Concern about if AI will eat software. What do you think about that company?
Salesforce is great. Terrific company. I think they're going to be an AI beneficiary. They are still focused on their profit margins. So they report each quarter not only their revenue growth, but they report out on their profit margins. And Mark Benioff is pretty excited about the improvements that have happened. You know, when we got involved, we were talking about them improving their Rule of 40 score. So that's revenue growth plus profit margin. And the Rule of 40 score has improved materially. So they have done a really good job at managing the business. The performance has been much better from the beginning of our engagement to now. The multiple has come down. So it's not an execution issue. It's, as you mentioned, software in general has been more under pressure, especially value software, which are companies that aren't growing 20+%. They're growing double digits, but it's not as high as other people would want. So we feel really great about it and think it's a terrific position for us, and the company's going to do well.
Okay, next up, Kenvue, just inked a deal with Kimberly-Clark, $48.7 billion. You were involved with Kenvue. Do you like that deal?
I love the deal. I absolutely love the deal. So Kenvue, we got involved in Kenvue, amazing brands, the best brands in consumer health. So Aveeno, Neutrogena, Band-Aid, Listerine, Sudafed, Motrin, and then Tylenol.
All the stuff in our closets.
And then Tylenol. And it's amazing. The brands are absolutely amazing. Kimberly-Clark, also amazing brands. Huggies, Kleenex, amazing brands. I think what people don't exactly understand about this combination, and I think they will. I think they're overly focused on what's going on with Tylenol and acetaminophen, but is that the org structures are similar. So actually both businesses are organized where they're run by geographic P&Ls. And to some degree, they're limited in their degrees of freedom because each one of those geographies has to have enough scale to be able to operate. So by merging these companies together, nothing's easy, but it's a fairly easy integration in that you're actually merging two org structures together that overlap beautifully, in that you can put more products, more brands in each geography. And by doing that, you get more scale advantages in each geography, and also gives you more degrees of freedom to be able to prune the portfolio and take out the smallest SKUs with the lowest volumes, or even the smallest brands. it's kind of a nuts and bolts piece of the inside baseball of how companies operate and what happens, but the fit together of Kimberly-Clark and Kenvue is probably better than people think it is. It's really a very good transaction.
Key to unlocking, I think, the ultimate value of that deal for Kimberly-Clark, though, how do they regain confidence or trust in Tylenol as a result of all these autism concerns?
Well, let's go back one more step, though. So the other thing that had to happen at Kenvue was an improvement in digital marketing and newer marketing, and Kimberly-Clark has also embarked on that transition, and they're further along than Kenvue was. So we're also expecting that they're going to be able to speed up our process at Kenvue, and combined there'll be a better marketing effort, especially for what should be the faster growing skin health and beauty brands. As it relates to acetaminophen and Tylenol, I don't know that there's a big change that we're seeing in brand trust as it relates to the actual sales. I mean, the business is fine. The business will be fine. This is a brand that's withstood other things that may have been even worse than this. And I think if you look at what's been put on the Kenvue website, there's a lot of information out there about why the company and many key opinion leaders and experts would say that Tylenol and acetaminophen is safe. So I think consumers know what they want to take and what they want to use in their closet or in their pantry or in their medicine cabinet, as you mentioned, and I think they feel comfortable with Tylenol.
How did you know that would be a good target? Like, what did you do? You assemble your team in a room and say, okay, Kenvue. Like, how'd you know? Like, how'd you know?
Yeah, we throw some darts. And
you said that, not me, all right? I didn't say that.
What we do is a few different things. For each industry, I mean, I kind of alluded to it before, but for each industry, we're looking at a spread of the different companies that participate in that industry. And we're focused on the ones that have lower margins and lower multiples, and trying to figure out if they deserve to have lower margins and lower multiples. You mentioned Darden before. When we first invested in Darden, their margins were worse than their peers and their multiple was worse than their peers. And then we looked at it and we said, that doesn't make any sense. Their actual assets are better. They have better brands. They should be a leader in restaurants. So we love that. And then when you look at Kenvue, their margins and their growth rate were lower than their peers, and their multiple were lower than their peers, but these are the best brands in the space. Doesn't make sense. There's no structural disadvantage. If anything, there should be a structural advantage. That's what gets us excited. And then when you layer on to that calls we might get from other people who own the stock who are frustrated, and then you look into it and you say, well, it was a spin-off from J&J, and I'm not sure the management team is exactly best suited to be able to create a lot of value for the company. You start to triangulate around an amazing opportunity.
What is misunderstood about activist investing?
I don't know. I think people are pretty excited about activist investing. You guys are talking about it leading up to this, how exciting it is. Activism is terrific. I mean, what we're doing is we're investing in companies. I run into people all the time. They love talking about activist investing. They throw out names. Oh, you should look at this company. This company's running terrible.
Yes, actually, yes.
Check. Give me I mean, there's suggestions that come all the time. Everybody loves when we get involved in a company where they're invested. So I think it's pretty well understood at this point. We make investments in companies that aren't performing all that well, and the secret behind it is the biggest impact we're having is we're lighting a fire under a management team to do more faster than they would have otherwise done. That's what's happening. We make an investment, and the management team, the day after we make that investment, I can promise you, they are getting together and they are going to do more than they would have done faster than they would have done.
These are pressure cooker situations that you put yourself into. Like, what's been the most stressful moment for you the past decade?
Oh, I don't know.
Do you have like one out of like 100?
I don't know that I have one off the top of my head. I mean, every day is stressful and fun all at the same time. I don't know that there's been anything that's been all too bad. Well, I mean, in terms of the macro stuff, I'll tell you, it wasn't so much micro. I mean, for me, just like anybody else, I mean, dealing with COVID was massively stressful. I mean, it was stressful for all of us. So trying to think about that as a portfolio manager and analyzing the impact for companies and society and, and learning how to work from home and being equipped and prepared to be able to work from home while you're cleaning your food that's getting delivered and you're concerned about your safety but worried about managing a portfolio, that was pretty stressful. I would say that was massively stressful, probably for everybody.
Mm-hmm. Maybe we can make this an annual just tradition. Thank you for doing this. I appreciate it. And thank you for the kind words on Yahoo. We appreciate it.
Well, I just need a football pick next year. You got to give me a
we
player.
We got to get the team. Please escort Jeff over to the Yahoo Sports side. I mean, please. I mean, let's come on. He's just asking for Yahoo Fantasy sports tips. Jeff, thank you. I appreciate it, man. Thank you so much. I appreciate it. All right, Julie Hyman, over to you.
Sadly, I can't provide that for him either. All right, 2025 has been a volatile year for the stock market, of course. The VIX spiked above 40 in April amid those tariff uncertainties, reaching its highest level in almost 2 years. Since then, the index has returned to its mid to high teens, signaling a calmer days on Wall Street. Yahoo Finance has always been a trusted source for market data, and now we can expand more broadly. We're pleased to announce that Yahoo Finance is now a redistributor of SIBO with the ability to deliver market data, such as the VIX, via custom API solutions to investors and partners worldwide. Yahoo Finance will power leading brands like Samsung with global coverage and actionable insights.
Welcome back to Yahoo Finance Invest 2025. I'm Brooke DePalma, live at the NASDAQ here in Times Square, and it's time now for Market Minute. Stocks dip as investors absorb the end of the longest government shutdown in U.S. history. White House economic advisor Kevin Hassett flagging that the October jobs report will not provide the unemployment rate. Now Wall Street weighing the impact of the shutdown on the economy and the path for interest rates. And Verizon is reportedly planning to cut about 15,000 jobs. That's according to the Wall Street Journal. The cuts are set to take place in the next week. This is coming as the company is looking to reduce costs and as it contends with increased competition. Lastly, Tesla looks to be changing its tune on the CarPlay feature. That's according to Bloomberg. The EV maker is developing support for Apple's CarPlay system in its vehicles. This move comes as Tesla has seen softer sales. The stock trading lower today and is headed towards its worst day since July. That's your Yahoo Finance Market Minute. And now let's get over to Bob Powell.
Thank you, Brooke. Hi, I'm Bob Powell, host of Yahoo Finance's Decoding Retirement podcast, and this is Ask Yahoo Finance Anything, and we mean anything. I'm here with a powerhouse panel ready to answer your personal finance questions. Jeffrey Levine is Focus Partners Chief Planning Officer. Rian Horgan is founder and CEO of retirement platform Silver, and Lizetta Rainey Braxton is founder and CEO of Lizetta and Associates. You've sent in questions on student loans, retirement, credit cards. even buy now, pay later. And we've got answers to help you get your finances in order. And reaching that goal often starts with saving. And there are a lot of options out there for online savings accounts, and a lot of people don't know where to start. So, jump ball question, where to start with online savings accounts?
Well, I think the very first thing is how much you're going to be putting in and how important is mobility of that money for you, because there are some very high yield options that sometimes are a little bit more difficult to get money into and out of. If you don't need that money right away, you can afford to put some money aside into one of those options. But if this is going to be very much like a slush fund almost, right? Like income comes in, money goes out to pay your checks, then or your bills, then at that point you really need to focus on what is the most seamless way for you to do that so that you can focus on doing your job, raising your children, all the other things that are more important in this world than managing the day-to-day checkbook.
So, Rian, I know a lot of people focus on like the APY, right, the annual percentage yield. Is that something they should pay attention to as well?
Yeah, look, I think when you think about APY and you think about yields in general, what you're really trying to think about is how long are you holding the assets. And so really trying to get I think kind of double tapping on that prior comment, which is this more medium-term capital? Do you need to be able to access it over the next 6-12 months, or is this kind of daily liquidity money?
Yeah, so I think also there's a lot of fees attached to some of these accounts, and there may be limitations on the number of checks you can write. Is that true?
Well, a lot has changed since then. I love my clients being in a high yield savings account earning that 3.5% or more. I mean, there was a time where it was like 50 basis points, I remember, a decade or so ago. So I don't see the fees and the transactions cost as much as I used to. I think, the financial services are really wanting these people to come to their bank and be competitive.
Yeah. What about like the difference between someone getting a promotional yield and like the yield that you actually get after the promotion's over? Do people need to know about that sort of pull the rug out from under you?
I think it's just being mindful of it, right? There's nothing wrong with a promotional yield, but if you're getting that promotional yield when that promotion is over, if this is longer term money, then that may not be the place to keep your dollars anymore. It may be time to look for another promotion. Now, again, of course, if we're talking about large amounts of liquid dollars, then that can make a lot of sense. But if we're talking about smaller sums, again, I think sometimes people overreact, right? Like at the end of the day, if you shop for your rates and you get 1/4 of an eighth of a 1/10 of a percent more across the street, how much is the bang for your buck worth it? And is there other things that you could be doing to be more mindful with your time and grow the top line more?
Yeah, I remember my mom used to go from one grocery store to another to another, because she had different coupons at different places. But for her,
yeah, but there are a lot of people today that still have a lot of different IRA CDs because every time one came due, they look for the top rate across the board, and getting that top rate is more important to them than consolidating it. And that's just a personal, it's just a person by person decision.
Yeah, so the other thing that we got from listeners was this notion of credit card points and people chasing credit cards and racking up points and trying to get the best deal for their credit cards. Any thoughts, Rian, about
Yeah, I mean, look, I think just the transparency is really hard, right, as a consumer today. And I think, as we see the credit card fees going up, I think the consumer is looking for value. And I think the question is, where are you getting the most value? Is it worth paying the $200, $300, $400 and getting these points? Like, are you going to use them? Or are you actually better with a more of a no-frills card? And I think that's where I think as the consumer, you need to be a lot more focused on, are those perks actually worth it to you?
Yeah.
And what you were kind of commenting on, there are some people who are specialists. They do it as a job and really work the kind of credit card system. What I say for my clients is back to what's most important to you. Do you enjoy traveling? Get a travel card. You want money back? Get a money back card, and be very mindful of paying it off every month so that you're not incurring those high double-digit
Yeah, I was going to mention that. Was that right? If you keep your balance, it almost offsets the benefit of having the points, right?
Exactly.
Sure. Yeah, I think you really hit on the point, which is pay your balance off every month and understand yourself, right? If you're someone who is not going to pay that off every month, then you might actually be better off with a debit card, even if you don't get the same amount of points or something like that, making sure that you don't outspend what you have. But if you're someone who has, let's say, the ability to pay that off each month, then points are effectively free, right? Then at that point, it makes sense to use them and find the card that's best for you.
Yeah, so another question we got from listeners was around whether I need a financial advisor or not. And I know I'm talking to a group of financial advisors, so the answer may be biased here, but what are your thoughts, Lizetta?
I'm a fiduciary. Of course, I can't be biased with that response. I, in all seriousness, do believe that there has to be a good fit. If someone is really good at financial planning, have gotten the tricks, the ropes, and reads upon it, then the answer is no. You hire out when you want extra time, right? You want somebody else to do the work for you. You want a dialogue partner, and you want somebody just to manage, help manage your life along with you. And I say life, not just investments, because it's very holistic in the approach from the way I think about it.
I think also today the American consumer has so much more choice, right? They can start their research journey themselves independently online and do that research. And we see a lot of folks talk to family and friends, right? I do think that parts of retirement, as an example, are very social. You retire around the same age as your family and friends, so you swap tips. But I think in these moments where you have these big decisions where it's hard to backtrack, that's where bringing an expert in can be really helpful. And so I don't think it has to be all digital or all human. I do think that there is this hybrid, which is do your research, get informed, get that information, and then go get that expert to help you make that final decision so you feel really confident.
Yeah, I often say emotion is the enemy of good decisions. And it's very difficult to divorce yourself from the emotions that are associated with your own decision making. I mean, I like to think that I am fairly knowledgeable and that I understand financial planning to a decent degree, but I have my own financial planner because I cannot remove emotion from my own decision making process. And so for me, a lot of times it's just having someone else to say, am I thinking about this correctly? Is there something I'm missing? Or am I letting my emotions get the best of me? In which case, if I am, it's probably not the right decision long term.
Yeah, okay. Another pocketbook issue that is on the minds of people is this notion of car payments, and we're witnessing right now delinquencies on the rise. What can people do to sort of mitigate and manage the ill effects of that?
That's such a tough question because people are getting squeezed. And so when it comes to credit, you start with the creditor and say, okay, this is my situation. Are there any options, right? Start with the person you're working with. And then two, you might, have to have it repossessed. That is the worst case scenario.
Nothing worse than the repo man coming
I know.
in the middle of the night to take your car.
And we also have to make it reality that some people have to do the reset. And so if you do have to do the reset, know what that means for your credit report, your credit score, and the like. Information is key, and no, it's not the end of the world. That's not the desired, but it could be the case.
Yeah, there might even be other options where if you have a more expensive car, can you turn that in if you're financing it and maybe go to a less expensive car? May not be your preferred vehicle, but it might be better than having to make, $1,000 a month payments. And I think, Bob, the bigger issue here is setting these up front, right? Like if you're someone who is going to make a $1,000 car payment, you got to have enough reserved in your liquid cash, maybe going back to having a checking account, right? That has a liquid dollar so that if something bad happens, that you have the ability to continue to make these payments. You shouldn't go on thinking that everything that exists today will always exist in perpetuity. Most things change over time and hopefully for the better, but sometimes that's not the case.
Yeah. So a question, it didn't come in from a listener, but it's a question I get all the time from my children and my children's friends is when they switch jobs, should they roll over the 401k from their former employer to their new employer or into an IRA or leave it behind? Tough choice, right?
Yeah, I mean, maybe I'll kind of jump in there. I see it through my own employees, and what really impresses me today is I actually see employees being more active in that conversation and consolidating. I think the challenge of having lost IRAs and not simplifying is a huge problem. Most plan participants today do have the option to bring their 401k to their new employer. And so whether it's rolling over to an IRA or just rolling it to the new employer, keeping it in one place, right? This spaghetti of retirement savings in lots of different places, it ends up with people typically being underinvested, not remembering what they have, and I think it makes
track of what they have, right?
Exactly.
Because
I mean, there are a number of these
their address.
Yeah, particularly, and when we see this, your email address when you come out of school is likely different than the email address you're using 20 years later.
And maybe deleted by your school.
I just think simplicity, to be able so you can track it, is so much better.
Yeah, I mean, it's so bad that Secure Act 2.0, that retirement bill that we had just a few years ago, created the Department of Retirement Lost and Found. I mean, it sounds like a made-up thing because it's so silly, but that's how many people are not keeping track and end up, losing track of their dollars in retirement accounts. So I do think, to your point, that most people are better off, whether it's for easier consolidation and just when you get to retirement age, required minimum distributions, only having to go to one place, whether it's managing the money in a more efficient manner. But there's always exceptions to the rule. I mean, we're here today in New York City. New York City school teachers get an automatic 7% return if they go into their fixed option, right? Like that is very unique to that plan, but every plan has something a little bit different. If you're getting 7% guaranteed in your fixed option, there's not a better bond option out there today. So that would be one of the exceptions to the rule, or maybe you do leave your money in the plan. It's why we have jobs, right? Is to help people make these decisions.
All right, so the reality of it is, and no names here, but a close friend, should I call her, says it's just too hard to take the money from my former employer's 401k and move it into either my new employer or into an IRA. She's overwhelmed by the process.
Yes, and the key is staying with it because it's your money and it's your life. Yes, of course, no one wants to give up money for any reason. I'm specifically saying institutions, and it is a process that has been going on for quite some time. So get on the phone, find out the forms, figure out who your key people are, document what's happening, follow through. It's your money, it's your future.
I want to double tap on the get on the phone because it seems so old school these days to say that. But I know, so I worked at JP Morgan for a long time. And when I left JP Morgan, I rolled over my 401k and I did not understand the paperwork myself. Like it was complicated. Yeah. And so I got on the phone because I wanted to make sure it was done correctly. And I think those lifelines are there. Even those of us that are experts are reading this paperwork and it is not written for the average human being.
Yeah. So pretend it's like Who Wants to Be a Millionaire, and that you get to call a friend.
Yes, sure, for sure. But these services are here for you, right? Just take advantage of us.
Yeah. All right. Let's go over to Allie Cannell in the Social Center with some viewer questions now.
Thanks, Bob. Such an important panel, and we have plenty of viewer questions coming in through social media. And Brian, this first one is for you. And fair warning, I'm sensing a bit of sarcasm in this first question. But Damien asks, I totally know all the really important things to know about IRAs, but I just want to make sure you know them too. So what are 3 IRA rules that everyone should know?
All right, well, this is really timely because this morning the IRS came out with their annual updates, and I've got the numbers right here with me, but I think, I was going to say, so the first thing I really get everyone to think about is actually the arbitrage between your Roth contribution limit and the Roth 401k. I think for those of us that are a little bit older, we don't even remember the Roth 401k, right? It's a newer concept, but you can put over $24,000 into a Roth 401k, whereas your IRA is capped at, or your Roth IRA is capped at $7,500. So that's like a real winner for someone who's maybe maxing out their IRAs and hasn't looked back to see if their employer has that option. The employer might not have had the option 5 years ago, and they probably have the option today.
And no income limits too, right?
Exactly. So there's no income limits, which is fantastic. Second thing I'd be thinking about is there's a lot of conversation about money going into IRA accounts, but it's really thinking about money coming back out. And I think one of the challenges that a lot of older Americans find is that all of a sudden they've got savings, hopefully in those accounts, and now they start to think about taking money out. Do they get tripped up by some of the surcharges for Medicare? And so really understanding that when you take money out of your retirement accounts, you have to really be thoughtful about the timing of doing that. The last thing I would say is for folks that are kind of in between those last couple of years for retirement, the Secure Act 2.0 gives you an extra supercharged a catch-up contribution. That's brand new. It went live last year, so make sure you're taking advantage of that super catch-up if you can.
Yeah, so people who are age 50 and older can contribute up to $8,000, but if you take advantage of the super catch-up for people 60 to 63, it's $11,250.
Yep, that's the number from this morning. Exactly. I was just triple checking it.
Right here.
Yes.
So.
I love it. I'm taking notes. And Jeffrey, I have a new one for you. Josiah asks, I have a mortgage at 7% interest. I often have $500 to $1,000 left over to save at the end of each month. I have a kid and a spouse. Should I prioritize paying down my mortgage or invest in the S&P 500?
Yeah, this is a great question, and I know the answer is not going to be very satisfactory, Bob, but it depends. How did you know? That's exactly right. Unbelievable, right? Well, the answer is it depends because you have to look at the relative benefits of each and what is most important for you. So investing in an S&P 500 fund, over time, you would expect to do better than 7%. Now, there's some questions here. If you're looking at paying down your mortgage, are you able to deduct that interest? If you are, then it's not a true 7% cost to you each year, right? It might be 6%, it might be 5%. Some of it depends upon your tax rate. So doing something that sort of beats it over the long term, like investing in the S&P, would be easier, if you will, right? You should have a better opportunity to beat it. But here's the thing, paying down your mortgage is a guarantee, right? So there's that on the other side. But if we're looking at liquidity, paying down your mortgage, very hard to access that money if you want it, right? If you have an issue and you need to, going back to the car payment, right? If you need to make that car payment, very difficult to say to the car company, here's my living room. Are we good this month? Like, that doesn't work very well. You need cash. So if you're in the S&P 500, turning that into cash is a lot easier. Yeah. So it's really looking at the totality of this and saying, what's more important to me? Is the liquidity more important? Is the guaranteed return, if you will, of putting money in? And it doesn't have to be all or nothing.
Right, could split the
That's
difference.
right. There's nothing that says you can't do some to pay down your mortgage a little bit faster and some to, and some in the S&P 500. It doesn't have to be an all or nothing decision.
Allie, what else you got?
All right, this last one is for Lizetta. One of our viewers on GeoTV asks, for beginners, what's the first step to take when thinking about investing? Should I start with stocks, mutual funds, or something else?
I love the fact that I'm hoping the one who's asking that question is already invested in a retirement plan, because now it's so easy to know what you're invested in the market through that. And you can have the index and you can have active, but a lot of people still go the index way because it's just easier in terms of performance. So maybe you want to match what you're invested in your 401k, be it index S&P 500 and the like. Do the same thing for your brokerage taxable account. And if you really, really love the stock market, or say you really, really love a company that you're spending a lot of money on, maybe you do want to dip in and buy a few shares as an investor and not only a consumer of that company.
Jeffrey, Rianne, Lizetta, thank you for being with us at Invest, and thank you. Over to you, Allie.
Thanks so much, Bob. I know I learned a lot from that panel, but for everyone else out there, stick with us, because coming up, we have our conversation with Robinhood CEO Vlad Tenev. That's on the other side of this break. Stay tuned.
Welcome back to Yahoo Finance Invest. It is now time to enter the trading pit. I'm Jared Blickery, host of the Stocks in Translation podcast, and here with me is Kenny Polcari, host of the Trader Talk podcast and a former New York Stock Exchange floor trader. Over the next 15 minutes or so, we're going to be showing you how to think like the pros and how they think about the markets and the news flow like the government shutdown, which is now officially over. And we're going to start you on the road to building an unbeatable investing plan and a winning portfolio with the help of Yahoo Finance data and tools. We're going to walk you through some of the basics, covering some technicals, some fundamentals, and whether you're a beginner or a pro, we're going to help you think about risk management strategy, one that will let you sleep at night and trade another day, because risk is the only thing you can control in this game. So Kenny, let's start with that. I'm going to dial up the Wi-Fi Interactive behind us, and we got some key things to think about when it comes to risk factors. How do you think about it?
Right, so you have to start thinking about where you are in the life cycle, who you are, how old you are, how long you're going to invest this money for. Is it retirement money? Is it money you're trying to save to buy a house in 2 or 3 years? That's all going to determine the level of risk that you're going to put in your portfolio. And it's important for everyone to understand that, right? So when you think about, the S&P 500, that's called market risk, right? On the scale of 1 to 100, which is what the scale is based on, S&P comes in at a 75. So anything below 75, you would get more conservative. Anything above a 75, you would become more, go further out the risk scale.
Let's talk about time frame. One of the key phrases in trading is know your time frame. Right. Some people, it might be a few minutes if you're an algo. Some people, it might be a few.
It might be a few sub-seconds if you're an algo, right?
Yes, exactly.
But if you're a day trader, if you're an investor, your time frame can be anywhere from 1 week to 1 month to 10 years to a lifetime, right? 40 years out if it's a retirement plan, right? If you're 25 years old, it could be 40 years out.
Well, and hopefully I got a few decades in me. we're going to talk about growth versus defensive and diversification, but I want to pull up an example here. I'm going to show us some ETFs. These are the 11 sector ETFs from the Spider. These go back basically to the beginning of the century in terms of data history here. So we got some nice history, but this is what's happened year to date, and these tell a story. So in the upper left, that is XLK. I'm circling that right now. That's up almost 24%, followed by utilities and industrials and communication services. Oops, we got a chart there. What you're going to notice is all of those are outperforming the S&P 500, which is up 15% this year. Now, the only one in the red is consumer staples, and that's kind of a defensive sector. So I just set that up. Tell me what you see in all of this, Ken.
Right. So what's interesting here is that these are the 11 major sectors within the S&P that everybody should know, you should be familiar with, right?
Right.
There are now subsectors to this, clearly, but these are the 11 major sectors when you talk about it. So currently, the S&P is up 15%. We've got 4 sectors that are outperforming the S&P, and then we've got another 8 sectors that are underperforming the S&P, with consumer staples the only negative sector, the only sector that's negative on the year, right? But as you begin to invest, as you begin to build a portfolio, you should think about the S&P broadly, right? Like an S&P total return
It's
fund.
what we call the benchmark.
The benchmark, and that's, you can get an S&P total return fund when you're just starting out. As you build the portfolio and as it accumulates and grows in value, then you can start to divvy it up. You can get more sector specific. You can become country specific, region specific. But we talk about that as we move on.
Yeah, a lot of people, there were 3 years into this bull market. So we are now in the 4th year, the very beginning. And a lot of people are concerned that we're in a bubble. We're not going to debate that here. But what if somebody is overinvested in tech and they want to branch out? I'm just going to show you one thing, Kenny, because the government shutdown began at the very beginning of the 4th quarter. That would be October 4th. And we can see this is a performance of all the sectors since then. So it's a little bit of a different look than we had on that last screen, which was a year-to-date performance. Healthcare is the number one. That's up 11%. And we haven't seen that in a while.
It's very interesting because healthcare has been the underperformer all year, right? It's been well below the benchmark. And in this last quarter, it's really raised its head. It's up about actually 19% just in the quarter alone, which has now taken it to that plus 10.8% because it was in negative territory for most of the year.
Yeah, and what about some of the other sectors? Utilities is kind of like an AI trade, but also classically defensive. How do you
do? And classically boring, right? You'd always think about utilities as, your grandparents owning utility stocks because of the dividend play. Well, this year, utilities, as you saw it, was the second best performing sector because we're talking about technology and AI and the energy demands and the utilities, how they're going to play into it. And so utilities have so far outperformed in terms of where you would expect them to be on a normal year.
All right. I want to get to a ticker example here, and we're going to go into the retail sector. I've got 2 here. We've got Lululemon, and that is the cyan line or blue line that I'm tracing out kind of at the bottom now. It's down 55% since the beginning of the year. And here's Amer Sports, which is AS, and that's a purple line. Now it's up about 10%. It was up more before. But here's a story that I want you to break down. So they were tracking each other into the bottom of that post-Liberation Day low. Then they took off, but then there is a different story here. What does this tell you?
Right. So I'm a chartist, right? I mean, while I look at some of the fundamentals, I always look at the chart to kind of tell me the story. And what the story's telling you is, from January till April, they were very much alike. They kind of traded with each other. Then after the April surge higher, you started to see American sports went straight up, but Lululemon started to falter, right? That's when suddenly you look at kind of what Lululemon doing, you compare it to the other names in the space, you see what the other names are doing. Are they all acting the same, or is there a divergence? In this case, there's a wide divergence, right? American sports kept going up with the market, and Lululemon, in fact, started to run into some problems. So that tells you that, okay, there's something else going on in Lululemon. It's not just, about technical. Now there's more of a fundamental story. And that would cause you as an investor to stop, think, go back and do some more due diligence, find out what's going on, and understand whether or not Lululemon should remain a holding in your portfolio. And by the looks of it, it's not a name that I would have held.
Yeah, I mean, any stock right now that is trading underneath those April lows, which were the lows of the year for many of the most best performing stocks, I would take that with a grain of salt.
Well, right, and you could find other places. You could find other places to take the money. Maybe you're going to allocate. You want to stay in retail, that's fine. But there are other stocks that are going to be better plays for you, better investments for you than Lululemon. I mean, I know people love the pants and the shirts and all that stuff, but in this case, as a stock, it's not really helping you out.
Well, how does a beginner dip their toe into the market? There are conflicting views on this. Some people say that you should start, stock picking right away. Other people say that you should invest passively.
Yeah, no. If you're just starting out, if you're someone that's, you could be in your late 20s or your early 40s. Doesn't make a difference. If you're just starting out, you have to start out and be broad, which is why I said you would start out with a total return S&P fund, right? And then you would contribute to that either quarterly, monthly, however you're doing it, and you would let it ride and build. As it builds, then you can pick the number. Maybe it's 7,500, maybe it's 10 grand, maybe it's 20 grand. That's when you'd start to peel it apart, and you'd start to diversify it away into other specific subsectors. Say you're younger, so you wanted to lean a little bit into the AI trade. So then you'd break some of it off and put it specifically into tech while leaving the bulk of it in the S&P. Because remember, you're going to get double the bang there, right? Because all the names in tech are in the S&P.
That is a great point.
Right.
Yeah.
So you have to make sure that you understand. If you go out and buy Apple individually, and then you buy the XLK, and then you buy the S&P 500.
That's a lot of Apple.
You're tripled up on Apple, right? And so you need to understand the role and the percentages that an individual name might have in the subsectors.
All right, great point there. While you were talking, I pulled up the S&P 500 behind us. Again, it's up 15% year to date. What I'm going to do is place a technical analysis indicator on it, and that's that blue line that just appeared. What sticks out to me is that the price of the S&P 500 has stuck above it this entire time over the last 6 months or so, basically since we emerged from that scary post-Liberation Day period. What do you see in this?
So, which is very interesting, right? Because there are typically three trend lines that we watch. The 50 is called the short-term trend line. Then there's the 100-day, which would be the intermediate. And then the 200-day is the long-term trend line. But this one here is the short-term trend line. But what you see is that the S&P remains above it. It keeps kind of testing it, never really kissing it or piercing it, but it's testing it. What you want to look for is right now where you can see we're just about to kiss the trend line. And what's going to be important in that is, does it hold or does it fail? If it fails, here's what typically happens. You get the algos that will kick in because we've had a technical failure on the chart, and then you'll get the algos that just operate based on a mathematical formula that will see that there's a failure and they'll go into sell mode, which will end up putting more pressure on the stock. And you see that or on the market. And you see that all the time. We saw that just a couple of weeks ago when we had that whole valuation concern conversation going on, and suddenly we did break it. We traded right down through it, but then cooler heads prevailed and we took it right back up. So if you're just learning, you need to understand that this is kind of one of the technical tools that you should know, that you should understand.
Yeah. And so we just did a little dabble into technicals. I want to dabble into fundamentals here. These are basically based on companies' financial statements, and this is how longer-term traders, and you wouldn't necessarily use fundamentals for day-to-day trading, but for longer-term investors, this will give you an idea of, and let me just bring this up here. This is our quote screen. And by the way, all this data is pulled from the Yahoo Finance data and site. Here's something called the PE ratio. This is the price of the stock divided by the earnings per share. And so this is a way to kind of normalize among different stocks or even sectors or even the entire market what we're looking at in terms of valuation. So to give you a basis, because we always got to compare this here, NVIDIA with a PE ratio of 52 compares to 40 for tech, compares to a high 20s for the S&P 500. So it's more elevated than tech sector or the S&P 500. But let me show you something here. Here's Tesla, 273 PE ratio. Here's Palantir, 412. And I know, Kenny, you don't necessarily use fundamentals to trade, but you do follow the stories.
Right. Well, you have to follow the story because you have to have a sense. And like you said about NVIDIA, it's 52 where the industry is 20 and its peers are more like 40. So you would argue that that's pricey, right? That they price that stock to perfection. In this case, go back to Palantir where you had it at 442. That's a huge premium, which is actually part of the story that we've been hearing over the last couple of days, specifically about this name, about it being priced to perfection, overvalued, stretched in terms of what investors are willing to pay for it. And look at today, it's down $10 or nearly 6% on the back of that kind of concern, which doesn't mean that you should panic. It doesn't mean that at all. It just means you need to understand how people and how investors use that number to interpret how the stock is going to move.
All right, Kenny, I have brought another ticker that you got me to look at, Ionic. And we're going to compare Ionic, IONQ, to the tech sector. And so the tech sector is this cyan blue line that I'm tracing out right here. And what you notice about Ionic is even though they ended up, well, they're in different places today because Ionic is only up 8%, but it's a lot more volatile. It swings below and it swings above by quite a degree here. So what do you see in Ionic?
So what's interesting is that Ionic is one of those subsectors, right? It's about the quantum space within technology. So the cyan line brings you the technology sector as a whole. So throw all the tech names in there and come up with that. You come up with that line graph, right? The purple one is Ionic itself, and what you realize is that Ionic is a very volatile name, right? It's not a large cap name; it's a mid cap name, and so it becomes very volatile. It's also in a space that's just breaking through, right? As we talk about quantum in the tech space and AI and machine learning and all that stuff, quantum is certainly gonna have its place, and it already is. But what all that tells you is how volatile. You have to make sure you understand the volatility in the name, and you shouldn't panic. You need to set larger parameters when you're trading that versus trading a more stable stock, because you can get whipped around and then get taken out of your position when you really didn't want to. So all that suggests is because when you really look at it, IONQ and the XLK. Is this daily or is this up year to date?
This is year to date here.
Oh, it's year to date. Okay, so IONQ's up 8%, but the tech index is up 23%. It's funny because just 2 days ago they were neck and neck.
We were looking at this right here.
IONK was up 23% just 2 or 3 days ago, and so we had a drawdown. We're going to kind of settle in here, and then my guess is once we get through the negativity of today, once again it'll come swinging right back.
Lots of volatility here, so don't be a hero. That's my biggest advice for investors. What is yours heading into this new year?
So, don't be a hero, don't panic, right? What you have to do is you have to take the emotion out of it. And all that means is make sure you understand what you own and why you own it. Make sure that the reasons you bought it remain the reasons you're going to own it going into the new year. And look, the new year, the beginning of the new year, I'm assuming is going to be a little bit rocky because we've had such gains this year that if investors want to kind of take some profits, they're going to wait until the new year to do that. So this way they put off that tax obligation until April of 27. So don't get nervous if you see some pressure, especially in tech, in the new year. It's just that would be more about people managing their risk once again and their financials.
Kenny, can you believe it? We got to go here.
I can't.
Kenny,
I could do this all day.
I think we might one day. And if you are ready to level up on your trading journey, you can get tons of trading advice, unbeatable contacts, and data on the Yahoo Finance platform. And straight ahead at Yahoo Finance Invest, Robinhood co-founder and CEO Vlad Tenev sits down with our Brian Sazi, his perspective on all things crypto, plus the booming business of prediction markets.
Robinhood is no longer just a trading app for retail investors. It's evolving into what co-founder and CEO Vlad Tenev calls a financial super app. The company's stock price has tripled this year, fueled by explosive growth in prediction markets, crypto, and new ventures into banking and social investing. Robinhood co-founder and CEO Vlad Tenev joins me now at Invest to talk about how far this evolution can go and what the future of investing will look like. Vlad co-founded Robinhood in 2013. Vlad, always nice to see you. I was going to go off on a different direction this interview, but I got an alert from Yahoo Finance. There's a story on our page right now saying you are delivering money to people's houses in partnership with GoPuff. Explain it to us.
Hey, Saz. Great to be with you. So we're launching a service, Robinhood Banking. It's rolling out to external customers right now. Early feedback seems quite good. And the idea is, can we actually give you the private banking experience? So the same type of experience that a high net worth individual would get from a private bank, but with the digital experience they've come to expect from Robinhood. And as we started thinking about the types of features and services that the high net worth individuals would get, one of them is they're not going to an inner city ATM. They're getting cash delivered to their house. And surprisingly, even though we're getting increasingly digitized, cash is still a very important part of the US economy. And people need it from time to time. And when they need it, we want to deliver it to them with the convenience they expect from other digital services. So high net worth individual gets cash delivered to their house in a truck. We figured out how to do that in partnership with GoPuff to the mass market.
Vlad, how does this?
And that's just one of many features that I think make Robinhood Banking the best solution for customers.
Vlad, how does this come? Well, I haven't, full disclosure, I've not used this yet, but I'm curious about it. How does this cash come? Is it in a bag with a dollar sign on it? Like, how's it packaged? I've never had cash delivered to my house, is what I'm trying to say.
Yeah, we don't want to just deliver it to you in a shiny bag with a dollar sign. I think it's a little bit more discreet than that. Gotcha. But actually, one of the initial markets is New York. So I encourage you to give it a try.
Fair enough. Look, one of the benefits of doing an event like this, we can actually get in depth into your story, the story of Robinhood. Take me back to the 1997 Infiniti Q45, Vlad.
Well, that was a very nice car. It was a boat of a car. That's a deep cut. So I was a graduate student at UCLA, and my co-founder, Beju, and I put all of our belongings, including some servers, into the back of my Infiniti Q45. We couldn't afford to move with movers, and also plane tickets were quite difficult. So we drove across the country to where you're sitting now, New York City, and started our first company. This was a high-frequency trading firm in the absolute middle of the global financial crisis, where everyone was telling us that that was the worst time that you could possibly start, not just any company, but a financial services company. But the industry changed. There was a lot of disruption. Institutional finance went from kind of open outcry trading on the floor to completely digital. And then this sort of like set the seeds for us launching Robinhood many years later, where we basically combined the technology of high frequency trading with the new platform shift of mobile, and became the first mobile-first zero commission financial company.
Do you still have the car? It's a bit of a historic thing, almost like the IBM Garage or whatever that was?
No, unfortunately, I don't have the car. It stopped running right around 2013, and then I sold it for about $300. So someone got a great deal in Northern Virginia.
Vlad, one thing inherent to your story, and you and I have talked about this a lot the past 18 months, but really this year it is the product velocity over at Robinhood. It seems like every day I wake up, there's something new coming from you and your team. Help us understand how you're able to get some of these products to market so quick, and how are you identifying new areas to grow in the space?
Yeah, I think that we've been fortunate to have spent a lot of time over the past few years building great infrastructure, both on the technology side, but also great great people, great leaders, and we try to move fast and do so safely because we recognize we're a financial company, and you don't want to, you want to make sure that customers have a reliable service, but I think we've been able to move fast while making sure that we do so safely, and it just requires having the right talent and the right technology infrastructure, which we continue to invest in. And it's not always the sexiest thing to talk about, but there were a couple of years, 2020 and 2021, where we didn't ship too many products, but instead we really got our house in order and built the foundations for the company you see today.
What's been the biggest game-changing product for Robinhood this year?
Well, I'd say the last quarter, we announced that we had record net deposits. So 20 plus billion in net deposits in the quarter into the platform. And we already surpassed last year's record of net deposits with another entire quarter to go. We also announced 11 business lines, up from 9, that generate 100 million plus in annualized revenue run rate. The two new ones are Bitstamp, which is our institutional crypto exchange that crossed into the 9-figure revenue run rate. And also prediction markets. Prediction markets, which we've talked about, our fastest growing business of all time from a revenue standpoint, doubling quarter after quarter. And we also announced so far in October, we've traded more contracts at about 2.5 billion than all of Q3 put together. So that's been ramping extremely quickly. So I think I'd have to point to that one as the fastest growing. That's on the active trader side. But again, you look on the wealth building side, where we're not just building for active traders, but we want to be your primary financial account and your secondary financial account. You mentioned financial super app. Banking's looking really good. Credit card has ramped to north of 500,000 cardholders incredibly quickly, which makes us one of the fastest growing in that space. And Robinhood strategies in retirement have been ramping as well. So I'm proud of how the team's been able to build for these very different customer bases, active traders on one hand, but also becoming the platform that can help all of our customers, the mass market, with the totality of their financial needs.
Vlad, here's what Bernstein just said about Robinhood after your quarter. Quote, quarter after quarter, Robinhood management raises the bar and tells us why the stock deserves its valuation. How do you model a company that adds a couple $100 million revenue businesses every year? How could an investor model a business like yours?
Well, I think that we try to give our investors really leading visibility into how things are evolving. And as you could probably tell, even the way we're communicating with investors is evolving and improving. So it was less than a year ago that we did our first video earnings call, for instance, and we've improved upon that experience. The last earnings call was not only on video, but we had live video question asking from retail customers. We had sell side, buy side, and the media in the room, and it was in the Chase Center in San Francisco. So we actually did it at an interesting location. So the communication with investors, I think, has been improving, and it's a product in and of itself. In terms of the financial profile of the company, we keep it very simple. We want to grow revenues faster than costs. It sounds simple, but it's actually not trivial to do, especially at high scale. And we make big bets. We're not only content to improve the products we have incrementally and get a little bit better, even though that's very important, but we also make bets on new categories that you don't see elsewhere. And that led to innovations that are relatively unique to Robinhood in our space. For example, 24-hour markets on the active trading side, cash delivery, which you mentioned on the banking side, the deposit match products, which still continue to be unique, and of course, prediction markets as well.
I see a lot of what you're doing, Vlad, really trying to connect with the retail investor that has become this investor has become way more sophisticated. Yet I look out through corporate America more broadly. I don't see a lot of companies doing video calls from the Chase Center for their earnings days. I mean, nobody's doing this stuff. Does that frustrate you? They're not taking the retail investor seriously.
Well, I'm seeing a ton of progress on this front, actually, and I'm working hard to make it easier for companies. I think you have to remember, most companies, when they think about their business, dealing with retail investors is pretty secondary or ancillary. They're worried about, making sure that they're launching products, and they treat investor relations, particularly retail, as kind of a chore or something they're forced to do. Our business is inherently different. Retail investors are at the core of not just our investor base, but also our customer base. And so we're kind of in a better position to take the lead here. But just last week, Opendoor, for example, became the first company outside of Robinhood to use our infrastructure to live stream their earnings to their customers. And we've had lots of others reach out. So you should expect that to be a growing trend in investor relations in the future. People are seeing what we're doing, and they're seeing that it's resonating with retail, and they like to explore and up level as well. Even you look at our IPO access offerings. When we pioneered IPO access to retail back in 2021, we were met with a lot of skepticism. People would say, of course, Robinhood would do it. You're Robinhood, but why do I have to share a chunk of my IPO with retail? That seems like a bit of a strange thing. But now, after 4 years, pretty much all of the major IPOs are in touch with us, and they're talking about how can they level up their retail engagement. And you've seen that reflected in larger allocations and better selection for customers. So I think it's a wave that's going to continue, and we're going to continue to do what we can to make sure retail is a first-class constituency for every public company.
You came out earlier this year, Vlad, with some very strong or robust long-term oriented growth plans in terms of numbers within those numbers. But since then, the crypto industry, it has even become more mainstream. The growth in these businesses, whether it's Bitcoin, various coins, have gone through the roof. 10 years out, how big is your crypto business?
Well, so right now, crypto at Robinhood is largely driven by spot crypto trading in the US, and it's 20 to 25% of our overall revenue. I think the interesting thing is that crypto and financial services are going to fully merge over time, and that's kind of the bet that we're making. So traditional assets, right now we make a very clear distinction between our equities business, our options business, our futures business, and crypto. And also, cash management, banking, and credit card are separate. But more and more of these business lines are going to see crypto technology permeating their very fabrics. So you're going to start to see banking-like products that are stablecoin powered. And there's going to be some ambiguity about whether that's a crypto business or a TradFi business. But as the two fully merge, I think it's going to be a little bit more difficult to cleanly separate. I think it's going to become bigger and relatively indistinguishable from traditional finance, particularly as tokenization technologies continue to develop and become more mainstream.
Over the long term, Vlad, what business becomes bigger as a part of Robinhood? Is it crypto or is it prediction markets?
I think those businesses too are not going to be distinguishable. I mean, you look at prediction markets ex-US, it's generally on crypto rails. And in the US, where you have CFTC and NFA, they're being offered via traditional means. I think what's going to happen is outside of the US, the dominant way to invest or get exposure to US assets and later on global assets is going to be through tokenization and crypto technology, like you see with our EU offering. And then the US eventually will upgrade on the back end, but I think that it'll likely be a little bit behind just because we already have that existing infrastructure that's serving customers well. And I think that if you look out 10 years, we'd like to build a company where more than half of our revenue is ex-US, and sliced another way, more than half of our revenue is institutional rather than retail. So I think there's a ton of growth left in crypto, and also as it continues on an infrastructure layer with things like decentralized exchanges, perpetual futures, tokenization, as it continues to develop and mature, you're going to start seeing crypto eat the traditional financial system and continue to become integrated at a base layer.
Let's bring in Yahoo Finance's Ali Canal from the Invest Social Center with some viewer questions for Vlad. Ali, take it away.
Thanks, Brian. And yes, Vlad, we have plenty of questions from our Yahoo Finance social media viewers. Kicking things off from user Hedge Vision, who asks, do you have any other perks in store for the Robinhood credit card?
Oh, we have tons of perks in store. So again, we want it to be the best experience and in line with what you'd expect from a private banking relationship. So if you are one of the 500 plus thousand cardholders for the Robinhood credit card, you're seeing great rewards, industry-leading cash back across all categories. And as banking rolls out, you'll see great travel benefits, an amazing travel portal, and I encourage you to check it out because more and more is coming on a monthly basis.
All right, so watch out for more there. And we have a two-parter here from AB. First question, as the entire world continues to shift towards AI, automated workforces, and robotics, do you see that as a threat to more traditional brokerage firms such as Schwab and Fidelity? And how is Robinhood positioned to be a winner in that space?
Yeah, that's a deep question. I think there's two views, two schools of thought about the impact of AI on society. One is that it's going to create lots of new jobs. So certainly there will be job disruption, but you'll see new jobs and job families and a flurry of entrepreneurial activity. That's the one that I happen to believe in. The other one is that the other view is that it's going to lead to greater and greater centralization, and maybe the handful of frontier labs that are building these models are going to aggregate more and more of the value, and they're going to try to build products and engage in enterprise deals that basically displace workers. So that's sort of like the bleaker view. I think regardless of which one of these you believe in, becoming an investor and getting exposure to the markets and AI companies in particular is going to be very, very important. And that's why we're pushing so hard on retail access to private markets in the US through various means. We think that it's going to be important for people to be owners in this AI technology in order for them to support it and defend it. Because AI right now, deeply unpopular. People are afraid of AI job disruption and how it's affecting their families and their livelihoods. I think a big part of that is they don't have skin in the game. You know, they're worried AI is going to take their jobs and give them nothing in return. And we're very focused on solving that problem in doing our contribution to solve it, which is giving private markets access to retail investors, particularly in AI companies.
Yeah, and we have been talking about AI all day. And then finally, for part two, with the great generational wealth transfer underway, how is Robinhood prepared to capture and manage these assets as a fully online platform?
Yeah, and that's a great question. So one of the benefits, one of the things that we're testing out and really leaning in with Robinhood Banking and the credit card in particular, is a first-class family experience. So we want to make it easy to bank, not just yourself, but your partner, your children, members of household staff that you might have. And that's really a first-class experience in our product, unlike other products. You should expect that coming to our brokerage and our wealth management products as well, to the point where it's going to get better for you when you have your whole family on board. So a lot of people think, well, Robinhood is just banking on young people to inherit all the wealth. That's not true. I think Robinhood is an amazing place for folks in their 70s and 80s even to to keep their money and their investments. And we offer these amazing match promos. So imagine, you're someone in your 60s, maybe you're 5 years away from retirement. You might have $10 million in your retirement account. Well, when we run a 3% match promo, that's $300,000 that's instantly credited to your account, which is a very, very strong value proposition, particularly the older and wealthier a customer is. And we find that as long as you're digitally savvy and you're comfortable with using smartphone and web-based technology, our customers get served very, very well, regardless of age.
Vlad, before we let you go, I was just talking to Max Levchin over at a firm, and I asked him, what does he do to de-stress? I mean, these are high-pressure cooker gigs. He told me he's a competitive cyclist. What do you do when you're not doing Robinhood? Like, what's your release point?
I like to go into the sauna. The sauna is sort of my de-stress zone. And it's quick, 15 minutes, a couple of times a week. It's very nice. And the great thing about it, you can't take your phone in there. If you take your phone, I've tried, it's about 5 minutes before it melts down.
Vlad, please be careful. I want to continue to talk to you into 2026. Just be careful, dude. Good to see all the stuff you're working on over there at Robinhood. I appreciate you coming to invest. Thank you so much.
Thanks, Saz. Good to see you.
Thank you. All right, let me send it over to Jared Blickery.
Thank you, Brian. Bitcoin down over 2% today, trading just under $99,000. Suffice to say, the crypto sector has been on a roller coaster ride this year. And today we've got some exciting news to announce. Starting early next year, following crypto markets is about to become much easier. We're excited to announce that Yahoo Finance is launching a brand new crypto hub soon, partnering with industry leaders like Bankless, CoinMarketCap, Decrypt, Real Vision, The Block, and more. We're also going to be bringing in NFT data to the hub as part of a partnership with Crypto Slam. This new hub will serve as a standalone spot for comprehensive written and video news coverage of all things crypto. We'll be right back.
Welcome back to Yahoo Finance Invest 2025. I'm Brooke DePompa, live at the NASDAQ here in Times Square, and it's time now for the Market Minute. A retreat in U.S. stocks picked up pace as investors absorbed the end of the longest government shutdown, and the tech-heavy NASDAQ composite leading losses, while the Dow backtracks after its second record close in a row. Michael Burry, who rose to fame for his 2008 bet against the U.S. housing market, has terminated the registration status with the SEC for his hedge fund, Scion Asset Management. This news comes after Burry recently bet against AI, disclosing a short position on NVIDIA and Palantir. Lastly, Planet Fitness provides long-term financial targets. CEO Colleen Keating noting there are several catalysts for growth coming together. The company projecting low double-digit revenue compound annual growth rate for fiscal years 2026 through 2028. For system-wide club sales, Planet Fitness is expecting mid-single-digit growth. And that's your Yahoo Finance Market Minute. And now a look back at the year in crypto.
We're seeing companies buying huge amounts of Bitcoin, and there's just not that much Bitcoin to go around.
You're seeing stablecoins become more part of the mainstream economy.
We have seen sort of an explosion here ever since we got these spot Bitcoin ETFs. There has been huge growth.
It wasn't just the fastest growth in any ETF we've ever seen. It was remarkably so. It was 5 times faster than anything that we've seen in the ETF space.
Bitcoin was introduced in 2009, and we still have no major legal use cases for it.
We're not allowed to own Bitcoin. The Federal Reserve Act says what we can own, and we're not looking for a law change.
It basically opens season for banks, large retailers, fintech firms, anybody to basically issue stable coins. Allowing that is going to be able to open up the ecosystem in a bigger way.
If you think about it, it's pretty obvious you want the 50% return, not the 20% return. I'll be buying the top forever because I'm expecting Bitcoin will continue to appreciate.
Well, Bitcoin has made a record run this year, but there has been some volatility along the way, especially recently. Crypto's popularity has also soared. You could make an argument that 2025 has been the year that crypto has truly arrived in the U.S. between an advocate in the White House and a wave of institutional adoption. Yet crypto exchange Kraken will be marking its 15th anniversary in 2026, making it the veritable granddaddy in this still young industry. The market has gotten a lot more crowded in that time and more established. With more on where the industry is going from here, we're joined by Arjun Sethi. He is Kraken co-CEO. Thanks for being here, Arjun.
Thanks for having me.
I do want to ask about price first, because there is some interesting price action today. We've seen Bitcoin fall below 100,000. How closely do you watch the prices, and how much is traffic on your platform correlated to the price of Bitcoin and other cryptocurrencies?
Yeah, just like any other asset, the more it goes up, there's speculation around it, so people get interested in it, and then they try to buy the asset. When it goes down, you tend to get a little bit more negative news, but that's across every asset class, crypto, ETFs, stocks, shares, et cetera.
So are you concerned at all that with that volatility that, that there is this drop in traffic, and how long do you think that this drop in crypto could last?
Yeah, so for our platform, we have over 400 plus crypto-related assets. We have all of the stocks and ETFs in the United States, as well as some international stocks that are going to be on the platform soon. So for us, it's across the board. One thing I think that's important is if you just look at the general slope of crypto, Bitcoin from 6,000 to 15,000 to 25, back to 8 to 50, back to 16, then 80, et cetera. You always have these curves that have continued to change for all asset classes. And I think what's much more important is what is the thesis behind why you'd want to buy Bitcoin or Ethereum or any of these assets versus hold a dollar or any other shares.
And do you think that sort of philosophy or reason for buying it, that is going to expand regardless of what happens to the price?
Yeah, there's going to be micro and macro cyclicalities across all jurisdictions. So the U.S. perspective is that we'll take a look at traditional markets, but we're in Australia, Canada, United States, UK, Greater Europe, et cetera, and then the rest of the world. All of these markets, in some cases, they don't have access to their own equities markets. So they're looking to buy assets that they consider safe. Most of the time, those assets are US assets. And crypto is one of those as well. So Bitcoin, Ethereum, the alts, Solana, et cetera, become sort of more synonymous with safety over time. And then the next phase of safety has been US Treasuries, which are stable coins, and then tokenized equities have been like a huge boon for us and other platforms as well, which is essentially similar to US Treasury as an asset that's safe. People want access to McDonald's, S&P 500, NVIDIA, et cetera. And I think that's great because you're leveraging the global liquidity, global access, global distribution through any global platform out there to be able to get access to these assets no matter where you are in the world, no matter what platform you use.
I do want to get more into tokenization, but first to kind of take a step back here for people who aren't as familiar perhaps with Kraken. You guys have a lot of traffic internationally as well. You know, there are a lot of crypto platforms now. As I mentioned, you guys have been around for a long time, but there are a lot of crypto platforms that are accessible here in the US, and we're seeing an increasing number because existing platforms like a Robinhood, for example, has gotten more and more into crypto. So how should people think about Kraken? What is the identity of Kraken versus some of those other platforms?
Yeah, so I'd take a step back in that the TAM is large, right? The total addressable market around how to get people access to these financial products in the first place. So over time, you've seen a lot of these fintech companies just give broader access, underbanked. You have neobank services, et cetera, sort of converging on giving people access to any type of yield or savings. So the way to sort of think about it is you have all this open access. We talk about open internet, open banking, et cetera. Well, worldwide, that hasn't really happened that much. And so the first new movement worldwide in terms of distribution is mobile phone, access to internet, and now global internet capital markets, which is essentially crypto. And then you're moving assets into that. And so we've been worldwide since day one. We've been fully remote since day one. So it just gives us access to a larger pool of customers. I think what has always made us different, frankly, is outside of core features is our culture. So what do we stand for? We stand for your property and your money is yours. It's your sovereign property, similar to how we think about our own freedoms and assets here in the United States. We want to be able to bring your assets, similar to how we think about crypto, is like it's interoperable. You can move it the way you want to. If you want to opt into a program that gives you a certain amount of yield, then you go to who you trust. And so we're vertically integrated in that way, which is we're an exchange like NASDAQ, and then we have an interactive broker-style platform for you to be able to use our products to be able to buy any of these assets that you want. And so crypto is where we started. Crypto native is how we were born. But those principles are what carries us for all the other products that we give access to. So, a lot of people talk about financial inclusion. I think of it more as how do we get more and more participants to get into the ecosystem. Crypto is the rails in the back end for us, and in some cases it's freedom to do whatever you want with your money. But the ability to have freedom to do what you want with your money is to be able to have forward mobility in the first place. So at a time where we're talking about, how do I participate in the capital markets. We're talking about socialism in some cases. What do I actually get for my money and who are the services that I use? I think the traditional institutions are capped to high net worth individuals and larger folks that have pooled capital for better products. We want to bring all of those products to everyone worldwide.
You guys also have expanded more into the retail side. You bought a company called Ninja Trader earlier this year. Historically, you had been more home for maybe professional traders. And again, this is an area that some of your competitors are getting into more. Coinbase, for example, is leaning more institutional now. So is that a threat for you guys? How do you think about that competition?
Yeah, I generally don't like the terms when people say retail or institutional. It's as if you're pitting people against each other. And so, what does the average consumer do when they're starting off, like as an entry point? What does someone do when they're, in their midlife of their career? And then what does a high net worth individual do? Like that's the aspiration for everyone, right? Like whatever your asset might be from your job where you get paid a salary plus a bonus and maybe equity depending on how you work. And so worldwide, these things are changing. And so the way in which we categorize our customers is that we started off with an exchange for active traders and professional traders worldwide. They eat the same, they think the same, they read the same, they were educated the same. Purchasing power parity is very similar worldwide. They're the basis and the strength of our liquidity, our global platform, our rails, and they just give us the ability to create all these products for consumers. And so, traditionally people will say retail, but I think of retail as like this transactional model of an individual. It's like, what do you care about? What do I care about? What will my kids care about? And so it's consumers on their journey, and then we build a separate set of products for them that are powered by our liquidity engine or Kraken exchange. And so the interface is different. So we have app called Crack, which is for sending, receiving, and getting yield, similar to how someone who is a high net worth individual would get. So if you want a 5% yield, hopefully in the future 8 to 15% yield, instead of having millions of dollars to get access to that product, you can have $5,000 or even $1,000. And then for our institutions, what they really care about is custody, safety, security. So we offer a lot of these yield products. So the DATs that we all hear about in the public markets, we support them.
Digital asset treasuries.
That's right. The companies that want to buy and hold on their balance sheet Bitcoin or Ethereum or any alts, we support that too. And then there's these protocol companies that are listing their tokens, we support them as well. So this is not any different than banking and financial services and the institutions that we're used to. We are building institutional products, but they are supported by our customers in the first place. And we consider, as a part of our ethos, free and fair and level playing field. So a professional trader, a consumer, or an institution, when they come onto our platform, they're able to trade, store, save, get products all at a equal access.
You mentioned tokenization a little bit, and I know you guys have a tokenized stock product outside of the U.S. called X Stocks, right? How is that product doing, and do you have plans to bring it into the U.S.? I mean, the sort of use case for it seems more logical outside of the U.S. So talk me through how you guys are thinking about that.
Sure. So similar to stablecoins, we built out our platform called X Stocks, or it's tokenized equities. It's permissionless. It's across multiple chains today. So Solana and ETH are the two main ones where we launched, and it's available worldwide, including most of Europe. It's not available in the United States yet, but we're hoping that changes over the next coming months to years. The way to think about it is, again, as I mentioned before, people want access, no matter where they are in the world, to what I call safe assets or growing assets. And it's either a hedge against inflation, or they want to be able to have forward mobility. So if you're a shopkeeper in Latin America and you want access to the S&P 500, you have access now. And if you want to get yields for it, you can do that as well. But I think what's more important is that there's global distribution of getting people onboarded into the U.S. capital ecosystem. What's really great is you have more people participating, you have more liquidity in the ecosystem, you have more owners worldwide that sort of think the same way we do here in terms of what our U.S. capital values are. And that ends up being really great. And so it has become one of our fastest growing products. I think we just passed 10 billion in transactional volume on a tokenless, permissionless platform. And it's not just available on Kraken, it's available on the Phantom Wallet, it's available on a Solana DEX in any of these markets. And so I think what's really great is, like, while we're creating our product, we don't also want to force people into a walled garden where they say you can only buy equities with us, you can only buy crypto with us. If you buy with us, you can move it to a wallet. If you want to buy from another wallet and bring it to us, you can, as long as our banking and financial services support what you want. That's what we're there to do in terms of their workflow.
I want to ask you about regulation, particularly here in the U.S., because Kraken's not available in every state, and not all of your services are available in every state, in part depending on particular coins that people.
We're available in all states but one.
All states but one. What's the one state where you're not available?
We're still not available in New York today.
New York, which is where we sit right now. So do you think that's going to change? And as I said, even if you're available in all states, there are certain things that are not necessarily available in all states. Do I have that right?
No, we're available with about 99.9% of all our products in all states.
Do you think New York's going to change? And do you think in general you're going to see more loosening of regulation here in the U.S.?
Yeah, I don't think it's about loosening of regulations. This is kind of the proverbial thought, is that if there's any change in the way in which regulations are structured, that you're not protecting the consumer, right? Consumer protection is at the, like trust, safety, and consumer protection has to be at the forefront. And this is very similar in Europe. And so a lot of the conversations people are having now are, how many disclosures or, like the cigarette disclosures that you're going to get cancer, do you have for products that are actually meant to give people forward mobility? And I think a lot of the discussions we're having is, okay, well, what are the types of financial products that you can get out to people? And so in New York specifically, I can't speak to like what they're thinking, but in the United States, we had the Genius Act, which is around legitimizing one-to-one backed treasury yields into stablecoins. And then the next phase is going to be what people call market structure, or the Clarity Act that passed the House, which is like what are the ways in which you can get financial products now through the exchanges into the United States. And so once that happens, I think what's going to be great is it'll be a flood of innovation, a flood of capital, a flood of products that can come in and actually start innovating with us, not just one or two companies.
Finally, I want to ask you, you might have seen the headline that Grayscale filed for its IPO today. There's been a lot of crypto IPOs this year. What are you guys waiting for?
Look, I think the best way to run a company is to be prudent and disciplined, first and foremost, and also who are your customers and who do you cater to. So we've got 3 large constituents, and what we want to be able to do is talk to them about we're financially sound. We know how to have our own risk management around how we run our company. We have enough capital on our balance sheet today as a private company, and that we don't race to the door as quickly as possible. The fear of missing out because everyone else is doing it. And so I think what's good about these companies coming out first is that they are educating the market on what's good and what's bad, what margin looks like, how do you make money, et cetera. I think for us, we're going to do it how we think about what public markets mean, in terms of access to capital or trust when our clients want it.
All right, thanks so much, Arjun. Appreciate it.
Thanks for having me.
And there's still much more to come here on Invest. Ahead, we've got a conversation with Delta Airlines CEO Ed Bastian, plus Reddit co-founder Alexis Ohanian joins us. And are you retirement ready? Her Money founder and CEO Gene Chatsky has the tips you need to know. We've got more Invest next.
Welcome back to Yahoo Finance Invest. As the crypto market matures and goes more mainstream, investors face both unprecedented opportunities and growing complexities. And we took to the streets of New York and got a sense of how people feel about crypto.
What are your concerns about crypto?
I think I'm going to sound old when I say why it scares me, but I feel like if it's not tangible, it's a little scary to think about, right? Like, you don't know where it's going or what it actually is. You can't hold it.
I tend to hold all of my crypto in self-custody because I feel more comfortable with that, and it gives me more opportunities to use decentralized finance, which is a great way to earn yield on your crypto.
I don't think that coins like Doge really have that much utility per se, but they're interesting to invest in, just to dabble in a little bit to see where it goes.
We're taking a closer look now at the evolving landscape of investing in cryptocurrency. We'll unpack what's driving returns and what could derail them. Joining me now in this conversation, we got Dan Dolev, Mizuho Securities Managing Director and Senior Analyst. Got Mark Palmer, the Benchmark Company Equity Research Analyst, and John D'Agostino, Coinbase Institutional Head of Strategy. Guys, welcome all. John, I will start with you. Let's start on Bitcoin, because we hit 126 all-time high in October. We're down about now 22% since then, John. Explain this move to us. What's going on here, and what do you think comes next, near, intermediate term?
Well, in terms of short-term price movement, not to be trite, but more sellers than buyers, right? That's ultimately what happens. So I try not to, we as an exchange care about price discovery and efficient price discovery and value transfer, and not so much causality behind short-term movements. But I'll remind everyone that this is an asset that is up an extraordinary amount over the duration of its lifetime. Year on year, we're still looking at, I haven't done the numbers yet, but probably looking at 35, 40% year-on-year return, even with the drawdown. The ability for an asset that has as much upside as Bitcoin to periodically have these types of price corrections or mean reversions, however you want to phrase it, it shouldn't be surprising. So throughout I think I've not been on your show, but all the shows I've been on during the bull run, the advice is the same. Dollar cost averaging into volatile assets is smart. If you believe in the thesis, buying at a discount in a consistent, sober, thoughtful way also seems smart.
Mark, let me get your thoughts. Same question about these moves we're seeing. I should mention, so Bitcoin down 22% from that all-time. I'm just saying Ethereum's down 35%. Solana's been cut in half. What do you think?
Well, I think one of the things that's been overlooked is the fact that back on October 10th, we had what was effectively a cataclysmic event for the crypto market that the mainstream may not have picked up on. But we had a flash crash. And in that crash, we saw about a quarter of the crypto market makers go out of business, which if you think about that, translate that to traditional finance, that's all you would hear about in the news. But as a result of that, we are seeing some healing that's going on with regard to the liquidity in the market. And at the same time, one of the big catalysts for crypto is the potential signing into law of the Clarity Act, which would create a regulatory framework for crypto. Well, the U.S. Senate was not going to be taking that up when there was a government shutdown going on. So you had a confluence of the larger macro with a crypto-specific event, and here we are, quite a bit lower than where we had been a month ago.
Dan, here's a simpler question, but honestly, it's a question I will get from friends and family. They'll say, what is Bitcoin? What is its point and purpose? One school of thought, I've had guests on the show who say, don't overthink this. It's digital gold. It's just a hedge against fiscal irresponsibility here and abroad. Is that how you see it?
I view this more as obviously, I think it's more of a risk asset than most people give it credit for.
Why do you say that, Dan?
Because it trades down a lot when markets are volatile, right? So I think those movements, that volatility, you see something that trades down or up so much, so quickly, and it's gone up so quickly over such a short period of time, that to me is the epitome of a risk asset, more than people give it credit for. That being said, it's a VIX on the NASDAQ. If you think about it like that and you don't overthink it, if you believe that we're headed to a great place and we have our sort of official price target for Bitcoin and it's going up, then it should outperform.
What is that official price target?
I think when we cover MicroStrategy, so we have to have an official price target. I think we're close to 150 by 2027. That's kind of when we published our note on MicroStrategy. That was our sort of official stance of where it's headed towards.
John, here's a question that came up today at Invest. Will Bitcoin ever be as big as the gold market? We talked to Michael Saylor. You might not be surprised that Mr. Saylor says yes. Here's what he says. He says Bitcoin will be a larger asset class than gold. Puts a year on by the year 2035. What's your reaction to Mr. Saylor?
So he's a very smart guy. And I read his analysis of why that would be the case. He's tying it to the virtual end of Bitcoin production, and the fact it will take 100 years to produce that the incremental 1%. He's not wrong that in terms of, if you look at other assets that are priced by the marginal unit of production, like say crude oil or natural gas, it's not uncommon for those assets to spike up when that marginal unit of production gets more scarce. So if that extra barrel of crude oil coming out of the ground is bid after, then crude oil prices will go up, regardless if there's 1 trillion gallons under the ground. So his analysis is thematically reasonable. Hard to tell what's going to happen, but I view Bitcoin as complementary to, as opposed to a replacement asset for gold.
You could own both.
I own both. I mean, in terms of the look, long-term inflationary hedges are difficult to figure out, and most large investors have not figured them out. So you can dollar cost average the global economy over time. That would be some type of inflation hedge, or you can try to pick a basket of assets that you think will perform well. Most funds that have looked at that problem, when they run the analysis, Bitcoin is a part of, maybe not the only asset, but a part of that asset. It incrementally helps inflation hedges over time because, again, it can be viewed as a hedge against money printing.
What's the risk? I'm listening to this.
Sure.
John, I hold Bitcoin. Yep. What's the risk it ever goes to zero?
If you think about the universe of things that would have to happen, what's the risk that the internet ceases to exist?
Mm-hmm.
What's the risk that the plumbing that interconnects us as a society goes away? So I hate to ever, I mean, look, crude oil went negative less than 2 years ago, right? The world's most important valued commodity. For a brief period of time, you had to pay someone to take it, right? So who would ever imagine that could happen?
Mm-hmm.
Obviously, it's not negative now. So markets can do really weird, crazy things. So I don't look at short-term price corrections when I think about the underlying thesis for why it should exist. The computational complexity that represents Bitcoin at this point, to unwind that completely, as well as the hundreds of millions of people who believe in it, is it possible, perhaps? Is it likely? No.
Mark, let's give people some investment ideas. All right, here's three as we head into 2026. You're telling clients, got three here, correct me if I'm wrong, Galaxy, Hut 8, and Strategy.
Yes.
Is there a theme or common themes that sort of join those together, Mark?
Well, with the first two, with Galaxy Digital and Hut 8, these are hybrid firms. Galaxy Digital is actually our top pick in the space, and that's because it provides two ways to win. The company's base, what it has built since its founding, has been an institutional platform focused on crypto. They're basically trying to build a merchant bank a la Goldman Sachs around crypto, and they've been able to get a significant first mover advantage as a consequence of that. So as we see institutional adoption of crypto increase, with the Clarity Act being a near-term positive catalyst in that regard, that business should do very well, as should the institutional platform at Coinbase. At the same time, Galaxy Digital, by virtue of buying a Bitcoin mining plant in Texas, back in December of 2022, when we had just seen the FTX collapse and people were thinking this was the end of crypto, they bought this facility for Bitcoin mining. As it turns out, it was convertible into an AI data center. And so now the company is sitting on 3.5 gigawatts of capacity in Texas. It's already signed contracts for the first 800 megawatts with CoreWeave. And the value of that, according to our sum of the parts, is, at least at this point, greater than the value of the institutional platform. But you put the two together, and there's an awful lot of upside. Again, a couple of different shots on goal.
Dan, those are Mark's picks. When clients are asking you top ideas heading into 2026, what are you telling them?
Robinhood is kind of I like two names very much, and there's another name that I want to mention here as well. So Robinhood is kind of your quintessential killer app, right? I know the price has been up a lot, but I think you just had Vlad on TV here for a long interview before that. They're just a machine. They're going after a $600 billion plus TAM. Today, they're less than 0.5% of that TAM, and they're going to 10x the company. So that means this could be like a $30 billion revenue company in a few years, not that far along. I also love Affirm.
Why do you love Affirm? We had Max on as well.
How could you not love Affirm? I love my wife, and I love Affirm as well. Don't get me wrong. My wife and my kids, and then Affirm, in that order. But
why is Affirm a buy here? Strong buy.
Because the TAM, the total addressable market for Affirm, is literally unlimited. What I mean by unlimited, it's basically all of credit, and they're offering a way for young people, and not necessarily poor people, but young people that don't like credit cards, don't like to revolve credit, to basically take a loan, like pay as you go, right? And I do also want to mention eToro, which we feel like is in an inflection point, right? The moat of eToro is much stronger. The valuation is a fraction of what Robinhood is. And you saw in this quarter that they reported, it's starting to gain momentum. So I think that's kind of the value play in the, let's call it like high valuation stocks.
I saw, Dan, I just want to ask you, I think I only saw one sell in your coverage universe. Correct me if I'm wrong, but I think there's only one underperform. Is that Circle?
Yeah.
Why is, and I know sometimes you have sells, maybe sometimes you do, yeah. Sometimes you have strong sells. Is this a pound the table sell?
This is like a sell with a vengeance.
With passion?
Yeah, with
All right,
passion.
why the passion on Circle?
We initiated, it's actually good, I'm very glad you asked this, but we initiated, I was just looking at it today. The stock was at $207 and everyone was drinking the Kool-Aid, the stablecoin Kool-Aid, and we're like, it's not worth that much. It's a great company, but it's not worth $207. We put an $84 price target, and if you look at it today, it's actually, touching our price target, back and forth. Rates are coming down. Their circulation is not going up much more beyond, like sequentially the circulation of USDC is like in the mid 70s. And they have to pay more and more for partners like, our esteemed partners here at Coinbase and others in order to get the stable coin. So it's like a buyer's market, not a seller's market. So, we still think there's, obviously like more bad news to come on that front, and we're pressing the sell on that one.
John, let me ask you this, because we were talking about catalysts for crypto. What are risk crypto investors you think have to think about broadly in 2026? Is it leverage, John, regulation, custody risk? What should I have on my radar?
So the macro thesis, quite frankly, looks good. I mean, and I know the price action recently hasn't been great, but we're looking at massive regulatory unlocks. Under the radar was a recent IRS unlock, where the IRS came out and provided real clarity on tax issues around crypto, which I think was a underserved point. We've got massive increase in institutional adoption, Coinbase's announcement of Citi partnership, JP Morgan using. So I think there's going to be periods of peaks and valleys, ultimately. So again, the idea of trying to time the market, I think, would be the biggest risk. Because a sober dollar cost averaging approach, given the regulatory unlocks, given the increased institutional growth, seems smart. But I think, to answer your question fully, I think market timing and avoiding trying to market time would probably be the biggest risk.
John, you might have line of sight here. Who owns Bitcoin right now? I mean, is it Josh? Is it institutions? Do we have a good, know what the breakdown is?
So there are charts floating around. Depending on whether you view BlackRock as a single institutional owner, which I don't, because their sales come through people buying via the ETF. You'll see numbers saying that the majority of Bitcoin is now institutionally owned. There's been recent selling from large old owners of Bitcoin. So I think the general thesis is it's moving more institutional, but again, you have to unpack the nuance of that. The ETFs have been extraordinarily popular. And so I view ETF as retail ownership, even though it's coming through an institutional wrapper. So I think we're looking at about roughly 50% ownership of institutional versus retail.
Mark, I'll end with you. Obviously, no surprise, one big theme we're talking about today, all things AI. When clients ask you, Mark, help us understand how AI and crypto intersect now and looking ahead. How do you explain that to them?
Yeah, well, I just gave one example with Galaxy Digital. Another is HUD 8, which is a company which has had as its basis Bitcoin mining, and then was able to evolve into a hybrid company that also had AI data centers. What is the common denominator there? Energy. It's the energy underlying this, which is really the key underlying theme, that if you can harness that energy, collect energy-related assets, then those can be allocated to Bitcoin mining, to AI training of large language models, or whatever the next technology is that comes along. So I think that as it pertains to AI, and I'd say this for crypto as well, you really have to be open-minded and flexible at this point, because we're so early. Even crypto. We just had the 17th anniversary of the release of the Bitcoin white paper. Bitcoin is not even an adult yet. It's still a teenager. We act like we're in this next stage of institutional adoption, when really we're in a very nascent period. With regard to AI, yes, there were folks who were talking about AI a few years ago, but not like now. Not with the kind of intensity that we've been seeing. That's going to be going into directions that we cannot foresee at this point. So it really is important to be flexible, to follow the trends, and to be open-minded, and to find those common denominators, such as energy.
As one guest put it to me today, he thinks AI, we're not even in the early innings, we're still in the batting cage. There you go. Fellas, great discussion. Thank you so much. Appreciate it. Let's send it on now back over to Brian Sazi. Brian.
All right, thanks, Josh. That bullish call on Hut 8, very well timed by Mark Palmer. Coming up at Invest, one of the biggest drivers of crypto this year has been a seismic regulatory shift in Washington, and a lot of that driven by President Trump and his family. Straight ahead, American Bitcoin's Eric Trump is here with Hut 8 CEO Asher Ganud. Plus, a check on the health of the travel industry, especially as flights get canceled thanks to the government shutdown. My conversation with Delta Airlines CEO Ed Bastian is also coming up. It's been an interesting year for Bitcoin. Policy wins, volatile price swings, institutional money pouring into ETFs, and a new wave of mining ventures taking shape here in the U.S. One of the biggest new names in the crypto space is American Bitcoin, backed by Eric Trump, Executive Vice President of the Trump Organization, and Hut 8 CEO Asher Ganud. The business aims to make the U.S. a crypto mining superpower. Hut 8 specifically is also looking to capitalize on the intense energy use needed to power AI data centers. I have been really looking forward to this chat at Invest all day long. I'm here with both Eric Trump, co-founder and chief strategy officer of American Bitcoin, and Asher Ganud, executive chairman, to talk about the business behind Bitcoin and where this is all going. Good to see both of you, gents. Eric, coming right to you out of the gate here. You are the ultimate hard investment guy, building world-class properties, golf courses around the world. Explain to us where does the passion come for Bitcoin?
Well, listen, it's the greatest hedge against hard assets. I really believe that with every aspect of my heart and soul, right? I mean, it's immediately liquid, it's global, it's transferable. You can transfer 24 hours a day, 7 days a week, instantaneously, hardly any fees. You can't do that with hotels. You can't do that with real estate. So I think it's the greatest hedge against what I do every single day, which is kind of the hard asset world. You know, I think it's also a great hedge against inflation. It's a great hedge against corruption. It's a great hedge against, poorly managed monetary systems around the world. And I think that's why you see this global influx to Bitcoin. I think it's become probably the greatest asset of our time. You see roughly 70% appreciation on average year over the last decade. Name an asset that's had that kind of appreciation. You just won't, find it, Brian. So, and frankly, a lot of this for me personally, because we have a little bit of a political hat in my family, as you know better than anybody, comes out of getting canceled by banks over and over and over for doing absolutely nothing wrong. And I think cryptocurrency is going to be the future of finance. And I think blockchain solves a lot of kind of the weaponization of the banking industry that's affected so many, not only in this country, but around the world. And so I'm deeply passionate about it. American Bitcoin is going to do it better than anyone. I mean, we started the company just under 8 months ago. We're the 25th largest Bitcoin accumulator in the country right now, public at least. And we're climbing that ladder very, very quickly. So,
Unbelievable things to come, and I'm incredibly proud of Asher and everything that we've created on this end.
Strong start for American Bitcoin, Eric. What's next for this company over the next 12 months? What is your product roadmap? And then even along the same lines, how in the world do you mine Bitcoin so cheaply?
We mine Bitcoin so cheaply because we've got cheap energy. And by the way, isn't it nice to be able to do that in the United States of America where we actually have favorable energy policy? We haven't had that for a very long time. You see it with oil and gas and everything else coming down to record lows right now. It's a beautiful thing to see. America has to lead the way. Energy cost is everything. Energy cost is directly correlated with GDP. The lower the energy you have, the higher your GDP, and that's what we want for this country. So we're doing it in West Texas using some of the lowest energy costs. Brian, we're mining Bitcoin for roughly 50 cents on the dollar to the average, to the spot price of BTC. Every single day, 24 hours a day, we're mining Bitcoin and we're adding it. And we believe this asset's going to be transformational. Listen, a little while ago, I looked at the exact price of Bitcoin 2 years ago from today. You know what it was? It was 36,500, and now it's sitting at 105, 104, bouncing around. It was up past 120 a month ago. Bitcoin has been one of the greatest assets of our time, and even now, as you see volatility, which you always see in cryptocurrency, because naturally a slightly higher vol, we're still 170, 180, 190% higher than we were at this exact date 2 years ago. And I think that speaks to the fact that everybody around the world wants it. Every Fortune 500 company is putting it on their balance sheet. Every family office is buying more and more. People are hoarding it. And this isn't just in the United States. This is all around the world. It's an incredibly exciting asset class. And I believe in Bitcoin with every aspect of my heart and soul.
Eric, you know everybody in this industry, of course. Earlier on, we kicked off our conference with Michael Saylor, a.k.a. the Bitcoin King. He really made a strong case that more companies need to have Bitcoin on their balance sheets. Do you have Bitcoin on the balance sheet of the Trump organization? And if not, why not?
We have a ton of it on the balance sheet. I'm incredibly proud of that. I've got a ton of it on my own personal balance sheet. And obviously I'm going all in terms of American Bitcoin. I mean, we're setting up the greatest Bitcoin company in America, listed on the NASDAQ, ABTC, using Hut 8's infrastructure. Asher is one of the best people in energy anywhere in the country, anywhere in the world. And we're mining it, as I said before, for roughly 50 cents on the dollar. There is no one doing it that's better than us. There's no one that's doing it with more passion than us. There's no one who's doing it quicker than us. Listen, we've been listed for under 3 months at this point. And every single day, it seems like we're passing another company. And these are major companies that you know about. And so we're climbing that ladder very, very quickly. And again, our success thus far is beyond incredible.
Asher, let me get you into this conversation. Just before you came on, we had Mark Palmer really make a strong bullish case for your company and what you're doing. For those not familiar, where is your infrastructure situated? And then day to day, what do your operations do?
We run sites all across North America. We have sites in Texas, we have sites in New York, we have sites across Alberta and across all of North America. Our sites are split up in power generation, so we own power plants, and also data center capacities. Data centers that power Bitcoin and the network that everyone relies on in order to securitize Bitcoin, the asset, and then also sites that we're building data centers for that are powering AI use cases as well. We're a believer at Hut that energy is the fuel that powers all future technologies, and we want to be in the center of technology and power.
Asher, you're building a pretty substantial site, I believe, in Louisiana. Do you have a tenant for that yet?
We have not announced the tenant for that yet, but as everyone knows, power is extremely scarce right now. It's a really large campus in Louisiana with near-term power, and so we'll share more about who's going to go there in short order, but we've already started moving ground, construction on the site, and building a lot of the electrical infrastructure.
Meta's nearby, Asher. Is it Meta? I have to ask.
We haven't shared who it is, and we will soon.
Fair enough. Look through, seen through your prism. We've been talking all day long about an AI bubble. Is that talk ridiculous?
I think in any large-scale wave and systematic shift, you're going to see building. And I think people are saying, how much money is going into this infrastructure? Our belief is AI is going to fundamentally change the way that we operate in the world, the way that normal people transact, how they transport themselves from location to location, how they work in the workplace, at home. And so we think AI is just at its beginning innings of its impact on the world and on society. And in order for that impact to happen, we need to build data centers to power that compute. And so the question is, are there too many data centers being built? Are there use cases already happening? People need to invest today for where the future is going. And so we think we're still at the beginning of that investment cycle and that integration into what AI is actually going to do for the average person.
Are there too many data centers being built?
We have not enough data centers being built. We need more power generation in the US, we need more transmission, and we need more data center capacity.
Eric, let me get back to you here. How do you see crypto changing the future of the financial services industry?
Well, first of all, I think it's going to onboard trillions of dollars into the U.S., right? That's happening every single day. You know, no country wants their own home currency other than obviously the U.S. dollar. No one wants a euro. No one wants the pound. No one wants, any of the Asian currencies. Guess what they want? They want the U.S. dollar, and so you have stable coins every day that are bringing trillions of dollars every year. That's bringing trillions of dollars onto American shores. You're going to see more and more of that happening. Second of all, the speed of finance is going to go up. There's not going to be waiting, 36 hours, 48 hours over the course of a weekend to be able to send out a wire transfer. That's going to become instantaneous. Fees are going to go down. Convenience is going to go massively up. So much of the blockchain technology is going to tokenize assets. We're seeing that every day. In fact, some of our buildings are being tokenized for the first time. And I think you're going to have this major shift to Bitcoin as truly the digital gold. I mean, I think you're seeing more and more money that will ultimately come out of gold, and you're going to see that ratio disproportionately shift into Bitcoin because it's been the single greatest asset that we've seen, and it solves a lot of the problems that physical gold has, including weight and transferability and so many other things, right? The ability to monetize, speed of monetization, and so. Again, you're going to see crypto literally change every aspect of our financial system, and it couldn't come quickly enough. I think we're wholly behind. The banks have been antiquated for too long. The banks have frankly been the monopolies that actually have been a disservice to ordinary people who don't have maybe the Trump last name and don't have a lot of zeros on their balance sheet, who get zero advantage and have been put at actually a massive disadvantage. And there's no question that every single day you see another widget popping up on your Amazon cart being able to transact in either Bitcoin or stablecoin. Crypto is here to stay. Crypto is the future of finance. And American Bitcoin, in terms of what we're doing, being able to mine it cheaper than virtually anyone, we are going to lead the way. We are going to lead the way, and America is going to lead the way, which makes me incredibly happy as a person who loves that flag right behind my shoulder.
Eric, the crypto industry it's still volatile, and look, we're right in the middle of the latest sell-off in Bitcoin. What do you think about this sell-off, and what do you tell your investors and contacts when prices do come off the highs like this?
I laugh. Honestly, Brian, I literally laugh because it's almost like not a serious question. Again, back to what I said before. Bitcoin exactly 2 years ago today was at 36,500. And what are we sitting at? 102, 103, 105. We're dancing in that region. It's up to, we were at, well over 120. So you had almost a 200% return in a 2-year period of time. And then people talk about the volatility of Bitcoin. Hey, I'll take that volatility. Give me more volatility if I can get more return. And I think that's how crypto people are wired. And if you can't handle volatility, stay out of cryptocurrency and don't bother. But go into treasuries where you're going to have zero volatility, and you're going to click away at 3% returns. Go have a great time doing that, and I'll see you in 10 years. Embrace volatility. Embrace the future. It's clearly happening. It's not just happening in the United States. It's happening globally, everywhere. I mean, I just spoke at a conference in Hong Kong. We had 25,000 people there watching Asher and I. It's happening all over the earth, right? I mean, this is here to stay, and I'll take 200% returns in effectively a 2-year period of time, anytime, and have to deal with a little volatility. Sign me up. That sounds like the greatest investment you could ever have.
Eric, when we talked, I believe maybe more than a month ago at Trump Tower, what I didn't appreciate was how fast sovereign wealth funds are moving into crypto. From your vantage point, what are they doing, and what are the actions they will likely take next year?
Yeah. Well, listen, I think they look around the world and they see, how unfair some of these countries are to their individuals. Look how many bad currencies you have out there. Look how many corrupt governments you have out there. Look at how many antiquated banking systems you have out there. It's almost developing countries almost need crypto more than the United States does, as crazy as that sounds, because it kind of cures all the problems that they have based on the fact that they don't have kind of modern financial systems. And so sovereign wealth funds are seeing that, and they're buying into it. I mean, I've had people who run major sovereign wealth funds tell me that they're taking, and most of them are governments, they're taking all the energy from certain cities in the middle of winter when they don't need to use it to cool their office buildings, commercial buildings, and using that to mine Bitcoin, right? And putting unthinkable amounts of money into cryptocurrencies. People understand that this is the future of finance, and they are embracing wholeheartedly. And by the way, this is happening in the UAE. This is happening all over the Gulf regions, all over the Middle East. This is happening all across Israel. This is happening by certain countries in South America who are literally, adding it to their national stockpiles, most specifically Bitcoin. The passion for cryptocurrency and Bitcoin in Asia is off the charts. I mean, look at what Korea is doing right now. Look at what Hong Kong is doing right now. Look at how Vietnam is opening up right now. And so this is happening across the board. And as I said before, it's here to stay, and it is going to modernize every aspect of our financial system. It's going to make it cheaper, faster, substantially more transparent, and a hell of a lot fairer to the end user who's traditionally, and I hate to use this word, gotten screwed by the big banks, including yours truly, who is probably the most debanked person in American history for doing absolutely nothing wrong.
Ash, let me get back to you. I don't know if you saw this, but earlier this week, CoreWeave got dinged. Their outlook wasn't that great, in part because of a delay in building, I believe, a data center. As someone putting these things in the ground, how difficult is it to get up and running an AI data center, and how long does it take?
The timelines to build a data center historically have been 2 to 3 years. People are trying to build them in 12 months today. And you have to rethink how you build these assets. Instead of stick building on site, maybe you skid the design and you bring it so a lot of it happens in a factory. You have the labor to support you on site in order to run double shifts. And so in building the speed, I think at Hut 8, what we're really grateful for is we used to build data centers for Bitcoin in less than 6 months. And so the infrastructure stack is more complicated, but we have this mentality and this ethos in the company to build quickly, to think about how to innovate around the deployment of these assets. And so the first question a lot of these companies had is, can you sign a contract? The next question, which we're starting to hear, is, can you build and can you build it on time with the customer? And are you over-promising to them? Or are you able to actually deliver to them the schedules that you've aligned with? The other element in these large mega projects is a relationship between the customer and the developer, and making sure that everyone works in lockstep to make sure that answers are given on time so you can move at the speed that you need. And so across the board, I think expectations need to be set with investors, between partners, and then you can deliver projects on time and under budget.
Asher, your company gets high remarks for, I don't know how else to put it, but not taking or signing crap deals. I mean, I imagine you're getting a lot of calls to work with you in some capacity. Why is that so important at a moment like this when the AI industry is going through the roof?
We've had deals that we've walked away from and we could have announced and I think would have done well for our stock performance short term. But we believe in the value of power long term. We believe in the scarcity of that power, and we've seen that come to reality. From 6 months ago to today, you see demand continue to rise. Right now, it's peak demand. Everyone needs these assets, especially at these timelines, and we're seeing the deals get better and better. And I think we are very open and honest with customers on what type of deals we're looking for, why we think those are fair deals, and we will hold to that. And we don't need to announce a deal for the sake of the deal. We're investing in long-term assets. These are 15-year contracts, and we want to make sure whatever we sign today, that we're happy about 5, 10, and 15 years from today as well.
Eric, let me get back to you here. How do you think the crypto industry will look different after President Trump's latest term? Of course, your dad.
Yeah. Listen, Brian, I mean, I think you kind of parted the sea, right, when it came to crypto. You know, you had an administration in the past that was just anti-crypto, anti kind of progression of the financial industry, and they did everything they could to possibly stop it. My father's completely reversed course on that, and America's leading the way. What's happening is, as America leads the way, as he parts the sea, everybody else is kind of following behind, right? So all the Asian countries, obviously all the Middle Eastern countries are all following behind. They're using America's framework as kind of the framework, you know, that will give crypto guide rails in all of their respective countries. And that allows everybody to embrace it in a way that has never happened before. It's kind of hard if America's sitting on the sidelines poo-pooing something for so many of these other smaller countries to embrace. Now they're fully embracing it because America is embracing it and America is leading the way. They want to follow us. You know, they've always wanted to follow us in just about everything we do. They're also following us in terms of this AI revolution. They're also following us in terms of, you know, so many of the kind of energy procurement things that we're working on, you know, as a country. And again, that's beautiful. So I think you're going to see the crypto industry massively change around the world. And I think it's going to be one of those things that's growing so quickly right now, you can't stop it. There's no one that's going to turn the ship at this point, and certainly not in a 3-year period of time, when it only progresses even further. And this is the new standard. America's going to be very proud of it. America's going to lead the way in it. And I think Donald Trump has a very big role in that, because this was not happening 9 months ago under the last administration. In fact, the exact opposite was happening. Crypto companies were leaving the United States. They weren't fleeing to the United States.
Eric, of course, we're having this conversation a day after the government shutdown ended. And look, we could talk about who's right and who's wrong, whatever the case. I've talked to a lot of CEOs here today, and they're frustrated. They want to keep running their businesses and planning and driving corporate profits. Like, how do these shutdowns eventually end, or is this just something we're going to have to deal with?
Hey, I'm frustrated. But believe me, it affects me too. I'm frustrated. You had every single Republican voting to open up the government, and you had Democrats, because they have no platform, they've got no message, they've got no leadership, and they've lost horribly badly for the last 5-year period of time, doing anything they can to be absolute obstructionists. And it is sad. These are people's lives. This is the GDP of the United States of America. I walked through Charlotte Airport 2 days ago, Brian, and it was a nightmare. I'm watching kids fall asleep on their mom's lap as they're sitting on a floor because the terminal's so busy from delayed flights and everything else. It's not right. It's not right that air traffic controllers can't get paid, people who work their butts off and provide a great service to this country. None of this is right. None of it's fun. And then I get to watch AOC out there, talking about how she would have kept it, closed indefinitely if it was up to her, and how dare Chuck Schumer actually have the gall to try and reopen, the greatest economy anywhere in the world. These are not serious people. They're not the Ashers of the world. They're not the me's of the world. These are not serious people. They don't have to live with the ramifications of what they do. They're just willing to obstruct Donald Trump at every single turn, and our country deserves a lot better than that. So I feel for those CEOs, and I'm one of them. I agree with them 100%. Let us do what we do best as entrepreneurs and capitalists in the United States of America, and no one stands a chance.
Eric, do you see yourself running for the presidency at some point?
Brian, it's a terrible profession. I can tell you that much. I've seen the best parts of it. I've seen the worst parts of it. I can tell you, I don't wish the worst parts on your worst enemy. We were the most attacked family in history. We were the most debanked family in history, never for doing anything wrong, just because they wanted to try and take us out. In fact, I just wrote a book about it called Under Siege, and that's what they did. They put us under siege. They put our nation under siege. I became the most subpoenaed person in American history, again, having never gotten a speeding ticket in my life, because they wanted to try and get to my father, and they wanted to try and take out our family and silence our family and gag our family. That's a long way of saying, I hope I probably never have to. It was so bad, and I had the right voice at the time, and I understood the trials and tribulations of our nation. I think I certainly could. But again, I've seen the worst of it. I've certainly seen the beauty of it. You can do great things. You saw that with my father in Middle East peace. This is something the Democrats could have never done. This is something Joe Biden could have never done. So there's beautiful things that come out of it, but at the same time, it's a rough world, and you better have a family that's prepared, and you better have the fortitude to go in there and go to war every single day, as my father has done for the last 10 years.
Asher, let me get one more word to you before we wrap this conversation. For investors that are investing in your company, or for folks that want to put money to work in a Hut 8, 2026, what is your big initiative, and what does success look like?
Continue to build data centers, powered infrastructure, continue to support American Bitcoin and their growth on Bitcoin mining, continue to support all of our AI customers. You'll see us build generation around data center capacity, both of all kinds of compute, from AI compute to Bitcoin compute. And so Hut 8 is a company if you're long energy. American Bitcoin is a company if you're long Bitcoin.
Well, good luck on the road ahead. Eric Trump, Asher Ganu, good to see you guys again. I greatly appreciate you coming. Thank you, guys.
Thank you.
Thanks, Brian.
All right, coming up at Yahoo Finance Invest, lessons in entrepreneurship from one of the original sharks, Damon John, and billion-dollar investing ideas from tech investor Robert Smith and Ann Walsh, the Chief Investment Officer of Guggenheim Partners. And be sure to stick around for my conversation with Reddit co-founder Alexis Ohanian. He's a serial venture investor with more than 40 unicorns under his belt. He has also made big early bets on women's sports. I'll get into all of it next.
Welcome back to Yahoo Finance Invest. Our next guest is an entrepreneur, branding expert, and one of television's most recognizable investors. Before becoming a household name on ABC's Shark Tank, Damon John built and scaled his iconic fashion brand FUBU, short for Us, By Us. Today, as CEO of the Shark Group, he works with companies from startups to Fortune 500s to sharpen their brand and drive growth. Damon, great to have you with us here at Invest. Thanks so much.
Oh, thank you for having me.
Now, most people know you as one of the original Sharks, but I want to start with what got you here. You built FUBU at home in Queens. You were sewing hats, selling them on the side while working at Red Lobster. How did that environment shape your mindset and this power of broke philosophy that you've now become known for?
Oh, I mean, it shaped it in all kind of ways. Analytics is what people told me immediately when I sold it to them. I had to find ways to upsell a customer or make them buy more frequently, but I didn't have the internet, or I didn't have cell phones, so I had to physically find them. I had to find ways to that it added value to them, every single day. So it's the same as the fundamentals of business today. It's just that you can do it online, and a billion other people can do it at the same time.
Well, you bring up an interesting point. Do you think it's harder or easier to start a business today? Because on the one hand, you do have access to all of those tools, but on the other, there's a lot of competition, and it seems like people are a lot more fragmented in this age of social media, and then you throw AI in there, and everything just seems to be different these days.
I do think it's easier because you can open up your phone right now and go to any Main Street store and turn on Whatnot or TikTok shops, and they have the inventory. You move the inventory for them immediately. You don't have to buy it, and they can ship it. And you can already have, 2,000 people you're already talking to every day, just showing pictures of your tuna fish sandwich. So I think that's the easiest thing to do. It's just, how do you scale these type of businesses? But overall, it's easier. And at the end of the day, it's just about speed, and speed kills in business. You can't wait for the perfect time. You have to make the perfect effort right now.
Speed and also community, right? I feel like FUBU, it was this movement. It wasn't just a fashion brand for us, by us. You were really cultivating this community aspect. What did that teach you about the power of branding, culture, marketing, and how they all work together to create a brand?
Well, community is everything. You don't have anything if you don't have community. And that's what we do every single day, whether it's for our entrepreneurs or my Fortune 1000 CEOs. We turn this idea of hustle into strategy, and strategy into community, and community into results. FUBU, if you look at it, was the first kind of hashtag of clothing, but every business is technically a FUBU. Every business is mompreneurs making for other mompreneurs, or biohackers making for other biohackers, or people who want price-sensitive products, or people who want luxury because less have it. It's always going to be community. But today, even more than ever before, it's no longer making and they will come. Community is the new currency.
Yeah. And let's talk about the Shark Tank community, because you said you joined Shark Tank because you wanted to level the playing field for entrepreneurs that didn't have access to capital or those investor networks. Why was that so important to you? And how do you think the show has really changed how Americans view entrepreneurship?
Because I thank you for that. And I think that, my job as the people shark on, there are so many people who told you need to make money to have money, or to make money, you need to have it, right? And I think that show really shows people that were just like everyday people living at home, chilling. They came up with an idea, and they said, the two fundamentals of what entrepreneurs do. I'm either going to solve a problem or bring somebody joy. And if I bring somebody joy, I'm going to solve a problem. And the next year, after watching Shark Tank, they're doing $200,000, $400,000, $500,000. They have a small little staff, and they're solving somebody's problem. And I think that that's why I wanted to go into the show, because we had this idea in the past. These walls were built that we can't accomplish what we want to. And I got to tell you, I got left back in school, and I got raised by a single mother. I grew up in the hood with no money, no last name. If I can do it, everybody can do it. And if Kevin can do it, anybody can really do it.
Yes, absolutely. And let's talk about some of those pitches, right? We all love to watch the pitches. What makes a pitch stand out to you, and what are your non-negotiables when choosing who or what to invest in?
The things that make a pitch stand out to me is that somebody's telling you a story. They're not pitching you. They're telling you how the train's leaving the station with or without you. They want you on the train, but it's leaving the station. You get a little bit of FOMO. They also qualify themselves on why this problem existed and they were the one to solve it. And they also tell you how they've overcome a lot of adversity and now where the numbers are, and they've done it small, and with your help, they can do it big. The non-negotiables are the people that come in there and say, well, if I get 1% of a $50 billion market, I'll have X amount of dollars. Well, the bankruptcy market is way bigger than that. I promise you'll get 1% of that if you keep thinking like that. So if you don't know your numbers and you don't know your customers, all you're doing is using my money as tuition. But if you know all those things and you can show proof of concept, then I'm in.
Yeah, you always have to be prepared. And after 15 plus seasons, I'm sure there's a pitch that still sticks with you today. Is there a one that got away story or a company that maybe surprised you down the line?
Yes, and by the way, it's 17 years of me suffering next to Kevin, but the pitch that got away, normally I couldn't care less because whatever is coming through the door, something else coming tomorrow, but I got beat out by Lori. She's a very mean lady, and she beat me out for a stupid-looking little sponge.
Scrub Daddy.
The Scrub Daddy. Yeah, see, you know it already. And every time, it's not that she beat me out for that. Every time I walk in the store, there's a Scrub Daddy, there's a Scrub Mommy, the Scrub Baby, the Scrub Daughter. They're all smiling at me, and I think she's done about $1.4 billion in sales to date.
Wow, and you've been bringing up your fellow sharks. I'm curious what you learned from each other because you are all so successful in your respective businesses, and you come to work every day, and you all have different philosophies and ways of really curating who you invest in and the why of it all.
You know, Barbara, when she does take her medicine, I learned that, she can brand anything from anywhere. She's the smartest branding person. She can create and bring the essence out of something. Robert has this curiosity like a little child, but he's a tech genius. Kevin knows how to manage his downside with complicated financial structures and manage his upside too. Lori is very, very good in creating products all the way from the beginning, from scrap, and knowing her packaging and how to bring it in. And Cuban, of course, has always been the wild cowboy who can foresee things, take a gamble, admit when he's wrong, but just go really hard as a partner. And I love and respect them all really dearly.
Also, I've spoken with Barbara Corcoran before. She is amazing. And like you said, she really knows her stuff. Now, when it comes to the investment areas that, you're invested across a lot of different sectors, and not just through Shark Tank, but also through the Shark Group as well. Is there any particular theme that you're watching right now and you want to put money to work in that area?
Well, there's two themes. And first of all, everybody has to understand AI, right? And so there's three themes. Understanding AI right now. The next one is and embracing AI as fast as it's moving. The next one is really understanding where the consumer is and how you grab their attention. Live selling is really where you can grab attention fairly quickly and build your own community. Another one is, now I'm going to get to 4. Another one is biohacking is a section, and longevity. The people that feel like they've been lied to, and now they want to take their health into their own hands. And whether it is a mom who wants to make sure she doesn't have die number 5 or 7 in something, or somebody who wants to know about fasting. Those would be the major ones I'm trying to think about. There was one more, but I will probably get back to, social cause. That's the reason why my company, Bombas, is the #1 company in all 54 Shark Tanks around the world, because every time that you buy a pair of socks or underwear, they give a pair away to the homeless, because that is the #1 requested clothing, item of clothing in the homeless shelters, and they're in the shelters.
And what you're speaking with all these different themes, it really shows how much the business world continues to evolve, right? If you were starting FUBU today, is there anything you would change or do differently?
Oh, absolutely. I would break down the selling. I would no longer have to deal with retailers. I would, of course, do the same thing we did, where I let people know who the CEO and who the founders of the company were, because people want to know not only what they're buying, who they're buying it from, but also I would break this out into 2 kids in every university and in every high school. 1 male, 1 female. We give them about $500 worth of credit, let them buy about $1,500 worth of FUBU, and sell it themselves, kind of like the Avon model, and bring people up the ladder. This way, I would have, 100,000 salespeople out there who are giving me real data on why people are buying or not.
I love that. Utilizing those college kids, putting them to work. Another thing that small business owners are dealing with right now is tariffs and the rollout of tariffs. For the companies that you're invested in, how are these small businesses dealing with that? Are they raising prices? Are they changing up their sourcing? Are they cutting back in any way, especially at a time where we've seen this broad consumer pullback as well?
They're doing all of it. They're not really raising prices because they don't want to pass that on to the consumer, because the consumer may just not tolerate it, and the consumer does not understand. At the end of the day, the consumer has other options. They are trying to find sourcing in various different areas, but they are cutting back on their staff and people. And with the fact that AI is coming around, they can actually do so in a way that's not going to actually make them, hurt them as much as it would have maybe 2-3 years ago. But sourcing people and sourcing from factories and sourcing, finance and money is always going to be the three hardest challenges. And you should never, government's going to change, tariffs going to change, leaders going to come in and out, and various other things are going to happen. You can never put all your eggs in one basket. That's always been the rule when you deal with manufacturing.
And you were just talking about how cutting back on staff is one consequence of the current environment. And we've heard from a lot of folks out there that it's really difficult to find a job. We're in this low hire, low fire environment. Yet at the same time, we're seeing this uptick in layoffs. What would be your advice to someone that maybe is struggling or wants to take a side hustle and turn that into real tangible income?
Well, if you're struggling, understand that most jobs are going to go away. A lot of jobs are going to go away. The trade business is going to rise and going to be at an all-time rise. And invest in that education if you can. Also, you have to reduce costs of increased sales. How are you looking at your children? That's one of the issues. How are children today in high school and college? How are they taking $400,000 to $600,000 worth of student debt for a job that's not going to actually exist in another year or so? So sometimes you have to look at the entire thing as a family. What are you doing? Where are you putting the money? Are you looking at assets? Are you looking at long-term assets like bonds? Are you looking at crypto? Are you looking at, buying in Apple, buying in blue chip? Because, if you put your money in the bank, what are you going to get? Nothing. It's almost like cash is trash. So you have to look at all of these things. But if you're looking at a career, you need to start understanding, how do you gain attention? Even if you're a plumber, you need to make sure that everybody knows about your plumbing services. And then you go out and look at these baby boomers who are their kids do not want the business, how to buy more doors, more plumbing doors, so you have a larger kind of version of a roll-up. You can just buy 2 or 3, small businesses like that and roll it up and have a massive amount of business at the end of the day.
You brought up crypto. Are you bullish on crypto?
I'm very bullish on crypto. BlackRock and Blackstone are bullish on crypto now. I'm really bullish on it. I've been in for a long period of time.
Awesome. And obviously there's a lot of volatility in crypto, and really there's a lot of volatility within the stock market as well. What's your approach on general investing at a time where we see, record highs, but you can have a week like we did recently where stocks just tank? Are you a long-term investor mindset to just park your cash and see what happens?
I'm a park your cash. I see that the big institutions have to put their money somewhere. There's only a couple of categories, obviously, and they're going to put it there. I made those mistakes when I was younger, thinking that I can kind of day trade or pull out quickly. I thought I was Gordon Gekko after doing some trades after 6 months, and I realized if I'd have kept that in there, it would have been 30x from what I had it at. So I'm long term. I'm like, I'm like Buffett. I go get some McDonald's in the morning, put it to sleep, and put my money to sleep, or put it to work technically and not bother it.
All right, Damon John says stay invested. And then final question for you, what is the number one mistake that you see entrepreneurs make?
Thinking they need money. I think entrepreneurs believe that they need cash to operate a business. No, you need proof of concept. You need customers. If cash was easy to get, then everybody would have it. And if cash solved every problem, then Blockbuster, BlackBerry, and Kodak would still be here. So it's really about, at the end of the day, over providing for your customer and being absolutely obsessed with your customer, not worrying about bringing in a lot of cash too early. Don't spread yourself too thin, and stay extremely focused on over delivering for your customer, because without your customer, you don't have a business.
All right, some great advice there. The Shark Group CEO, Damon John, thank you so much for joining Invest. Jared, I'm going to send it back over to you.
Thank you, Ali. The last hour of trading is underway on Wall Street. I'm here with Kenny Polcari. Brooke DePalma is live at the NASDAQ, and Ines Ferre is live at the New York Stock Exchange. Let me just go through some of the market action today, Kenny. We got the Dow down 1.5%, the NASDAQ down 2.5%, S&P down 1.7%. We can see this on the board here. Here's the Dow. All these markets that I just mentioned having their worst day since October 10th. And I'm sure you're getting some client calls here.
You're getting client calls because people start to worry about, is this the beginning of the end? Because now we've gotten these, headlines about, these big famous investors, unloading or making negative bets. And now we see the market off today. Look, I don't think as a long-term investor, this should cause you any concern. Down 1.5 or 1.2 or even 2%.
Yeah, let's show the year to date here. Here's the S&P 500, still holding on to gains of 14.5%. And you and I were talking about the 50-day moving average earlier. Let's just put that on there.
And I was just going to say,
Boom.
Where are we? We're kissing it, right?
Yeah.
We're just sitting right on top of it. So this is going to be key.
Smooch.
Because if we pierce it, if we breach it to the downside, then expect more selling to happen because the algos will kick in. They'll go into sell mode. The buy algos will realize that. They'll step aside. They'll be avoiding prices, and then stocks will trade even lower, and they'll trade lower quicker, right? But that then, for the savvy investor, creates an opportunity, especially in individual names. You want to look when that happens. You want to be able to take advantage of the good, solid names that are being price dislocated for no other reason than the algos are going into sell mode. If the fundamental story has not changed, there's no reason for you to panic.
Let's take a look at the sector action, Kenny, and you can tell me what you make of this. Only a few green sectors, mostly defensive, healthcare in there. By the way, the leading sector since the shutdown in this quarter, but then tech down 2.8%, leading to the downside. Consumer discretionary, another mega cap sector. What do you think about this?
So these were if you flipped it around from this morning, these two were up there in the upper right-hand corner. They were the outperformers. In fact, look at consumer staples. That was down here in the red in the negative category. That one's positive today. Now it's not having a super day, but it is positive, along with healthcare, which is another sector we talked about that had been an underperformer all year, but has now started to raise its head. So I actually like that idea because it's part of, you see where money's going to go when people get nervous, and those are sectors that have underperformed and we've taken advantage of because we put money to work there when it was just kind of, felt like dead money, but is not dead money any longer.
Let's take a look at the NASDAQ 100 because I'm seeing some headlines like Tesla down almost 7% here. This is a year-to-date chart, so it hasn't been this low since September, having its worst day in I don't know how many weeks. And look at that, just threatening to cross that big psychological 400 number. What do you say to the Tesla investors?
And so that's going to be another issue because that's a key level that it's been watching and it's been hovering around. Again, if it fails to hold that, expect the algos to go into sell mode. Now look, it's funny. I was never a Tesla owner. I didn't own the stock. I don't own the car, but I like to watch the action.
Sure.
But be careful when you watch this. The trend line on this is going to be very important in terms of how the algos are going to respond.
All right, and now NVIDIA, the poster child of the entire AI rally. This is a 3-month. Let me just dial up a year to date. You can see holding on to gains of 38% there. Looks like it's not an incredibly significant level right here. It might be piercing that trend line, which I just drew in very quickly here. What do you think about NVIDIA technicals?
Listen, I think NVIDIA is fine. Again, keep your eye. Just because when the market gets nervous like this, just watch the trend lines. But look, they come out with their earnings next week.
Yep.
This is a crowded trade. The options market is telling you that there's a 90% bet that they are going to beat significantly, and that's already priced in. So even if they beat significantly, don't be surprised if you see a buy the rumor, sell the news type of event, and you'll see the market back off a little bit. But if it does, it's an opportunity to buy NVIDIA. It's not going anywhere. It's right at the heart of this whole AI trade.
I got one more screen for you, Kenny. This is our meme stock board, and some of these stocks, well, they used to be small. They're a lot bigger now. Palantir, Robinhood, CoinDesk, Rocket, Carvana, etc. What do you think of this cohort?
So again, listen, they're exciting. Palantir's another crowded trade. It's been an outperformer. So the fact that it's down nearly 7% today on a kind of an ugly day makes complete sense to me, as it does really a lot of those other names.
All right. So let me just dial into some sectors that are looking a little green today. In fact, it was looking a little green earlier, so we don't have quite as much green here. But here's energy. Here's the pharma sector. Let's leave it here. Any of these pharma names interesting to you? We had the Pfizer CEO on earlier.
Right. We had Pfizer on earlier, but when you think about pharma, you think about healthcare, and healthcare was up today, right? It's been up. And it's up again today. And these are a bunch of names. You know what I like in there? Merck is a name that I've I've liked. That's had kind of a very interesting year. It's been kind of negative on the year. It's built a base at the bottom, and it's starting to break out. I like Merck. I like it for
let's measure it from the bottom here. You can see up 18% from that April 8th bottom.
Right, and if you look at it really on a longer term, on a year chart, put the year chart up there because you'll see what I'm talking about. If you put the year chart, look how it's now. It's put in a nice base here. It started to break out. I think it's in the healthcare sector. I think it's going to continue to break out. I like Merck. I like its products. I like it's a dividend payer, so it's a great name because they'll pay you to own it.
And let me just do this. I'm going to put the quarter-to-date performance here. I mentioned healthcare is the best performing sector since the beginning of the quarter, which also happens to coincide with the beginning of the shutdown. We're seeing some nice gains here, which we haven't seen in a long time for healthcare.
Right.
So do you think healthcare is back now?
Well, listen, as a long-term investor, I always had a position, and we always have a position in healthcare. We took advantage of it when it was underperforming. So yes, I like it. I think healthcare is going to do well into the new year. And actually, you may see, if the market really gets nervous, you're going to see more money move out of some of those high flyers in communications and tech, and it's going to move into sectors like healthcare, consumer staples, which are boring. It'll still go into the tech trade and into the utility trade, though.
All right. Now I'm going to dial it back to the energy sector. This will be the last screen we show here. Now, energy has had kind of a wild ride. It was great in 2022 when we had a bear market, but it's just struggled to get back to those old highs. You think about the large cap tech sector.
Right. So think about what's happening in oil, right? The price of oil is now pierced 60. I think it was trading at 58 and change, at least it was this morning. And there's this whole story about a supply glut coming in 2026. That's a supply glut story. That's not a demand story. Demand is fine. It's really an oversupply. Oversupply is just going to force prices lower, which actually will be good for the consumer, good for the markets. But names like ExxonMobil, Chevron, the biggest names in the sector, I think are certainly fine names to, exposure to have.
All right. And Brooke, we want to see what you're looking over at the NASDAQ, please.
Jared, well, certainly I'm continuing to see these stocks sell off this afternoon. One stock that is lagging today that caught my eye is Roku. That company had its CEO sell about nearly 50,000 shares that are worth about $5.2 million. So we're seeing some downward momentum when it comes to that stock, down more than 6%. And certainly that's a similar picture, as you pointed out, we're seeing across the screen here. But I do want to point to some bright spots within the market. One of them is Nike, a company that I've been covering, especially under that turnaround strategy under CEO Elliott Hill. And that company is seeing a bit of a pop today after Wells Fargo upgraded the Nike stock to overweight. The analyst there said that it's lacing up for liftoff. That was a fun little pun there. He said that the headwinds in classics have ultimately reached a peak. He also said that upsides and innovation are expected to come through, and also this turnaround strategy that's underway. Now, another stock that also got my eye is spacecraft maker Firefly Aerospace. That company also in the green today amid this sell-off. And the company is in the green today because they plan to resume their Alpha rocket launch, and the company also beat expectations on revenue for this past quarter, and so that stock moving higher today. And another one, maybe particularly interesting here, department store Dillard's. That stock, last time I checked, was up about 15%, and we're seeing a movement into the close here up as much as that. The earnings per share beat Wall Street's expectations. We also saw same-store sales growth beat expectations as well, kind of unique for a department store. The company said that sales in ladies' accessories, juniors, and children's apparel increased significantly year over year, and this is quite unique and maybe why we're seeing some investor optimism, especially amid this concern that consumers are pulling back in this environment. Jared?
All right. And Ness, we've got you down at the New York Stock Exchange. What are you seeing there?
We're watching Bitcoin right now, Jared, tumbling to its lowest level since May, hovering just below 99,000 per token. You've got Ether that's down more than 6%. Solana also down more than 6%, as altcoins are also tumbling. And just diving into Bitcoin for a bit, it really hasn't been able to make a comeback since the sell-off in October. You had those leveraged positions that were liquidated. You've had whales that have been selling, long-term holders that have been selling. And just looking at some commentary from 10X Research, Marcus Thielen over there, and their data is showing that long-term holders are still selling. They like to sell high and buy low, and so they apparently don't think that the price has come down too much. Fund managers also are likely trimming their ETF positions. So the question is, where are the marginal buyers when it comes to Bitcoin? 10X Research based basically saying that Bitcoin's in bearish territory. They don't think that it'll last too long, but they do think that there is more downside to go unless Bitcoin can reach the $110,000 level. One catalyst that could turn things around, that's just one catalyst, would be the Fed if it lowers rates in December and more dovishness from the central bank. But moving on to the Bitcoin miners, we've seen pressure on these miners today as well. These are Bitcoin miners that have been also pivoting to AI. You have Bitfarms, one of the largest Bitcoin miners in the US, that's under pressure. This is after the company reported its quarterly results with its revenue missing expectations. But look, this is their big reveal was this plan that they have over the next couple of years to turn all of their Bitcoin mining into and focus solely on AI and the high performance computing. This is a trend that we have seen over and over again when it comes to Bitcoin miners. This is because there's more competition, price volatility, their margins are getting squeezed with Bitcoin mining, the Bitcoin halving, which is cutting their rewards. So a lot of them, what they're doing is that they're utilizing their data centers, their power capabilities, and they're servicing the AI boom. So even though you're seeing pressure today on these stocks that have been pivoting to the service the AI sector, the AI boom, year to date, investors have been happy about the fact that they have been pivoting into AI, because year to date, these stocks are up double-digit percentages, or in some cases, triple digits.
Yeah,
Jared?
Watch those trend lines in crypto. Thank you for that, Ines, and well, Kenny and Brooke as well. Let's send it over now to Julie Hyman.
Yeah, and coming up next, we're going to be hearing from Delta Airlines CEO Ed Bastian. He'll be talking about the effect that the shutdown has had on the company. As you can imagine, he's not terribly happy about it. As well as Jean Chatzky, Her Money founder and CEO, with some retirement tips for you. Don't go anywhere. We're here hard at work in the control room on Invest.
Delta celebrating 100 years in business, and suffice to say, a lot has gone on in the 100 years within the aviation industry, within the consumer, within the world. I'm really excited to bring in our next guest here at Yahoo Finance Invest, Delta's longtime CEO, Ed Bastian. Ed, good to see you here. 100 years, mind-blowing thing in corporate America, mind-blowing milestone. What does that mean to you?
A lot of pride. A lot of pride in our people for getting there. First U.S. airline to reach 100 is quite a statement. When you think about all the challenges our industry faces, the hundreds of airlines that have come and gone to have Delta reach not just the mark first, but the first to the second century of flight, and the head start that gives us on our future. But it's about people. It's about service. There's something about Delta that's in our heart. It's in our DNA. It's the consistency of excellence that we look to provide. We have great planes. We have great technologies. We have great lounges. We have great places we go. But it's the people that really make it special.
I want to dive into all that in large part because I am a loyal Delta flyer. I am, and I'm just fascinated by the travel experience. But you mentioned challenges, and the aviation industry has been undergoing some challenges with the government shutdown. At a high level, what disruption has this caused for a business like yours?
It's been very disruptive. For the last week, when you go in with no notice and you just arbitrarily reduce the amount of flying in the system for all of us, incredibly disruptive for our customers. We had no advance warning to be able to get people to different places, so there were delays. When you couple that with the amount of the accelerated pace of staffing shortages in the towers, which I think was somewhat tied to what we were seeing with the force reductions. Controllers are, and by the way, hats off to them, particularly those that have been working without pay for almost a month and a half. Really, really big thanks and security agents that are doing that. But the reality is that there was stress, there was strain. It was completely unnecessary into the system. It's our industry that forces, I guess, even government to get back together and to open up. So be it. But it's causing a pretty significant disruptive end. The good news is that I anticipate we'll be fully up flying very, very soon, in the next day or so, and hopefully, when the next time comes, we'll find a better solution.
Hopefully there is no next time with this.
But there always is.
Yeah.
But hopefully it's not our industry and our people and our customers that have to bear the brunt of the dysfunction, because the people that we put in power to run the country can't agree.
What this has exposed, this record-setting shutdown, Ed, is, like you mentioned, the shortage of critical people that allow planes to safely go in the air, the aging infrastructure. From your vantage point, how severe are these issues?
We're safe. We're absolutely safe. The safest form of transportation, period. And that's what we do all day long. We talk a lot about our brand, as I said, the airports and the fancy places we go. Internally, we talk safety all the time. And if you're not seen as safe, if you don't have that core trust element with your consumer, you can't do the things that we do. So incredibly safe. We've been accelerating over the last decade the retirement and the replacement of our fleet. Our fleet actually has gotten younger in the last 10 years. COVID partly helped, but we retired a lot of old planes during COVID, the 777s, the MD-80s, excuse me, MD-90s, and several other older models. And we haven't had an issue, because we've been with Airbus for the last 5-7 years, getting all the deliveries that we expected. They've been operating right through this period.
What has to happen to get more air traffic controllers into these spots to backfill positions that maybe aren't being backfilled?
Well, one of the most important things is to modernize the skies. The air traffic control systems were developed decades ago, 50, 60, 70 years ago, still using some of the same technologies, the same infrastructure, very manual. And when you have an environment that's so stressful, that operates with such manual intensity, it's safe. But it's safe because things get slowed, and they maintain a big margin for error to keep us all safe, which we appreciate. But the reality on that is, today it takes longer to fly from Atlanta to New York than it did in the 1950s when we launched that route.
It's hard to even grasp.
It's hard to grasp, but that's because the system is so taxed, and so it's so slow. So you do circles, you wait in lines, and you don't have the modern technologies that we use in many other transportation industries. By the way, many other air traffic systems around the world have much better technology than we do in our states. Kudos to the administration. They got $12 billion investment to get started this year. Again, it was another thing that probably was delayed during this shutdown period, and we got to get it going again. But we all need to make that investment, and that's just a down payment. I think the real cost is going to be significantly better. I don't know of a better return that you can have, because just think about how much time it's going to save being able to use the technology, how much safer it'll be. The elapsed savings that you're going to see in terms of sustainability and fuel and giving people their time back, and then allowing us to grow at a much higher pace than we've been able to grow.
From the outside looking in, people might think after a shutdown, everything gets back to normal. We're all good, dude. We're going to travel and get to where we get to. Is that the case? I mean, can you just literally flip the switch and things go back to normal?
There's no flipping the switch. We got crews that we got to get back ready for, because we've been taking flights out for a couple of days, in advance in time, and now we got to see if we can get those crews back on schedule. It'll take several days, but I'm hopeful that by the weekend things will be running very well. The last couple of days have been running pretty good in anticipation of an agreement, and I hope that's a good baseline to look at.
Ed, you're seen as one of the one of the best CEOs in the game for a long time. How have your past few weeks looked different? When you see a government shutdown, how do you manage your teams differently? How do you manage your people differently?
Well, it's frustrating. It really is. We've had, our business has been doing great. We had earlier issues.
You just had record revenues.
Record revenues this year, but we had earlier issues at the start of the year with all the geopolitical announcements, the tariff debates, the announcements, the uncertainty that existed in the economy really froze the economy. And our business runs on economic growth. And when you have the economy basically stall, which we saw happen in the February, March, April timeframe, brought our bookings down pretty considerably. We got it back up June, July. Things started to take off again. We're looking for, and we will have a great holiday season. Things were looking great. Then all of a sudden you have a shutdown that occurs, something that comes completely out of your control, but out of nowhere. We can't do business like that. We need more, from our government leaders. So we have made our points known with all our people, our elected officials. Do your job. Do your job. And I understand there's disagreements, but it should not come at the cost of asking people to work particularly in high stress, incredibly sensitive areas without pay for weeks on end. That's inexcusable.
Is the consumer okay?
Consumer is strong, but again, it depends what consumer you're talking about. Our consumer in the experience economy, the higher end experience economy, is doing incredibly well. And we've seen this for the last several years. The higher the experience set goes, the more premium it is. The demand, it seems to be insatiable. It just continues to grow. Whether that's international experiences, whether that's a hot concert tour, or last night I was at a great restaurant in the city. It was packed, hard to get a table. That's where people continue to want to invest, because they see great value, they see great opportunity. If you're providing a commodity, if you can I can do this, I can do that. If price is your determinant, that consumer isn't doing too well.
You have really pushed hard into more premium seats. You are, in effect, reinventing the flying experience. Looking out, and I saw this, I think maybe it was in another podcast you did with David Novak, former CEO of Yum Brands, talking about how the flying experience is changing because you're investing so much, and you can think about investing over the next 5 to 10 years. Like, when I sit in a Delta seat, how will it look different 10 years from now?
Well, I think first of all, it'll become a much more immersive entertainment experience. This is a journey I've been on for a long time. We have 200 million customers a year, on average 3 hours a session. They're all seat belted in, all facing the same way. If you can't figure out a way as a marketer to create value for those consumers as well as for yourself, you're not very good. And that's what we're doing. That's why we launched free Wi-Fi at scale around the world.
Thank you for that. And it all works. It works great.
And it works. And we invested over $1 billion in making that happen. People wanted to charge. They said, no, we're not charging for it. Consumers deserve that. And by the way, all those other airlines are now copying and following us for that. But that's the platform. And then you bring in an Uber, an exclusive relationship with Uber. You bring YouTube TV, into the plane, which eventually we have YouTube now, we'll have the TV opportunities expanding. We have a digital platform to give people opportunities to see content and have marketers have a chance to kind of get exposure to their consumers and take great advantage of the time you're spending with us.
You're even redesigning the seats.
We are. We're redesigning the seats. We're bringing all the new, particularly international planes we're bringing, full 50% of that plane is going to be in a premium category, compared to in the past where the premium cabin, the first class was really a loss leader. Now it drives the bulk of the revenue on board the plane. And so that experience set continues to grow. The lounges that we have, the JFK-1 lounge for
nice.
The international traveler, which we have in Boston. We have Delta One in LA. We have it in Seattle. It's the airports themselves. People still land in LaGuardia and think they get off. They think they're in the wrong city, and then I say, no, this is LaGuardia. We all grew up and realized the challenges of LaGuardia. I landed there the other night, and I got off and say, wow, this is pretty impressive. That's the future. And those things, by the way, can't change. There's a lot in this industry that moves around, but when you have the real estate and you have the footprint, and people see where you're going, that's when they want to join you on the party.
What happens to the average Joe that just wants an economy ticket, given the premium seat push? Like, what happens to them?
We have that product for them too. We call it Basic Economy. If all you want from your carrier is the lowest price, we are price competitive with anybody out there. Now, you will not get a premium service offering. You'll probably won't even get a seat assignment until you get to the airport. You may be one of the last people to board online. You may not have room for your bags. But if all you care about is the lowest price, and you still get high quality, reliable service, it's not like we discount or dismiss anyone, because those people are our future premium travelers. Every million miler starts as a 1 miler, right? And everybody starts their journey. And those people I'm particularly sensitive to that realize that this is an aspirational brand. This is a brand you want to be part of, even young in your journey, because you can see where it can take you.
Will AI impact how you price tickets?
It won't impact how we price tickets on an individual basis. What it will influence is the process of pricing. Today we have tens of millions of price points out there at any one point, because we sell 300 days out. We have 5,000 flights a day. We have all kinds of inventory categories on each flight. And so the complexity of doing that, which is still largely manual in many respects, it's not manual, it's run by computers, but very manual in terms of the oversight of that. We can do it a lot more efficiently. We can be a lot more agile and flexible. We can see where we're in market, where we're not in market at the right level. We can make sure we're making you the right offer based on the time, but it's not going to be based on your individual circumstances. There was a lot of concern whether we're doing personalized pricing. We don't have the capability with hundreds of millions of customers a year to do personalized pricing. But what we do is we can make the process go smoother and much more seamlessly for consumers.
If you'll indulge me, I have one or two leadership questions. It's not so often you get to hang out with a leader who's been, 10-year anniversary coming up next year as CEO.
Yeah, February actually.
That's wild. What's a piece of advice you would give to young leaders about building resilience in volatile industries?
People think that, wow, you've had so many experiences with crisis management, whether it was 9/11, whether it's the pandemic, global economic crises. You've developed your resilience through those experiences, and those experiences build some fiber inside you. But the thing I tell young leaders is make sure you know what you stand for, make sure you know what your mission is, your purpose, what you stand for as compared to what you stand against. Because you're going to need to pull on all of those fibers when you get through crisis. I had a wonderful board chair when we started the pandemic, Frank Blake, who told me—
Former Home Depot CEO,
and he was our CEO, our chairman for many years, my boss. And he told me, he said, you guys are going to get through this pandemic. He told me at the very start, we don't know what's going to happen, but I know you guys are going to get through it in a good way, because we understand your values. We understand what Delta stands for, and staying true to those values. And if you know what those values are, those values will be revealed during crisis. If you don't have character, it's really hard to build when that storm hits. And if you don't have the values sorted out, then that's when you start swimming around and going from guardrail to guardrail. But if you know what you stand for and your ability to lead through times of uncertainty, that's really important. So prepare for crisis in times of prosperity. Build those resilience genes, because it's going to come.
Last one, Ed. What do you hope Delta's legacy will be 20 years from now?
I hope it will always be seen as a great brand for service, for our people, for our community, for our customers, for our shareholders, that people really love this brand. And secondly, I hope it's seen as a force for good around the world. And when I talk about the second century of flight, and only 1 in 5 people in the world ever stepping foot on the airplane, that's where we're going. And that international growth and expansion will bring better understanding than any technology or any other service level that you can. When you physically bring Spirit together, that's when people start to understand and actual challenges start to get worked on.
You've given Yahoo Finance a lot of your time through the years. I would just like to say I greatly appreciate it. Thank you for joining us here at the Yahoo Finance Invest.
It's always good to be with you guys.
Thank you, Ed. I appreciate it.
Big tech has been powering stocks higher in 2025. The market's gotten more recent tailwinds from falling interest rates, and all of that's been favorable both for equities and for fixed income, even as questions about potential instability in private credit markets have begun to surface. Our next guest's career in financial services has spanned 4 decades, and she's appeared regularly on lists like Barron's Most Influential Women in U.S. Finance. I'm joined at Invest by Ann Walsh, Managing Partner of Guggenheim Partners and the Chief Investment Officer of Guggenheim Partners Investment Management, which oversees more than $350 billion in assets. And thanks for being here.
Hey, Julie, nice to be here.
So it has been a really interesting market environment. I guess maybe we live in interesting times, as the proverb goes. And I know one of the more recent things that we've been watching in the market here has been the government shutdown and now the end of the government shutdown. And it was interesting because the shutdown happening didn't really seem to harm the rally in the equity markets. But there did seem to be a little relief when it was over. I mean, how did you think about the shutdown? And more broadly, how do you think about government functionality as it relates to investing?
So we've certainly seen now a record-setting government shutdown, but we saw the second longest during the Trump 1.0 administration. And I think this fiscal policy and political disruption is really one for the playbooks for the rest of the Trump administration. And the volatility ride, I think, will continue from that perspective. Having said that, I think that we are through some portion of some of the volatility that we saw earlier in the year. I like to think of the Trump administration of having 4 policy pillars in no particular order. Trade and tariffs, which continues. Deregulation, which is sort of going on in the background right now with great pomp and circumstance to begin with DOGE, but really kind of now playing around in the background. Tax policy, which is one of the elements that's actually got some certainty to it now because of the One Big Beautiful Bill passage, and I think that's going to create some tailwinds into 2026. And then ultimately the immigration policy, or if I tend to prefer to call it reverse immigration. So we're seeing all of this play out, and I think that's going to continue.
Do you think that it is all of this is at this point an underappreciated risk by the market? The market seems to have gotten somewhat used to some of this. And again, more broadly, do you think that the political gulf in this country is an underappreciated risk by the market?
Well, I think we have to sort of separate markets from politics and policy, and obviously, and even the real economy. They have combined effect, but they're operating in almost a siloed fashion. The disparity or the discourse with regard to policy and politics, that's going to continue, and that's going to create headline volatility. But I think the market's looking through that, whether you're talking about fixed income markets or you're looking at equity markets in particular, you're looking at Fed policy. Markets are considering a whole lot more factors, and they're looking at the fundamentals separate from the narrative that we see at the headline level.
All right, so let's talk about some of those fundamentals then, and let's start with the Federal Reserve. Now, earlier today, we here at Yahoo Finance Invest heard from the former Fed Vice Chair Lael Brainard, and she talked about the challenge that is right now before the Fed. So I want you to listen to what she had to say, and then we'll talk about it.
With inflation now not continuing to come down, but stalling out around 3%, a little higher, they are concerned about inflation. And the other side of the committee, I think, has been sounding the alarm about the weakening labor market. And that was what we saw in September, a very clear commitment to cut 3 times in those projections. But it turns out that 9 of the 19 members were not actually on board for 3 cuts. And so that is what we're going to see play out in December. Even if we see a cut in December, it's likely we would see a pause after that.
And it's interesting because at the same time, she said she would vote in favor of a cut in December because she is more worried about the labor market. What do you think is going to happen here with rates?
So we're at kind of a delicate time because we have had the government shutdown. We don't have the usual data sources for the Fed to point to, and they like to claim to be data dependent. Having said so, they also look very much at anecdotal evidence, and in particular the Fed's Beige Book, which seems to indicate a slowing down of the economy to a level that I consider more equilibrium. And if we're in more of an equilibrium, which is a sub 2% real rate of growth, then I'm looking at real rates of interest that should be lower. The neutral rate should be lower, and so let's just assume the neutral rate's a 3% level. So for the Fed to continue to cut rates to 3%, they have some more cutting to do. I'm in the camp that I believe that they actually will cut in December because I look at that Fed Beige Book and it seems to indicate a lot more slowing and fraying around the edges in particular. One area that we've watched all year long and will continue to watch is sort of what I call the bifurcated economy. There's really two speeds that are happening in the U.S. economy. One is the lower end consumer and the small business market, and the other is the high-end consumer and the larger companies with access to capital and the ability to, particularly benefit from the AI trade, for example. And so as a result, you've had this two-speed economy, and the Beige Book really represents this broader level of the economy, and it's really becoming much more sluggish. And so as a result, I think ultimately the Fed will say neutral's probably lower than it is now, probably closer to 3%. And, the idea of actually cutting rates makes sense. And I still also contend that we're going to see more rate cutting in 2026 as well.
And you think that the sluggishness in the economy will take care of the inflation issue? Because that hasn't gone away.
Right. Well, one of the other elements about this bifurcated economy, of course, is that portions of the economy that are particularly sensitive to interest rates. So the interest-sensitive parts of the economy are also slowing down, housing in particular. And the cost of housing is actually declining, although that's not much reported. The last CPI number, the one that we actually got to see, seemed to finally indicate the owner equivalent rent portion of CPI had finally started to move down. And I think that's going to make a big difference. So while I believe that the rate of disinflation has slowed, the trend is still towards more disinflation, which will then also be supportive of further rate cuts.
I also wanted to ask you about the composition of the Federal Reserve. As we know, and as Lil Brainerd just alluded to, it's a very divided Fed right now. But we're also going to, of course, get a change in leadership at the Fed next year. And the White House's sort of rhetoric about the Fed has faded to some extent. But who do you think is the best choice to lead the FOMC next? And are you concerned about the White House sort of, again, leaning on that person when it comes to policy decisions?
Well, a few ways to look at the selection process. One, I think that the panel of nominees that are being considered are all pretty well qualified to be Fed chair. I have my particular favorites, but
you want to tell us who they are?
Well, I actually happen to be a big fan of Kevin Warsh. And I'm biased because he's a bit more of a monetarist, and I do believe money supply still matters. But Mickey Bowman's amazing, and maybe more of a dark horse is Kevin Hassett, and then I'm a big fan of Chris Waller as well. So we have a good selection of potential candidates, and notice I sort of picked more of the economist background personalities, if you will. Having said so, I believe ultimately it's not the first time we've seen political pressure put on Fed chairs. We go back to Nixon, we go back to Lyndon Johnson. There's a long history of presidents trying to put pressure on the Fed chair, and strong Fed chairs are important. Independence is important, but let's remember the Fed's also subject to congressional oversight, so not fully independent from policy oversight. They have two mandates. The dual mandate of stable employment and stable prices is still part of what they're obligated to work towards and engineer. Having said all of that, no matter what happens, I think we are looking at a more dovish Fed composition. And that means we're back to my concept of and belief in much lower neutral rate going forward, which should be helpful for the interest-sensitive part of the economy, the lower-end consumer to some level. For example, along with, in 2026, some tailwinds that we're going to have, particularly with the One Big Beautiful Bill. There's some tax benefits in there that will also be rather stimulative. So I think all of this keeps us out of any kind of recession risk, but it lends us to more of a neutral policy.
I wanted to come back to the other big driving engine in this economy, and that's AI, of course, which you and I have talked about before. How are you thinking about this whole bubble question and how to strategically invest in AI right now?
So I'm a big fan of technology in the long run, and I believe artificial intelligence will ultimately be a technological game changer. But it has to play out. We're still in early innings. The huge amount of investment that's being undertaken right now is in what, the blocking and tackling, the chips, the infrastructure build out, the data centers, and ultimately the power needed to power all of this into the future. The applications, the work streams, the usage of AI has to broaden out into the entire economy, and that's going to take some time. So in the long run, I'm also very positive. In the short run, in terms of just equity valuations, the question is, are we in a bubble? And I think if you look back to it, the number one comparison time frame, which was the internet bubble in the late 1990s, you were looking at valuations that were so extreme because you didn't really have any earnings. Now you have earnings, and I think the risk or the concern is, are we going to now pile on quite a bit of debt to build out the infrastructure for artificial intelligence into the future? And I think that's something to watch, but I don't believe that we're there at this point in time. I think there's more for this market to run, and I think technology will continue to drive a lot of stock market performance.
So on the corporate lending side, you don't yet see, or maybe we won't see, that sort of reach for risk in terms of this build out. What kind of warning signs would you be, as someone who is very experienced in the credit markets, what would you be looking for?
So I get asked this question a lot, particularly with regard to private credit, which is, where are we in the cycle? And what I say is there's cyclical risk, and then there's structural. And cyclical risk is what happens late cycle in the economy, when the economy slows down, there's more bankruptcies due to businesses failing, usually recessionary pressures. We're late cycle, but we're not really there in a recessionary environment. Structural happens when you end up with over leverage, too much lending to over levered entities.
Like the financial crisis.
Exactly. And you also end up with weakened covenants, investor protections go away. And when you get a few headlines like, Tricolor, for example, or First Brands, you get people questioning, are we having structural risk, or is this still cyclical? And I would say it's still more a little bit cyclical, as those particular companies tend to start to have problems late cycle. So, but we don't have what I consider to be at this point in time a structural, widespread risk, and I'll say yet. But that's what I look for and what I'll look for in the future.
And you have a great analogy to explain at these cyclical times when people reach more for risk. You have an analogy that explains sort of the risk that maybe they're taking in offering some of these loans.
Well, I think actually what ends up happening is people don't examine where the collateral is, what the underlying value is. And my analogy, it's a little rough, but you can take a Tiffany's box, and it's beautiful and it's gorgeous, and they put a pretty bow on it. But if you fill it with dirt, there's no diamond ring inside. It's just a box with dirt in it. And I think that's what lenders and investors have to be aware of, is know what you're investing in, and do more than just look at the outside and assume that everything is okay. Really do the diligence. Select your asset manager carefully, and that you know that they're doing their diligence.
Right. Do the work. That's always
good.
Work. That's always good advice. I want to end on this, Ann. Obviously, you work really hard. Every time I see you, you're traveling around, speaking to investors, working with portfolios. What do you do when you're not doing this? What do you do to relax?
Well, I read a lot, and actually, I do get to play some golf. So I get to spend time with my family, and we're all golfers, and it's a good way to come together and enjoy a beautiful afternoon. So yes, there actually is from time to time some downtime.
I like it. All right, good. Thank you so much, Ann. Great to see you.
Thank you, Julie. Nice to see you.
Coming up next, we're counting down to the closing bell on Wall Street. We got all the market-moving headlines and a closer look at today's action. That's next. And also, billionaire tech investor Robert Smith is here. He gives his insight on the state of the tech sector and its transformation. Plus, the rapidly growing business of women's sports. One of the people leading that charge is Reddit co-founder Alexis Ohanian. He'll be with us.
Welcome back to Yahoo Finance Invest. I'm Bob Powell, the host of Yahoo Finance's Decoding Retirement podcast. Here's a staggering number. About 4.2 million people in the U.S. will turn 65 this year. That's millions of people leaving the workforce and facing the task of living off their savings in retirement amid an escalating cost of living. Now, you might be thinking of your own personal finances and wondering, am I putting away enough money so I can maintain my standard of living when I retire? And how do I do that? Well, you've come to the right place. Jean Chatzky, she's a personal finance expert, author, and founder of Her Money. And Elizabeth Gore is co-founder and president of Hello Alice and hosts Yahoo Finance's The Big Idea podcast. And they're joining me now for a retirement reality check. So, ladies, one of the questions that we got from listeners was around rolling their 401k into a checking account. Thoughts?
A checking account?
Well, yeah, that's the question.
All right.
Jean.
So
I think that's very dangerous.
Well, I think it's very dangerous, and I think when you roll it into something other than a qualified account, if you don't roll it into an IRA, you're going to face a lot of taxes
and
potentially penalties depending on your age.
Right.
So the rollover decision is a really, really important one. It is not a bad idea to roll over in any real situation, but you want to make sure that you're picking the place that you roll to carefully and that you don't take the money out of the tax deferred account, because then you lose all of this good work that you've probably been doing for decades.
And I think about human behavior. I think it's really important that folks are disciplined and their money is in environments that are not completely easy accessible. So that's what makes me nervous about that.
So we don't know the reason why they want to roll the money over. It could be emergency, in which case maybe you take a loan out, or maybe you can take an emergency distribution from your 401k. But if it's just to roll it over for the sake of getting access to your money, taxes and penalties.
Well, taxes and penalties, and you should be planning your withdrawals over that long period of your retirement so that you get the tax consequences right, so that you give the money more time to grow, right? It can grow tax deferred for decades longer. You just want to max that.
Yeah, so one thing that may save someone from making a bad decision is not all plans allow you to take distributions, right? So you have to check your summary plan, right, document, your SPD, to find out even if you can even do this before, like, take an in-plan distribution.
You got to do your homework and really research and not assume that one size fits all, right? Every product is different. When you put it in, your age, it all matters.
Yeah. So another type of retirement account that we get lots of questions about is the health savings account, right? Which everyone describes as the triple tax advantage account, right? It goes in tax-free, grows tax-free, comes out tax-free if you use it for qualified medical expenses. But some people want to know, can I overfund it? And if so, what's the penalty?
Well, first of all, I love HSAs, right?
Who doesn't love an HSA?
Right? I love them because they can become a supplemental retirement account, as you well know, right? If you can get yourself to the point where you are paying for your health care out of your current cash flow and you invest that money in an HSA and you let it ride, let it grow, then you've got this supplemental account. Once you get to retirement, you can save your health receipts for years and years and years and years and just write them off. Down the road, you can use that money to pay Medicare premiums. I mean, it's so valuable. Can you overfund it? Yeah, you could put more than the IRS allows you to put into it.
Right, but there are taxes and penalties on that, on the over the contribution at 6% per year. So you've got to either take it out or pay the penalty for as long as it's there.
Also, research and study what you can actually use it for. You'd be surprised in your life what you can actually use that fund for. That I think people just think I'm just paying a direct medical cost, but there are so many other areas that you can actually use that fund for. So again, go back and research, study, and understand the capabilities.
Yeah, so one question we always get, and I'm sure you get it too, Jean, is this notion of if I apply for Medicare, I have to stop contributing to my HSA typically about 6 months before you enroll, and otherwise you have to sort of take that money out.
Yeah, you have to time everything very carefully when it comes to Medicare because there are a lot of things that can mess you up if you do it incorrectly. By the same token, it's not all that hard to put a little reminder in your calendar and just nudge yourself to stop paying that one bill.
Yeah. And I want to also shout out to the millions of people who are participating in elder care right now. They're doing this for their parents. And again, you have to do that research on behalf of your parents and understand for them. I care for 2 aging parents right now, and I'm in these decisions all day long. So you have to really understand what their products are before you help them make those decisions.
Yeah, so last question about HSAs. We know that when they were created, they were described as an IRA for healthcare expenses in retirement way back when. Most people, when they invest in HSA, they put it into a money market, and most of the time they're using it for current medical expenses. But for some folks who have the ability to delay using that HSA, you can invest it in the market. You can put it in a S&P 500 index.
But you have to turn it on, and I've seen statistics about the fact that only 6% of people have actually turned on the investing function. I mean, there are some barriers to entry. Sometimes you need to have a minimum balance in order to invest your money. It's worth, as Elizabeth said, picking up the phone, doing a little research, and finding out if you are in the kind of HSA that gives you the option to invest, because not all of them do.
Do you have advice for small business owners who aren't working for a big corporation and they're thinking about these, how they find all that information?
There is a lot of information available at healthinsurance.gov. There's a lot of information available at AARP. Actually has a really, really good vertical. I'm sure there's a ton on Yahoo. The point is to just go online and have a conversation with, whether you do it with ChatGPT or some other bot, about what is out there, and Don't give me that face.
I'm going to say, if you're going to use AI, double check.
I think he just had a small heart
I'm
attack.
like, I had a moment.
He just had his own reality check.
I'm like, AI.
No, but I mean, I do this pretty much every day. I go on, I have a conversation with AI about something I'm trying to learn, and I tell it that I want it to give me realistic, viable, credible sources that I can believe in, then I fact check it, as we all
I think
would.
that's the key,
I think
right?
that's
The
the
fact
medium,
check.
right?
Yeah.
I mean, it's your
Don't
starter
take
kit
it-
for information.
Don't take it at face value.
But then you go exactly to the source, to the products and services you actually are using, and then fact check it.
Exactly.
All right. So, in your experience, what small habits have the biggest risk of cascading into the biggest financial crises? And I'm thinking about credit card debt, or not having a budget, or not having health insurance.
Mhm.
What are your thoughts?
Being unconscious is the overarching habit that gets people in trouble. Whether you're unconsciously spending because we just swipe and dip and click and tap and money moves so quickly, whether you are unconsciously not paying attention to your investments, you've got to get yourself to focus on what's coming in, what's going out, and where it's going. And if you know those three things, you're going to be in much better shape.
So many people just go, money, right? Like, it's too much work.
You know, it's gotten easier, I think, as a person who's not a deeply financed person. And I would say the biggest mistake for my audience, for small business owners, is not starting. So they tend to wait to pay themselves. They tend to wait to start their 401k. They tend to wait to start putting money into their medical expenses. So I think the biggest mistake they can make is whether you're making $1 or you're making $500,000 a year, you need to start putting money away for your own services. Even if you're a solopreneur, it's really important.
I run into a lot of small business owners who believe that their business is their retirement plan, which is such wonderful optimism, but we know,
It's very little
it
times
doesn't,
the case.
Yeah, it doesn't always turn out that way.
Also, if you are more secure and know where you're going, you will be a better leader. If you know you're putting money away for your long term, you will make wiser decisions in your business.
Yeah, there's a recent study published by the Investment Company Institute by Sarah Holden and a co-author, where they looked at who has the best chance of success in retirement, and it's someone who has a long-term planning horizon. So if you're the SOA, Society of Actuaries, says notice that most people only have a planning horizon of 10 years.
Right.
But if you have something that's like 10 years and longer, you have a better chance of having a better retirement outcome.
Right, and I think even, I suggest for people, for their own children, to teach them to start putting money away early. So the second my kids are in 4-H, they sell their rabbits and they're having to put their little money away and understand how to save for long term. And I think we can all teach the next generation that. So in your sandwich, you've got elder care, so you're making these Medicare decisions for your parents, but then you should also be teaching your children how to get there.
Yeah, and I'm not surprised by that long-term time horizon, because we've learned a lot from the people who study behavioral finance about visualization. And I think visualization is just, if you can see it, then you can do it. And these folks who have the long-term time horizon are seeing a lot further into the future and helping their future selves.
I've put my face into those
Me
aging
too.
apps, and it's scary.
Yeah.
All right, let's go over to Allie Cannell in the Social Center with some viewer questions.
Hey, Bob. Yes, we have a lot of great questions from our social media viewers. And this first one is for Jean, comes from Josephina. And she asks, my mom will turn 73 next year and will need to start taking requirement minimum distributions from her IRA. Is there a strategy for when she should think about timing the RMDs? Are there penalties for doing it wrong?
Well, yes, there are penalties for doing it wrong. The big thing that you get penalized for is not taking enough. The IRS actually calculates for you how much you need to take out. It's a number that is based on your age, based on your life expectancy, based on the amount of money that you have in the account. If she's at age 73 and she has yet to start taking distributions, I suspect she doesn't really need to use this money all that much. And so she may be the type of person who wants to think about something called a QCD, which is a qualified charitable distribution. It's a way to make a charitable donation straight out of your IRA. The money doesn't get taxed, and it doesn't count, and it counts towards your RMDs. So you kind of get the best of both worlds.
And you're making an
able,
impact in your community.
Yeah, and you're able to give away more for less. It's kind of a little bit like giving away appreciated stock, which I love as well.
Yeah. What else you got, Allie?
Well, Bob, I even have one for you here. This is from Chip. He asks, do my children inherit my Roth tax-free?
Yeah, so just a little bit of background on the Roth IRA. It's different from a traditional IRA. The money goes in after tax. It grows tax-free, and then the money comes out tax-free, unlike an IRA. Now, the interesting thing about inheriting an IRA is your children don't have to take RMDs, but they do have to withdraw all the money within 10 years. So that's not the same for a spouse. Your spouse can roll it into their RIA or not, but they don't have to take RMDs. But your children need to exhaust it by the end of the 10th year.
And I think a lot of people get confused that you actually still have to do that with a Roth, not just a traditional IRA. We lost my mom this past year, and so my brothers and I are in the process of getting distributions from her traditional IRA, but there's a tax hit there.
Yeah, so you'll pay an ordinary income tax on those distributions, but my children, if they inherit my Roth IRA, won't have to pay taxes on that.
Exactly.
So what else, Allie?
All right, well, finally, Elizabeth, this next social viewer wants to know, what's the best pre-retirement decision you've ever made? And don't say hire a financial advisor. So a bit of a caveat in there.
I'll say it.
Okay, you say it first.
You hired a financial advisor.
You know what? You have to just start. I came home for the Peace Corps. I put in $100 a month for my retirement. I know that sounds silly, but again, it adds up over years. And so if you just take the time, we'll go in the middle here, start using ChatGPT to learn, but then go and confirm the facts, start investing in your retirement, in your health care, and your future. Just start. That's what we did as a family, as kids coming out of the jungle, and then here we are all these years later with money, and it adds up. So just start.
It does. I have one more for you.
Yeah.
I think it's really important 10 years out, 5-10 years out from retirement to really get a sense of what you spend every year. A lot of people have no idea what retirement is going to cost them, and it's impossible to plan for retirement if you don't know the cost of the life that you're going to be living. The best indication that we have is how much we spend now. So if you can get yourself to really acknowledge your cost of living today, it's a lot easier to establish that roadmap for tomorrow.
My fishing budget is going to go up when I retire. So I'm just going to have to balance. Oh yeah, I love to fish.
All right.
So I got to plan for that.
Yeah, you do. All that bait's expensive. Elizabeth, you eat, breathe, sleep all things small business,
do.
right? So when I think about small businesses and retirement plans, I think solo 401k, SEP IRA, and IRAs. Do you have a preference?
I would say go in the IRA direction. I think just we don't understand the tax benefits. You can put it in there, forget about it. And I think that's the most trusted area for small businesses at this time.
All right, last question, personal question, Jean. When your nose isn't at the grindstone, how do you unwind?
I like to run and I like to cook, and it's good that I like to do both because running helps me work off those calories that I eat.
Fair. All right, thank you, Gene. Let's send it over to Brian Sazi for a look at the market close.
All right, thanks so much there, Bob. Those are the closing bells on Wall Street. Let's get a wrap on trading and bring in our in-house panel of experts, Jared Blickery from the New York studios, Brooke DePalma at the NASDAQ, Inez Ferre from the Stock Exchange, and Ali Canal from our Invest Social Center. Jared, let me get over to you. Pretty tough day for the market today. Not good.
I know, Brian. I came into the market this morning. The Dow was coming off its second record high in a row. We got the government shutdown past us. But look at this. The Dow is down 800 points, or 1 2/3%. We take a look at the chart here. We are closing pretty close to those lows of the day. So not the best setup here, at least for this one day. Here's the NASDAQ down 2 1/3%. And here's the S&P 500 down a similar amount to the Dow. All three of these charts just looking pretty red and pretty negative. I should add, all of those major markets having their worst day in over a month. So here is the headline from today's sector action. Energy, the only sector closing in the green and just barely up about 0.2%. And then the other leaders here, the least bad off, we see staples and healthcare. So it was a very defensive setup in terms of the leadership today. And then what did not do well? Tech was leading the way down 2.5%. Consumer discretionary also down a similar amount. And then industrials, communication services, utilities, real estate, financials, all of those down more than 1%. And I want to focus on the Dow right now because we do have a couple of bright spots. I mentioned energy was in the green. Chevron, this little rectangle here, that's up 1.33%. Then we got Cisco up over 4.5%. That is an earnings story. They did very well. Guess what? A lot of their networking gear is in high demand because of the AI story. So Cisco up 4.5%. J&J, consumer staples, that defensive stock up 0.5%. But then another earnings story that didn't play out too well today is Disney. Big takeaway for investors: studios cost a lot of money and more than Wall Street was expecting. So Disney taking a hit of about 8% today. Meanwhile, we can see the tech trade, at least in the Dow, not doing the best. The only dark red spot, though, we have is NVIDIA, down 3.5%. And another thing, the dark red squares here, we had JP Morgan, IBM, Caterpillar, Goldman Sachs. All of these were trading at record highs a day or two ago. So it just goes to show you that this might be a little bit of sector rotation here. I've talked with Kenny Polcari all day long here. He's fielded a lot of calls. The main trend lines in the S&P 500 still in play. So this isn't a sell the news event for everybody here. I just think there's a little bit of concern given the breadth of some of these tech misses that we've seen lately.
All right, good stuff, Jared. Brooke, a sea of red today in markets. Anything hopeful, optimistic on your front?
Brian, a pretty bleak picture over here at the NASDAQ. And what we're seeing is, as Jared had mentioned, that tech sell-off really leading the downward momentum at the close today. As he mentioned, the tech sector down more than 2.5%. NVIDIA seeing its lowest close in nearly 3 weeks. Also keeping a close eye at Palantir because that stock is also seeing its lowest close since early October. And these are key names that have really led this AI momentum, have led this tech rally, especially over the key summer months into the fall and now into the end of the year. Now we're seeing a bit of a pullback there as investors really assess this key AI bubble risk that we've been chatting about. I know some of our guests weighed in on that as well, really trying to mention the diversification and rather the flow through that AI will have now to other sectors. Other stocks that have my eye are those hyperscalers, the one doing this spending within this AI demand. That includes Microsoft, Google, Amazon. Those are some of the companies that have really lagged behind the data centers over the last 6 months when it comes to the momentum that we've been seeing in this market. And also Tesla down more than 6% today, nearly 7%. This marks their worst day since late July. I think it's also worth noting that Tesla has now reversed the gains that it made year to date, especially in September, October, and ahead of that $1 trillion pay package vote from shareholders.
All right, no optimism from Brooke. Inez, I know you have something for me, something positive.
Risk off across the board, Brian. Look, crypto under pressure, gold under pressure. Even the U.S. dollar was slightly lower as well. But just double clicking on gold here is down 1% at around 4,170 per ounce. It was above 4,200 earlier this morning. It had rallied over the last several sessions. But this may be a little bit of positioning because what do you do if there's a sell-off? You may be taking profit off of the asset that's done the best for you year to date. Year to date, gold is still up about 60% for gold futures. Looking at digital gold, Bitcoin not faring well today, down about 3%, hovering above 98,000. That's the lowest level since May. One tailwind that strategists have been pointing to is the government reopening. That should help with liquidity as fiscal spending kicks in again. So that should boost assets. But the one question is, where are the marginal buyers when it comes to Bitcoin? Because sentiment soured in October when you saw that big sell-off. Fund managers have been trimming their positions of ETFs. Compass Point says that they're seeing support at 95,000, and they don't see any near-term catalysts that would send it higher. But 10X Research, they're saying that they're watching the $93,000 level because if it does go to 93, then you could see an air pocket below that, unless Bitcoin can climb into the $110,000 level, Saz.
All right, thank you, Inez. Allie, I know you are my last beacon of hope here in this hit. Anything positive, smiley, you name it.
I do have a couple
Thank
things
you.
positive, a couple things negative. But let's start with one of the things trending right now on social, which is Waymo, a major move in the autonomous car race, becoming the first robo-taxi company to offer driverless rides on U.S. highways. So we have new routes that have been rolled out for passengers in San Francisco, Phoenix, Los Angeles, more cities to come there. And this puts Waymo way ahead of those competitors like Tesla, like Uber. And it does come after tech bull Dan Ives was on our program just a few hours ago saying that our very own Yahoo Finance anchor Julie Hyman would be in a robo-taxi in 2026, not necessarily a Waymo robo-taxi, but a robo-taxi nonetheless. And clearly with the news today, anything is possible, and this space is just speeding right along. Now, what's not so positive there and something that is trending is more job cuts, particularly from Verizon. They are set to cut about 15,000 jobs, the largest layoff in the company's history, and that's about 15% of its workforce. And this does fit a broader trend that we've been talking about throughout the course of the day. Shark Tank's Damon John telling me earlier that most jobs are going to go away and that small businesses, they're being hit by tariffs, they're being hit by higher costs, and they don't necessarily want to pass those costs on to the consumer, so they are pulling back spending where they can, and that includes hiring. So we are continuing to see this disconnect between big corporate America and Main Street. Also related to jobs, the White House confirming it will partially release October jobs data, just the payrolls numbers, not the unemployment rate, after the shutdown delayed all of that official government data. I'm sure that's something that investors will definitely be wanting to parse through to really judge where we're at within the current economy. But I will end on a really positive note here among all this doom and gloom, Brian, because Vine, it's basically back, y'all. And Brian, I don't know if you know Vine, but I was a big time user of Vine. It's a new app that's relaunching. It's called Divine. It's backing from Twitter co-founder Jack Dorsey. It brings over 100,000 classic 6-second Vine videos and lets users post new ones. And the big thing here is that it will tell you whether something is AI generated. So it's really trying to emphasize the human connection. I'm a millennial, so all us millennials are really going crazy over this, pseudo return of Vine. And I can't wait to get cracking. Maybe Next Invest will do a bunch of Vines. And that's what we'll do for the social center.
loved me some Vine, Allie. Thanks for bringing that up. I think I originally used Vine on my iPhone too. I think it was absolutely awesome. But real quick, I want to go back to when you mentioned on Waymo. I've been working with Julie Hyman for over 6 years. No way she's getting into Waymo. No way, Allie Cannell. Come on.
She's literally over here saying, did you say you would? All right, she said she'll get into Waymo, Stas, so I guess we're gonna have to make this happen. We'll all get into Waymo together.
There she is. There she is. I don't buy it.
Waymo?
You're not getting into Waymo.
Listen,
Come on.
I don't want a robot in my house if it's controlled by a person remotely, but I'll get in a Waymo.
This is shocking, Julie. I can't believe it. I learned something new about you every single day, Julie Hyman.
Okay, well, good. I'm glad I can still surprise you.
All right, well, good stuff, y'all crushing it. Coming up, we are all in on the state of tech. Speaking of driverless cars, we hear from two top names in the industry, Vista Equity Partners Robert Smith and Reddit co-founder Alexis Ohanian. We'll be right back.
back to Yahoo Finance Invest, presented by eToro. Robert F. Smith is the chairman, founder, and CEO of Vista Equity Partners, which manages a $100 billion portfolio of investments in some of the world's largest enterprise software companies. Over the past 25 years, Vista helped bring enterprise software to the cloud, and now, of course, it's working on implementing the transition to artificial intelligence. You might also, by the way, recognize Robert from a viral moment in 2019 when he repaid the student loans of 400 graduating students from Morehouse College. He's a dedicated philanthropist and the author of several books, including his most recent Lead Boldly, 7 Principles from Dr. Martin Luther King Jr. Robert F. Smith is joining me right now at Invest. Thanks for being here.
Great to be here. Great to see you.
I got to start with the theme of the day, the theme of the year, the past couple of years, which has been AI, right? And generative AI in particular. And I'll get to investing in AI, which you've been doing a lot of, but I do want to start with AI in the workforce because, as I'm sure you're aware, the Financial Times reported that Vista's told investors that you plan to cut your workforce, in part because of what's going on with AI, potentially by as much as a third. What can you, I mean, we've been hearing this from a lot of companies, Robert.
Yeah.
So it's not perhaps as shocking as it might have been recently, but what can you tell us about the plan?
Yeah, like all things, there's a fair amount of misstatement in what was reported. But with all that being said, Gen AI and ultimately agentic solutions create massive productivity. You know, we have over the last 25 years at Vista really embraced technological change in how we transform our portfolio companies and of course Vista in and of itself. You know, we've gone through multiple waves of the digitization of everything in many cases, and you think about the distribution first of compute, the Internet of Things, mobile first, cloud, and now we have a new technology, artificial intelligence, utilized through Gen AI and of course agentic solution sets. What we are finding is a massive amount of productivity that comes, not surprisingly, from all aspects of what this technology distributes off the infrastructure that we are managing. If you think about productivity and product development and customer service, customer support, go-to-market, all those dynamics, we're seeing massive productivity. We are built for growth as a firm. We're going to continue to grow. What's interesting is as you grow, you can actually grow without adding as many people, which is the way you actually have to think about this. Now, in certain instances, there are going to be certain categories of jobs that become very much affected by artificial intelligence and Gen AI. Other categories become very much more enabled by that. And so it's a balance of expression and expansion as you get these systems to actually operate at scale with capacity. And part of what we've been leaning forward in doing with all of our portfolio companies is we've built out now an agentic factory. We have some fantastic partners. We're now able to take the architecture of these workflow systems called enterprise software, the unique data sets, which less than 1% of the data in enterprises actually exist in these foundational models, and actually create agentic solutions that create highly efficient dynamics in operating through these existing workflows. That's a unique aspect that enterprise software companies can actually embrace. The value of incumbency is really going to matter in certain of these industries. So that productivity will actually absolutely make its way through the overall economy and of course private equity firms ultimately. Right. We have unique workflows in private equity firms that we can actually leverage these solutions.
Okay, so what did that story get wrong then? I mean, because all of that would indicate that you're pushing towards a leaner workforce potentially, or as you say, maybe deployed in different ways.
Yeah.
So what did it get
wrong? We are not reducing our staff by 30% or whatever the number was. I don't know where they got that from.
Are you planning to slow hiring as a result of all
in
of
certain
this?
areas, yeah, for sure. But you know, when I look at the work that we do in our private equity business, our credit business, our value creation business, massive amount of opportunity. And here's why. You know, if you think about the waves of how technology have played out in over decades, you know, the first wave, of course, is typically I call it the hardware providers capture the vast majority of the economic benefit. Second wave typically are what I call the service providers, infrastructure providers, in this case, hyperscalers capture that benefit. And you're seeing that play out. It is the enterprise software vendors ultimately that, if you have, I call it sovereignty and dominion over workflows and data sets, that have the ability to take this agentic solution sets and capture massive amounts of economic rent opportunities. It expands their TAM dramatically. One of our companies, one of our first companies that went through our AI factory, our agentic factory, it now has expanded a market now 10x what they had before. Now, the way I like to say it, Gen AI will enable enterprise software to eat services. Okay, it will create a massive amount of efficiency in the work that it does and workflows, and we are now installing these systems real time across literally hundreds of customers, and it's non-trivial work. But as you do the installations, we're actually starting to see the benefits of it. Of course, we're taking those same sort of systems, and we have been within Vista and saying, okay, what are the areas within a private equity firm that we can leverage so that our people can become more productive, they can expand their area of their TAM of opportunity. And the good news is the enterprise software market right now has a disproportionate valuation relative to, call it, the AI groups, that as you make these agentic and AI enabled, I think these businesses are going to create massive upside and opportunity for our investors. That's what we're focused on.
So there's so many threads to pull on in there. I guess I'll start with the valuation question first. Do you think that publicly traded AI is in a bubble?
So it's an interesting question in that, you have to build out infrastructure. And again, being a student of history around as an investor, you have to be. It took massive amounts of capital to build out the infrastructure that we benefit from now. You remember the global crossings of the world, building out cable and fiber. And okay, now some of those companies went bust. There was in a bubble. Some of those companies ended up being the winners because they built at the right time, right capacity, and the needs and demands of what the market.
Although in some cases they took
demand of
decades to come back
in some
cases.
Stock
prices.
Absolutely. So those are the dynamics. Everyone looks to, we're putting trillions of dollars into an infrastructure that is a question of, do you have enough power to support it? And you argue, is there a bubble because you can't support it with the power? There's an argument around that. Are there enough component parts? Is there enough distribution? Are those component parts that we are looking at today going to actually give the power demands that are required? We're hearing, of course, there are other solution sets that have lower power by a tenth of what we're seeing. So do you need the same sort of power? So all of those are market dynamics that have to reach certain points of equilibrium over time. Where we focus, again, all of that provides infrastructure for enterprise software. At the end of the day, what we're going to be doing is utilizing inference. You can put it in the form of tokens, utilizing inference to create massive economic rent and productivity for our customers. That will all inure to the benefit of those enterprise software vendors who become agentic. So there are going to be ebbs and flows over who is actually capturing what value, what period of time. Certain folks will have monopolistic positions for short periods of time, and then others will come up with, like an all silicon, different solution sets that will be lower cost, suit to purpose, different infrastructure. Do you have to have it all centralized? Can you do it at the edge? In terms of the inference capabilities, do you need 1 gigawatt power supply, or do you need 50 megawatt to do certain inference for certain use case applications? And is that more suitable for that use case application? So we're going to go through those waves, and some parts of this market are in bubbles, and other parts are very much in a great investable space.
Do you think that power is going to be the main constraint on the build out of AI in the shorter term?
In the short term in the US, yes. I think in other parts of the global economy, they have an excess of power, relatively speaking. The question is, can they utilize that power to actually power Gen AI or agentic or data systems or GPU data centers in a way that is accessible and usable for those who need it? Mm-hmm. So again, there's not only the power dynamic, there's accessibility, what are the requirements of latency, and what are the size of the models for the use case and application. Not every model needs a massive LLM. Some will be able to use some small language model in an environment to deliver a high capacity solution for that particular industry. So again, it's early, it's a lot. but it has massive implication and massive productivity. So we're excited to be a part of what I call the edge of this thing, which ultimately is the enterprise software will capture benefits. We built these businesses now. We were converting, I think we have 18 of our companies now that already have agentic solutions in the market that are getting installed or have been installed and seeing real results. And I am just really excited. I've never been more excited about investing in enterprise software than I am today.
And you're probably fortunate to be on the private side of the space right now, perhaps. I was taking a look at some of the returns in the public markets. Because when we talk about AI in a bubble, we're mostly not talking about enterprise software companies, right? So I was looking HubSpot, Atlassian, Salesforce, all of them have been hammered this year. All of them are down pretty sharply this year. And the perception in some of these cases is that Gen AI is going to replace rather than augment. So do you think that is a risk? Is it a risk for any of your businesses? I mean, it sounds like you said you're very excited about the opportunity.
Very excited.
At the same time, what's the risk?
Yeah, I've stated to our investors, it's an enterprise software, I believe, ends up in 3 states. There is agentic, rule of 70, and no right to exist. Okay, so certain public investors can't necessarily discern between those 3 categories just yet because they're not seeing enough of the proof points of, okay, is an agentic enterprise software business, does that create massive growth and massive opportunity? And if they aren't agentic, do they have a right to exist? Do they actually have, the way I like to think about it is sovereignty and dominion over workflows and data sets that are unique. Less than 1% of enterprise data actually exists in these large scale models. So if you actually have that capability, incumbency matters. And if you build agentic solutions around the workflows, that matters. If you don't have that as an existing construct, there's going to be some challenges and some problems. Who actually has the proprietary access to the workflows? And are those workflows designed in a way that you have to do certain things that you can't do in an agentic world or in a open world that says, hey, listen, we need regulatory compliance, we need all these sort of aspects that create an agentic workflow within those environments. If you do that well, you have a right not only to exist, but to thrive and to actually expand what is your addressable market. If you haven't done certain of those aspects in building out your infrastructure and having, again, the sovereignty and dominion of the workflows and data sets, you may not have a right to exist. But that doesn't mean you can't use these Gen AI solutions to lower your cost of your delivery dramatically. That's what I call that rule of 60, rule of 70. Increase your profit margins because you're actually able to lower the cost of development and customer support and go to market, all those sorts of things, and deliver solution sets at a higher profit, which give you the ability to return capital to your investors. That hasn't played out yet at size and at scale in the public markets, which is why public investors are still trying to sort all that out.
I'm also curious about sort of deals and exits in that environment right now, because you've done a lot of big deals over the past several years. We have seen more IPOs coming in this market, some AI, but particularly in crypto. So what do you think that environment is going to be like over the next year? Do you think you're going to get some more exits for your investors?
Yeah, we're excited. I mean, even in this last year, we've been able to return a little over $12 billion, which has been exciting. And none of them have been through IPOs, right? So if you think about it, even with the IPO window and market being closed, we have been able to build businesses that strategic buyers have been excited about buying, financial buyers have now been excited about buying, and positioning those businesses so people understand they have an agentic aspect to them, or they're a rule of 70 and have the capacity to deliver over the long-term returns to the buyers of those sorts of businesses. That's essential to our business. Our business is to buy, create value. All this operational intelligence that we bring and our best practices is an important part of what we do as investors in enterprise software. With all of that said, now that the IPO market is starting to open, we have a couple of companies in registration, and we're excited about the prospects of what they can lead to in the marketplace. So again, like all things, these markets go through different equilibrium states, and we're excited about the fact that now public investors are now saying, listen, we are now in demand of companies that actually have the ability to sustain growth and market share and market opportunity in very specific enterprise software areas, and we are fortunate to have companies that fit in those spaces.
Yeah, I want to get back to the labor question a little bit, because we keep seeing pretty dismal both anecdata and data about Gen Z and then Gen Alpha in this job market, that it's tough for them to get jobs.
Yeah.
What skills do these people need in the age of AI, especially as you talk about the shifting of the job market?
Yeah.
What do they need to know?
There's going to be a little more of what we call the whole brain type of skill, right? You know, my generation, part of our generation, you know, you could be really a STEM person, and you know, as a result of that, you know, there was a premium on being able to process data and come up with insights and analytics around that data. And now you have this new tool and a set of agents that can actually do that much more efficiently, much more quickly, and serve you, in essence, the synthesis of the data based on what it is you're looking for. And now what do you do with that? And so those who get actually a little bit more whole brain, creative, thoughtful, understanding the ecosystem, the EQ of intelligence, of engagement. I mean, look at our sales agents, for instance. For a period of time, most people think salespeople are selling all the time. And when you talk to them, they'll tell you that. Well, if you actually look at the data, they're only selling about 15% of the time. A lot of the time, they're doing things from, you know, putting up sales notes and, you know, putting strategies together, all those sorts of things. Think about using a series of agents that prepare your salespeople to be more effective. So rather than them taking, you know, hours to do, you know, sales prep, it takes minutes. It's delivered at the time they're walking into the meeting. And now they can focus on, I call it the human aspects of what is it that solves the problem, the relationship that they need. Those are the things that are going to create massive productivity. So there's going to be some shakeout in those parts of the market. Do you need as much of the kind of the sales prep dynamics that we do today, which were often entry-level type jobs, right? But if you have the ability to also orchestrate agents to deliver that, you can actually now effectively treat and deliver to more salespeople that capability. So that's how this is all going to evolve in many of these instances.
An issue we've talked about before also when you talk about building out your workforce, as you well know, there's been a backlash against policies that aim at fostering diversity, equity, and inclusion. So when you think about recruiting, whether it's for Vista itself or for the portfolio companies, is there still a place for DEI in this environment? Is there still a business case for DEI?
The business case hasn't changed. It is, you know, everyone knows the more diverse thought that you have, the lower risk, the higher returns, the data is all out there. Now, how people react to it, that's, you know, a different instance, but the data is there. I tell our teams constantly, keep doing what you're doing, hire the best people, enable them to be effective, ensure that they have the ability to create the connectivity. In America in particular, we have to embrace the resources that we have at our disposal. The thing that we have done over the last 20, 30, 40 years is distribute capability globally, digital capability globally. So a lot of the things that always kept us on the leading edge, you know, now are accessible everywhere. So as an economy, if you look about the US economy, you have to actualize as many people as possible using the tools that are available so that we can be the most productive workforce and deliver the most productivity per person, per country that we can in order to compete as a small country on a number of people basis relative to others. That's why for us it's important to deliver solutions that teach students. You know, we have partnerships with, you know, some of them HBCUs where we deliver AI systems and curriculum to, you know, Morehouse and Spelman and now to other HBCUs. Our partnerships with code.org, we'll get to over 5 million students who are not only just teaching them code, but now it's AI-centric coding, all those sorts of things. We have to equip that K through 12 and then higher ed groups of students to understand this is the new paradigm of how work's going to be done. You need to embrace it. You need to become a master of how it is utilized and understand how to scale it, not just in corporations, but also in starting businesses, encouraging people to actually use the unique insights they have as entrepreneurs from the communities that they come with to develop businesses and expand those businesses at a much more rapid pace using these technologies and these platforms. That's where the opportunity set really lies for us.
Robert, as I mentioned, you have written a number of books, and the latest book highlights speeches from Martin Luther King Jr., but sort of through the lens, and you add some commentary on your own experiences and reflections. And I'm curious whether you think at this current moment in this country, there's been backsliding in terms of racial equity in America, whether we're talking about politics or culture or business.
Yeah, to me, we have to embrace the assets that we have, and that's our people. Our greatest asset in this country are our people. We need to enable and actualize our people, and part of that means we have to build stronger alliedship around what are the areas that we need to address.
Are we doing that?
In some communities I see yes, in some communities not so much. Some communities are moving forward and some communities are moving backwards. But we have to create enough of a momentum moving forward, because moving backward is not going to be an option in the rate and pace of change in the global economy. For periods of time where you had disproportionate access to technology and resources, you could operate in certain ways. The world has become flat in many respects in that regard. Look, the U.S. has been a beneficiary of it because we reap the benefits of the products and solutions that we've been able to sell globally. But now people have access to that. So we now have to actualize, I call it, every able-bodied American to participate in the opportunity and enable them to actually create GDP, create access to additional jobs and expansion. That's ultimately what keeps us on the front foot of prosperity. That's what's important.
Robert, finally, obviously, you're a busy guy. You're raising money. You're writing books. What do you do in order to try and shut off a little bit and rejuvenate?
That's a great question. I just actually went on a wonderful trip with one of my sons. And we went fishing for 3 days, and then he got me on some roller coasters for a couple of days, which was a lot of fun. But a lot of it is connecting with people that you care about. To me, it's listening to great music, listening to the thoughts of the youth, what it is that they're interested in, and gaining perspective as to where you should focus your time, energy, and attention. And when people ask, well, how do you spend that incremental moment? It's usually listening to music and trying to plan a fly fishing trip with one of my children.
That's the second fishing answer I think we've gotten today. What kind of music are you listening to?
Right now, John Batiste is my guy. Oh, he's just amazing.
Love it.
I think he will go down as the greatest musician of his generation. So I'm excited to participate with him in that
You
venture.
and I are on the same page.
Outstanding.
On that one. Thank you so
Good,
much,
Julie. Always
Robert.
good
I
to see
really
you.
appreciate it. Great to see you.
Pleasure.
So I was going to send it back over to you.
Really love that chat. Please tell Robert I said hi. I'm locked in on the other side of the office. I cannot get over there. Straight ahead, I sit down with Reddit co-founder and venture capitalist Alexis Ohanian to see where he is putting money to work and why. Welcome back to Yahoo Finance Invest. My next guest is a tech entrepreneur and investor with an eye toward making the world better. For years, he's been at the forefront of tech revolutions and among the first to recognize value. He's been an investor in dozens of startups, including 40 unicorns. Those are companies worth at least $1 billion. Companies that come to mind include Opendoor, Instacart, HubSpot, Patreon, Filecoin, and Coinbase. Not to mention, he was the co-founder of Reddit and more recently has been investing aggressively in women's sports. Today, he is with me at Invest to discuss the biggest tech revolution of them all. That is AI. 776 founder and Reddit co-founder Alexis Ohanian joins me now. Alexis, so great to see you again. We've been talking about AI for this whole event today, almost 8 hours of this thing. At the same time, we've seen AI stocks hammered for really the second straight day. Where are we at in the AI cycle?
Oh boy, look, I think everyone is realizing this technology is here to stay. It is real. Now, I spend my days at the earliest possible stages of investing. I don't spend a lot of time dabbling in the public markets, so I can't speak to those valuations. But the bigger trend is very real. The innovation, the efficiencies that we're seeing, a simple example like writing code, something that I had to, teach myself when I was in high school. The act of writing code has gotten so enhanced thanks to this technology that it's changing the way apps are getting created. And so if you just look at that one very, very, very specific use case that obviously has a lot of value in the world, right? We can't live without software. We can see the implications for this. And so, I can't speak to those public market valuations. I'm still long-term very bullish on the overall technology trends. And I think one area where we've seen growth in the private portfolio has been around infrastructure-related investments. And so companies that are building on the hardware side, on in the world of atoms, but atoms that are in support of the bigger needs we're going to have around energy and compute. And just excited to see that. I think a lot of this technology can help us live much better lives. And that's the kind of thing we want to get behind.
Alexis, you've been early on so many things in technology. Take us through where you're seeing opportunity right now, like at the ground floor. I imagine things you're looking at right now may come to fruition 5-10 years down the line.
Yeah, I mean, I can speak to vibe coding. We seeded a company literally called Vibe Code that has really focused on mobile first, iOS and Android first app development, literally from a text prompt. Like my dad could, within a few minutes, build an app to solve some problem he has. They really believe, the founders do, that software development will get incredibly commoditized and that access to creating useful software, especially on your mobile device, will just look and feel fundamentally different than how I was taught as a kid or how generations of developers were taught. And that feels very inevitable and actually feels like a shift we'll see in the next 5-10 years. On the really extreme end, my partner Caitlin just backed a company called StarCloud, which is aspiring to build data centers in space. They actually recently just put the first one up there on a recent SpaceX launch just last week.
Data centers in space? How does that even happen?
And again, so to have basically unfettered access to light, so solar power that's coming through. You still have to solve a lot of problems with heat dissipation, which again, I'm not the physics expert here, but the founders are. And what's exciting is, if you want to build, and I think Elon recently, and maybe even Jeff Bezos were recently talking about the inevitability of data centers in space as a means to achieve these extra levels of a civilization where we get to become a spacefaring civilization. And we actually have these needs for compute so that we can, whether it's inhabit Mars, the moon, or any of the other things that are going on around there. In the short term, right, we're having enough growth here building data centers on Earth, terrestrial ones. But at the far ends of ambition, you have founders looking to build these data centers in space to help, create opportunities for using that compute out there in the constellation of satellites. And there's plenty of defense reasons and plenty of just human advancement reasons why this actually could be helpful if the science works. So again, we want to be the first check in a range of companies, from software, which I feel quite familiar with, all the way to, like I said, data centers in space. This is the kind of ambition we look for at 776, and it's exciting because, founders are, in a way that wasn't the case when I started Reddit 20 years ago. Founders today are very aware of the power of technology, and so many of the very best feel an imperative to build not just great businesses, but great businesses are going to help push humanity forward. And it's inspiring. It's I'm on the other side of the table now. I'm just wiring the money. I'm not building the businesses like I used to. And so it feels really satisfying to be close to and inspired by founders who are doing just such great work.
Alexa, I think you and I are the same age. When did we become like the old guys in the room?
I know, dude. Geriatric millennial is when it really hit home. I mean, look, I'm 42. I have 2 young kids that keep me on my toes. But it's probably the best part of this job is you're constantly seeing a new generation of founders who have new ideas, right? The 21-year-old founder of Vibe Code, right? He's teaching me about the world and his generation today, knowing he basically grew up on the site I created, Reddit, and has a totally different worldview because technology has been a core part of his entire life. The internet, social media has been a core part of how he learned, how he connected. And it's wild just to see now the ripple effect. And like I said, I leave most of the conversations I have with founders, pitch meetings daily, feeling motivated and inspired. And it's an amazing time to be alive. And I definitely feel old. That is
you and me both, I assure you. How are the founders of today, the ones leading this AI revolution, how are they different from your generation?
I think what's very interesting, and I know a lot is said, every generation seems like they hate on the next generation coming up as being too entitled, too lazy, all these things. And I remember when it was assailed against millennials, when we were the 20-year-olds, I see it happening. I'm not falling into that trap. I do think the ones who are the builders of this generation, who are really high agency, who are really motivated, are head and shoulders above certainly me and our generation we were building. I think the fluency, the fact that they are truly digital native, the fluency they have with technology, but also the fact that they've seen a tremendous amount of change, right? The iPhone showed up in 2009, 2010. Those are all technologies that they take for granted. That's just the default standard state. And if you and I remember dial-up modems, it's crazy to think that
I plugged into my compact computer.
Everyone's hand, you take it for granted. But what'll really bake your noodle is the fact that this generation of founders is thinking about AI in a similar way. If you're 18 years old, the ChatGPT moment was a few years ago, and so you were really coming of age, and you were about to go to college, and now you have a totally different worldview on knowledge because we've democratized access to infinite human knowledge, and the tools on which we're building they're the worst they're ever going to be. They're only going to get better. And so the gift of that is the founders who are leaned in right now, they know it has never been a better time to be building a company, to be starting a company. It's never been a better time to be an 18-year-old, whatever, 20-year-old, someone who has minimal experience, but has really high agency, really high drive, and is very curious. So it is an amazing time to be a founder, far better than it was 20 years ago. I think at any point in the last 2 decades that I've been either building companies or investing in them. And I know it feels like there is a big gap. At the same time, we have members of that same generation that are like opting out of work or railing against a lot of that. And I really, really hope that the builders win. I really, really hope that more and more people, especially young people, feel compelled to see problems and then do something about them, right? Not just talk about them, not just complain about them, but actually take action. And what I've just seen, the power of entrepreneurship to be able to just improve quality of life. Yes, build great businesses that hire lots of people, but improve the quality of life for civilization. I want to see more of that. And I do feel that gap with this generation. But for the folks who are leaned in, it's inspiring as hell.
Alexis, you're a father of young children. What is this AI revolution? What will it mean to how they learn? But in addition, what does it mean for that generation, their ability to find jobs 15, 20 years from now?
Well, okay. So on the latter point, I don't know. I want to believe I'm a tech optimist, and I do think more new jobs will be created than removed from the system. I think an easy example, we were fortunate to be early investors in a guy, Mr. Beast, 5 years ago. The idea of being a content creator, let alone a billionaire because of it, was unthinkable, 15 years ago, 20 years ago? And now it's probably one of the most common professions that a young kid, at least in America, wants to be when they grow up. So there is precedent, right, for, social media, that revolution was a significant one, not nowhere near as big as AI, but it was one that created entirely new career paths, sectors, industries that didn't exist before. And with every technological revolution, there's always new careers, new things that come up that you or I can't necessarily think of. The builders are going to build and do. And so I'm hopeful there are going to be more new ones created. We actually just in DC with one of our companies, Area 2 Farms, where they're franchising vertical farming. And when they talk about what is needed to manage a vertical farm, especially in a dense urban area where you don't have a lot of space, and because it's more vertical, you're going to have a whole new trades of people who are working on the robotics that help manage those farms and make sure the lettuce, grows on time and whatnot. And so again, we're already seeing AI, robotics, they're two sides of the same coin, creating new jobs, new opportunity, new innovation, better quality of life, right? Everyone deserves access to high quality, well-grown produce, right? Whether you live in a rural community, whether you live in a city. And so I feel like it'll be a net positive. That doesn't mean it won't be a bumpy road. And, how do I prepare my 8-year-old and a 2-year-old for this? I've already been paying attention. I've been tweeting about things like Alpha School, which I think are taking a really smart first principles approach to education. I do think the future of education for, let's say, K through 12 looks a lot more like having guides instead of teachers, and that's verbiage from folks like Alpha School and Prenda, where your personalized AI tutor is doing a lot of the instruction, right? I'm a big Duolingo user. You're familiar with that. That is probably the
great platform
expression of that, right? And there's no reason why a kid, regardless of their background, regardless of their home life, shouldn't be able to get personalized education. So if they need extra help with a certain part of math or a certain part of English, fill in the blank, you're going to have AI solve those problems for them, giving them that infinite access and infinite patience to support and customize learning. And then hopefully those kids get to spend the rest of their school day actually interacting and building up their emotional intelligence and solving problems. And I think the school of the future should really optimize the time with the AI to help learn, but also maximize the time off a screen so that kids are getting the things that are going to continue to be valuable when they grow up. Emotional intelligence, communicating, empathy, creativity. And those are things that, in my opinion, are what really make us human. Like those are the most delightful parts of being a human being. And essentially we have these amazing calculators now that have democratized access to a lot of the pure horsepower of intelligence, which should allow this next generation to focus on the more, I'd say, human sides of it. But it's a thing we think about a lot. There's no one solution. I serve on the board of Tiger Woods' foundation, TGR. They're doing a ton of great work with their learning labs, and that's an after-school curriculum. But we're talking all the time about how we can bring AI into those learning labs so that these kids, even when they come out of school, maybe their school systems aren't quite adopting this new tech fast enough. They can come to these learning labs, spend an hour, and get a huge ROI of customized, personalized learning. So I'm excited. I can see firsthand the way these technologies are improving the quality of life for the people I care about. And even, if I'm on a road trip or in the car for a minute with our oldest daughter, I can use AI to come up with, 50 trivia questions that are suitable for an 8-year-old. Sometimes I put like 10-year-old because I want to push her a little bit. And now I have a quick little trivia game that I can, engage with my child on, right? I want her to understand that this is a tool that will help her stay curious, that will help her solve problems, right? I want that growth mindset baked in. And I can't help but be a tech optimist in this regard, because I can see just how much power she's going to have at her fingertips that we could have only dreamed of when I was her age.
Alexa, let me channel the sports side of your brain. And earlier on today, I had a really good chat with Ted Leonsis, owns the Wizards, several other teams. His portfolio is valued at, I believe, close to $8 billion. We mentioned the Lakers, valued at close to $10 billion. You have been an early supporter, investor of women's sports. When in the world is this valuation gap closed between women's sports and some of these mind-blowing valuations on the men's side of the equation?
Look, it's coming quick. My tweet about how undervalued women's professional sports was in March of 19 went viral for all the wrong reasons, right? I said this is a massive opportunity. I said I was going to either start or buy. It was an NWSL team, professional women's soccer team, and one day it was going to be worth billions. And most people said I was an idiot and no one watches women's sports and that'll never work. And I said, save those tweets. And he ultimately paid a little over $1 million for the expansion fee to start Angel City FC. And in the wake of that success, right now it's valued at the most for any American women's soccer team. Arthur Blank in Atlanta just paid, I think, $160 million for his expansion fee. So that's quite an appreciation over just 5 years. And so it has been really validating to see, to call the shot, to spark that and see the growth. But I think anyone will tell you it's just the start. There is so much more room to grow. And remember, most of these men's teams' value is based on media deals that have been baked over decades. And, whereas for women's sports, when we're building a team, I just bought the LA franchise of League One volleyball. And it was just like 2 weeks ago, so hot off the press. And,
Congrats. Wow. I didn't even.
We build out, thank you. When we build out the structure for how to build that team, most of our revenue is not going to come from a media deal. Most of our revenue is going to come from brand deals. And so we've been able to build, Angel City's doing tens of millions of dollars in revenue a year. You're seeing a precedent here for more and more women's pro teams to basically build the muscle of revenue generation in a way that's much more about, business, right? It's about how do you drive revenue through brand partnerships and all these things that it turns out lots of CMOs are excited by. And the media deal is still down the road. So you have to earn that media deal through the viewerships, but the brand dollars obviously help you build the brand and prove the value. And it's this virtuous cycle. And you've seen that in the rapid ascent of WNBA team valuations and revenues. And I think, it won't be for every sport, but you can see the places I've been investing, obviously also starting a Formula One for track and field like Athlos. That's an entire league where I've seen this same opportunity that I saw with women's soccer, where the World Cup showed up every 4 years and then everyone was watching and then they all disappeared. The thesis was simple, why not make sure they don't disappear and keep investing? Similarly, track and field is the #1 Olympic sport. These athletes are superstars and then they disappear. They shouldn't disappear. So we built Athlos and 4.5 million people tuned in for our New York meet just a month ago. And we're rolling out a multi-meet league next year with teams. So I'm excited about all this. I think at the end of the day, we're only 5 years away. I think 6 years from my tweet. And I think there is still so much more room to grow in women's sports. I think we will absolutely see billion-dollar women's sports teams as I had laid out, and I will be sure to rub that in the face of all those haters on Twitter 6 years ago.
Last one, and I wanted to save this one, Alexis, because I think this is also in your wheelhouse, and it's also in the wheelhouse of my dear friends at Yahoo Sports. Why are collectibles having a moment, and what is next in this industry?
It has been an amazing ride. We love our partnership with Mantle and Yahoo. We've got some hobby awards right now, actually. I think this industry is starting to professionalize, right? The hobby was always a very mom and pop type business. And during COVID, everyone was locked down. Everyone was feeling pretty anxious, and nostalgia became really, really desirable. And so that's when I got back into the hobby. I collected cards as a kid, like a lot of kids in the 90s. I thought that collection was going to help me retire one day. It did not. Thanks, Sarah.
Same here. I just found my Batman cards the other night, Alexis, from the 1990s movie. I got a whole collection of them.
90s, yeah, that's tough. That's probably not worth much. I'm sorry.
Thanks a lot.
The good news is the card producers are being a lot more savvy with how they're the big problem is the oversupply, right? Supply and demand. I'll tell you what happens there. So the card producers are being a lot smarter now, a lot more creative, limiting supply. And here's the way I look at it, very simply. Collectibles are our generation's art. And at the end of the day, if I can show you a, Serena Williams rookie card on my desk, or, 86 Fleer Jordan, right? That feels like a flex. That for me, having a Warhol or having, pick your favorite modern or contemporary artist, it doesn't really do a lot for me. But if you abstract it away, right? What is, art on a wall is ink or something on a dead tree. And, that 86 Fleer Jordan is just ink on a dead tree. But there's a cultural significance for a generation of us who grew up during the rise of sports, really the commercialization of sports. And I think whether it is trading cards, comics, collectible video games, collectible music, even match-worn jerseys and outfits, I think these kinds of culture assets are still undervalued. Obviously, do your diligence. Don't, ask your wife before spending your entire IRA on these things. But very, very important is, and the thing that I really do believe is that, art and these culture assets have always been a part of, sort of the financial world. And you may not, agree with it, right? A crate of wine, priceless Van Gogh or whatnot. And I think this is just a new generation's version of that same thing. And thanks to the hyperconnectivity of the internet, so sports has never been more valuable. And I'd say in particular, if you think of this AI age, I've only gotten more bullish about the value of sports since that tweet in 2019, not just because it's been working and working well, but because across entertainment, AI is going and already going to upend every other pillar, right? Hollywood, television, all those industries you're seeing, right? The cost of production is going to drastically fall. There's a chart-topping song right now that I think is entirely AI generated. It's a bop, right? But the music industry, It's going to look very, very different. Taylor Swift, I'm still taking my daughter to see Taylor Swift. That's a religious experience. Kendrick Lamar is going to be just fine. But if you think of more vapid, sort of shallow, like one-hit wonder type artists, right? It's going to be very challenging when, you know, a talented producer or a 16-year-old can spin up a really catchy beat, one of those earworms. And so every other form of entertainment is going to be really reimagined because of this technology. But I'm never taking my kids to go see robots play soccer. I'm never taking them to go see robots hit 18 hole-in-ones, right? Can you imagine the Ryder Cup with robots? And it's just 18 European.
I could, but that's not. We won't take it. We won't go there for this conversation.
But it's boring.
Yes.
And so I believe if we project this out, every screen in our life, right? Think of how good the TikTok algorithm is, or you pick your favorite social network. They're all optimizing for that little bit of dopamine to keep us a little bit more attracted. And at the end of the day, this will only get better. And all the content we consume on a screen will be optimized for exactly what we want, when we want it, the way we want it, right? And so there is a dystopian side of this, which is a part of our humanity dies from that, because we're not here to be spoon-fed exactly what we want when we want it, right? Our species is here because we've done hard things, or our forefathers did hard things and overcame them. And there's a part of our humanity that dies if we're just getting this sort of spoon-fed, release. And so I think the last place left where we'll be able to live vicariously through this human experience of, like, going back to when we tried to catch the gazelle, and like some days you catch it and some days you don't. And it really sucks when you don't, but you dust yourself off and figure out how to catch it again. It's left in sports. And if you grew up like I did as a Commanders fan, you felt a lot of pain growing up and disappointment, but boy, does it feel good when that support is rewarded with some success. And I think sport is the last storyline that is going to be left with, that is truly like a must-watch experience for us in this age of AI. And I like I said, robots are not going to replace it. AI will just enhance the experience. And so then think of all the things related to that will continue to maintain or even increase in value, which takes me back to collectibles. It makes me think, like, again, if you're thinking about it as an investment, and again, do your own diligence, but if you think about it as an investment, that creates a really interesting opportunity for the asset class. And we've seen it with the marketplace alt that I had seeded. The growth has just continued quite well over these last few years.
Alexis, thank you for doing this. You've always been a supporter of Yahoo Finance. Thank you for making time with us for this big event. We will talk to you soon. Thank you so much, my friend.
Absolute pleasure. All the best. Love me some Yahoo Finance. And make sure to vote for the hobby awards between Mansell and Yahoo Sports.
Thanks, Alexis. Appreciate you, man. All right. Well, thank you to everyone for watching Yahoo Finance Invest. It has been a tremendous day for the team. And look, I know you've been watching me on camera all day, Julie Hyman, Kenny Polcari, Nez Ferre, Brooke De Palma, Jared Blickery, everyone. But it is the people behind the scenes that help bring this to life over the course of many months. They have been busting their butts off around the clock, darn near here, every single day around the clock, trying to bring this event to life. And I couldn't be more proud of them, because without their superhuman efforts, I wouldn't be sitting in this chair. I hope you enjoyed all of today's content. You can head to our landing page, check out all the video clips. I'll be back on air tomorrow morning with some big takeaways from Yahoo Finance Invest. Again, thank you for the love and support, and we'll see you tomorrow.